Please like, share, and subscribe. Wishing you happiness and good luck every day.
When you think of an investment genius, one name probably pops into your head, right? Warren Buffett. But what if I told you his entire method, a method that, by the way, modern finance theory says shouldn't even be possible, could be broken down into a simple, understandable blueprint? Well, that's exactly what we're going to do. Using Robert Hagstrom's incredible book, The Warren Buffett Way, as our map, we're going to deconstruct the philosophy that built one of the greatest fortunes the world has ever seen. So let's just start with a number that's, well, it's kind of hard to even wrap your head around. 586,817%. Yeah, you heard that right. That was the total gain of Berkshire Hathaway under Buffett's leadership from 1964 all the way to 2012. A performance like that, it doesn't just suggest success, it screams for an explanation. And here's why that number is so controversial. For the last half-century, the big idea in academic finance has been something called the efficient market hypothesis. Basically, it says you can't beat the market with skill, only with dumb luck, because any information you might have is already baked into a stock's price. So a track record like Buffett's, stretching over 50 years of just winning again and again. According to the theory, he's just the luckiest person who ever lived. Or maybe, just maybe, the theory's got a big hole in it. And that, right there, is the central puzzle we're trying to solve. If all the experts and all the textbooks tell you that you can't consistently beat the market, then how in the world did Warren Buffett build an absolute empire by doing exactly that, year after year for decades? Okay, so here's our game plan to figure it out. First, we're going to look at why he's such a massive exception to the rule. Then we'll uncover the education that really shaped his thinking. After that, we're diving deep into his 12 immutable tenets. This is the core blueprint. Then we'll explore his kind of controversial take on building a portfolio, the psychology that makes it all click, and finally, how we can all start to think a little bit more like Buffett ourselves. So just how rare is a performance like his? Well, statisticians have a term for something so far from the average it basically shouldn't happen, a 5 sigma event. We're talking a 1 in 3.5 million chance of this occurring. And that's exactly what academics have called Buffett's track record. This isn't just unlikely, it's so statistically improbable that pure chance just can't be the answer. And here's the key takeaway from that. Look, anyone can beat the market for a year or two. That could be luck. But when you do it for over 50 years while managing billions and billions of dollars, luck just doesn't cut it as an explanation. Buffett's record is the ultimate proof that yes, skill, not just chance, can absolutely win this game. His methods aren't random, they're part of a repeatable system. So where did this amazing system come from? I mean, he wasn't just born with it. His philosophy is this powerful mix, built on the shoulders of 3 intellectual giants. Each one gave him a crucial piece of the puzzle, and when you put them together, they form the bedrock of his entire approach to investing. First up was Benjamin Graham, his professor at Columbia. Graham gave him the quantitative, the numbers-driven foundation. He taught him to always think of a stock as a piece of a real business, and to always buy it for less than it's really worth. That's the famous margin of safety. Next, Philip Fisher added the qualitative side, showing him how to spot innovative, well-run companies with huge long-term potential. But the final piece of the puzzle, the one that really brought it all together, was his partner, Charlie Munger. Munger was the one who pushed Buffett to move beyond just buying mediocre companies at super cheap prices. He said, Warren, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that synthesis, Graham's numbers, Fisher's quality, and Munger's wisdom, that right there is the Warren Buffett way. So that's the theory behind it all. But how does he actually put it into practice? How does he decide what to buy? Well, Hagstrom's book boils it all down to 12 core principles. This is the non-negotiable checklist, the blueprint he uses for every single investment, and it's broken down into 4 key areas. First, he zeroes in on the business itself. And the number 1 rule is his most famous. Is it simple and understandable? If he can't explain on the back of a napkin how it makes money, he's not interested. This is his famous circle of competence. Second, he wants to see a consistent operating history. He's looking for companies with a long, stable, predictable track record, not some risky turnaround or a brand new startup. And third, he asks about the long haul. Is this business still going to be a powerhouse in 10, 20, or even 30 years? Next, he moves on to the management, the people who are actually running the show. First, and for him, this is the big one. Is the management team rational? And really, that just means one thing. Do they use the company's profits wisely, or do they waste them on ego-driven projects? Second, are they candid? Do they talk to shareholders with total honesty, especially when things go wrong? And finally, do they resist what he calls the institutional imperative? This is just that corporate herd mentality, the pressure to mindlessly copy what your competitors are doing, even if it's a terrible idea.
Then it's time for the hard numbers, the financial tenets. He's looking for a consistently high return on equity. He wants to see how well the company uses shareholder money to make more money. He calculates what he calls owner earnings, which is basically the real cash profit a business is generating, a much more honest number than what you often see. He also demands high profit margins because that signals a really strong competitive edge. And finally, he uses the $1 test. Has the company shown that for every single dollar of profit it keeps, it creates at least one new dollar of value for its owners? And the last two tenets bring it all home. After all that analysis, he asks, okay, what is the real intrinsic value of this entire business? He calculates this by estimating all the cash the business is going to produce from now until Judgment Day. Then comes the final, most crucial question of all. Can I buy it in the stock market today at a significant discount to that value? That gap between its value and its price, that is his margin of safety. It's the cushion that protects him from being wrong. And only when every single one of these conditions is met does he even consider making an investment. So once he's used this checklist to find a great company, how does he actually build a portfolio? Well, this is another area where he just completely breaks from what everyone else does. He practices something called focus investing, and it's basically the exact opposite of diversification. You know, the conventional wisdom says to diversify. Spread your money around, own a little bit of everything to lower your risk. Buffett thinks that's nuts. He calls it diversification. His approach is the polar opposite. He believes you decrease risk by concentrating your money into a small handful of incredible companies that you understand inside and out. And this quote right here reveals his entire philosophy on risk. See, for Buffett, risk isn't about a stock price bouncing around day to day. Real risk is not understanding what you own. He believes that by concentrating your bets, you force yourself to be more disciplined, to really deeply know your businesses. And that intense knowledge is a far better protection against risk than just scattering your money all over the place. But here's the thing. Having the right checklist and the right portfolio strategy, that's only half the battle. Buffett's true superpower, the one that's almost impossible to replicate, is his psychological discipline. He has absolutely mastered the mental game of investing. So what's the biggest obstacle to your own investment success? Well, for most of us, it's the person staring back in the mirror. Our own emotions, greed when the market is flying high, and fear when it's crashing, are poison to good returns. There's this concept called myopic loss aversion, which is just a fancy way of saying that we feel the pain of a loss about twice as much as the joy of a gain. And that causes us to panic and sell at the absolute worst time. Buffett, though, he seems to be immune to all of this. He's famous for being greedy when others are fearful and fearful when others are greedy. So his key advantage really comes down to two simple things: rationality and patience. In a world that screams for constant action, Buffett is perfectly happy to just sit there and do nothing for months, or even years, waiting for the perfect opportunity to come along. He compares investing to baseball, but a special kind, where there are no called strikes. You can stand at the plate all day and just wait for that perfect fat pitch right down the middle before you swing. Okay, so we've looked at the theory, the 12 rules, the portfolio strategy, and the psychology. Now for the most important part. How do we actually pull all of this together and use it? How can we really learn to think like Buffett? First, let's just look at the scoreboard one last time. Over almost 50 years, the market did great, returning a very respectable 9.4% a year. But Berkshire Hathaway, using these principles, returned 19.7% a year. That difference, compounded over a lifetime, that's the difference between doing well and creating true generational wealth. The method just flat out works. And that brings us to maybe the most empowering part of his whole philosophy. Even with those unbelievable results, Buffett has always insisted that his method isn't some secret code that only a genius can crack. He believes success just comes from consistently applying simple, rational ideas. It's about having the right discipline and the right temperament, not some crazy high IQ. And that really is the most important takeaway of all. The whole point of studying the Warren Buffett way is not to try and be Warren Buffett. You can't. The real goal is to take these timeless principles, thinking like a business owner, demanding that margin of safety, staying rational when everyone else is panicking, and to integrate them into your own thinking. That's how you become a more intelligent, more patient, and ultimately a more successful investor.
So we'll end by turning his first and most important rule back on you. What businesses, what industries, what technologies do you understand better than almost anyone else? What is in your circle of competence? Because according to Warren Buffett, that is the only place your journey as an intelligent investor can really, truly begin.
Warren Buffett. You hear that name and you immediately think investing genius, right? But here's the big question. Was the Oracle of Omaha just born that way, or was he made? Was it all just dumb luck, or was it something else? Well, that's what we're going to dive into today. We're going to unpack the origin story of this absolute legend. You know, if you ask Buffett himself, his answer is, well, it's pretty humble. He basically says his massive wealth comes down to three things: living in America, some lucky genes, and of course, compound interest. He has this great phrase for it. He calls it winning the ovarian lottery. You know, just being born in the right place at the right time with a brain that, in his words, was just wired in a particular way for making money in our economy.
But is it really that simple? I mean, come on. The source material we're looking at today makes a really strong case for the opposite. The idea is that Buffett didn't just get lucky, he actually carved out his own destiny. And that's really the mystery we're going to try and solve here. Was it all just fate? Or was this something he built himself with sheer force of will right from the very beginning? Okay, so to get to the bottom of this, we've got to go way back to the very beginning. We're talking about a young kid in Omaha, Nebraska, who wasn't just, good with numbers. No. He was completely obsessed with them. And I mean, this wasn't your typical childhood hobby. This was a deep, innate fascination. Picture this. He and a friend would just sit on the porch for hours recording license plate numbers for fun. And when it got too dark for that, they'd go inside, let out the newspaper, and count how many times each letter of the alphabet appeared. He even used a stopwatch to time his sister's marble races in the bathtub. I mean, who does that? This was a brain that was just naturally wired for data, for patterns, for calculation, right from the start. So, this is where everything changes. As much as he just loved numbers for what they were, one simple Christmas gift from his Aunt Alice, it flipped a switch. It was one of those nickel-coated money changers, the kind you clip on your belt to make change. And just like that, his abstract love for numbers found a very real, very tangible new target: money. And that little spark didn't just smolder, it exploded. That fascination with money turned into this relentless entrepreneurial drive. And believe me, this wasn't just a kid playing around. This was business. Get this, at just 6 years old, he had already cracked the code of business. His model was brilliant in its simplicity. He'd go to his grandpa's grocery store, buy a six-pack of Coke for 25 cents. Then he'd go door to door and sell each bottle for a nickel. You do the math. That's 30 cents in total sales, which means a 5-cent profit. That's a 20% return on his money. This wasn't just a kid with a side hustle. This was a 6-year-old who understood profit margins and arbitrage. It's incredible. And it did not stop with Coke. He sold chiclets, he sold magazines, he sold popcorn and peanuts at football games. If you could sell it, he was selling it. And then, as a teenager, he leveled up. He and a buddy started their own company, the Wilson Coin-Operated Machine Company. They bought a used pinball machine for $25, talked a local barber into putting it in his shop, and they'd split the profits. After just one day, they pulled $4 in nickels out of that thing. Before they knew it, that one machine turned into a bunch, and the business was pulling in $50 a week. The hustle was just absolutely relentless. So all of this work, all this hustling, it really started to add up. By the time he graduated from high school, Warren Buffett had saved $9,000. Let that sink in for a second. We're talking about the 1940s. That's not just pocket money, that was serious capital, all earned one nickel and dime at a time. So you have to ask, where does a drive like that even come from? Well, a big part of it seems to stem from his family's brush with the Great Depression. It was brief, but it was terrifying. His dad lost his job at the bank. Their savings were just gone. And even though his father bounced back pretty fast, that experience, that fear, it stuck with young Warren. It lit a fire under him. His biographer called it an absolute drive to become very, very, very rich.
All right, so now he's got capital. He's got this fire burning inside him, and he starts to shift his focus from just earning money to making his money work for him. And his first real venture into the stock market, well, it was about to teach him one of the most painful and most important lessons of his entire life.
He's only 11 years old, but he decides he's ready. He takes $114.75, which was money he had scraped and saved for 5 years, and he even convinces his sister Doris to go in with him. They buy 3 shares each of a stock called Cities Service Preferred. It was a stock his dad recommended. He'd studied the charts. He felt like he knew what he was doing. He was confident.
And then, boom, disaster. The stock immediately tanks. It drops by 30%. And you can bet his sister was reminding him about it every single day. So what does he do? The second the stock crawls back to what he paid for it, he sells. He gets out, locks in a tiny $5 profit, and just breathes this huge sigh of relief. But then he has to watch in absolute horror as that same stock skyrockets to over $200 a share.
Of course, he did the math. He figured out he'd missed out on a profit of $492. Now, to you and me, that might not sound like a lot, but for an 11-year-old who spent 5 years saving up just over $100, this was a catastrophe. In his mind, it was like he'd just thrown away 20 years' worth of work. But you know what? That painful mistake became the absolute foundation of his entire investing philosophy. He made a promise to himself right then and there. 3 rules. Rule 1, don't get obsessed with what you paid for a stock. Rule 2, don't be in such a rush to take a tiny profit. And rule 3, maybe the most important lesson he ever learned, patience. Patience is one of the most important virtues in investing, and he figured that out at 11 years old.
So that whole experience taught him something huge. Raw talent for numbers and a crazy work ethic, it wasn't enough. He needed a system, a framework, a philosophy. And his search for that philosophy is what comes next. It's a journey that would take him from a school he hated to a mentor who would literally change his life forever. So his dad makes him go to college, and he ends up at the famous Wharton School of Business. You think he'd love it, right? Nope. He was totally unimpressed. He felt like they were just teaching all this abstract theory, but he wanted to know the practical stuff, like how do you actually make money? He stuck it out for 2 years and then transferred. It wasn't until he found out about a professor named Benjamin Graham at Columbia University that everything, and I mean everything, finally clicked into place. So what was this revolutionary idea that Graham was teaching? It was a concept called intrinsic value. And the idea is actually pretty simple, but it's incredibly powerful. Basically, if you can figure out what a company is truly worth, its real underlying value, and then you have the discipline to only buy its stock when it's selling for less than that value, you can't lose. For a numbers guy like Buffett, this was it. This was the logical, mathematical system he had been looking for his whole life. When Buffett first read Graham's book, The Intelligent Investor, his description of it is almost spiritual. He said it was like seeing the light. And that's because this was the moment. This was when his natural gift for numbers, his crazy entrepreneurial hustle, and that hard lesson about patience, it all came together, unified by this one single powerful philosophy. And he didn't just, get Graham's ideas, he absolutely mastered them. His classmates said that it felt less like a class and more like a private conversation between the master and his star student, with everyone else just watching. And get this, at the end of the course, Buffett got an A+. It was the only A+ Benjamin Graham had ever given out in 22 years of teaching. So after graduation, he does the logical thing. He asks his hero, Benjamin Graham, for a job. And Graham tells him, no. Ouch. I'm sure that stung. But Buffett wasn't deterred. He packed his bags and went back home to Omaha. He didn't have a fancy Wall Street job, no, but he had something way, way more valuable. He had the complete intellectual toolkit that would guide him for the rest of his life. So when you really look at it, how this legend was built, it wasn't just one thing, was it? It was this potent combination of an incredible, innate gift for numbers, a work ethic that was just off the charts, some really tough lessons learned from his own failures, and finally, finding that perfect investment philosophy to pull it all together. So yeah, maybe he won the ovarian lottery, but he didn't just sit on that winning ticket. He cashed it in with a lifetime of hard, focused work. And that kind of brings us to a final question, one I want to leave with you. We've seen his story as this blend of raw talent, crazy hustle, and learning from failure. But if you think about success today, in our world, which of those traits do you think is the most important? Is it the natural-born talent? Is it the relentless work ethic?
Or is it that ability to get knocked down, learn from it, and get back up again? It's a really interesting thing to think about. You know, before Berkshire Hathaway became the behemoth it is today, there was something else, the Buffett Partnership. It was this small firm started by a 25-year-old guy in Omaha, and it became the launchpad for an absolute investing legend. So today, we're going to dig into how it all began. Okay, let's get into it.
I mean, that question sounds kind of crazy, right? Turning $100 into 25 million in just over a decade. But that is exactly what happened. And this story, it's not just about the numbers. It's really about the mindset, the incredible discipline, and a few key moments that would define the career of Warren Buffett. So how on earth did he pull it off? Well, the story doesn't start with a pile of cash. It starts with a mentor. See, before Buffett could find his way around the market, he needed a solid map. And he found his map maker, the guy who would completely change how he saw the world, the legendary investor, Benjamin Graham. This quote from his biographer, Alice Schroeder, is just so powerful, isn't it? Because learning from Graham wasn't just about picking up a few new stock tips. For Buffett, it was like his whole reality shifted. Before Graham, Buffett saw stocks as just, little squiggly lines on a chart. Graham taught him the most important lesson of his life. A stock isn't just a piece of paper. It's a tiny piece of an actual business. And that one simple idea, well, it changed absolutely everything for him. Think about that analogy for a second. The stock market really can feel like this big, chaotic, even dangerous city if you don't know your way around. Graham didn't just give Buffett a few directions. He gave him a system, a whole framework, a scientific, methodical way to invest. It took what a lot of people thought was basically gambling and turned it into a real, honest-to-God discipline. So, flash forward to 1956. After a couple of years working for his hero, Ben Graham decides to retire. So Buffett, just 25 years old, heads back home to Omaha. Now, he wasn't some big shot on Wall Street, not at all, but he had Graham's map in his pocket, and he was ready to start his own firm. And you can see here, things started incredibly small. I mean, we're talking 7 partners, mostly his family and friends, who put in a grand total of $105,000. And Buffett himself, get this, he put in just $100 of his own money. His real capital was what was between his ears. And the fee structure really shows you how confident he was. His partners got the first 6% of any returns, and he only got a cut of the profits above that. He was betting entirely on his own ability to outperform the market. This was the promise he made to those very first partners. And right from day one, the philosophy was crystal clear. This wasn't about chasing hot stocks or following the herd. It was about 2 things. 1, finding true fundamental value. And 2, and this is the big one, not losing money. That principle became the absolute bedrock of his entire empire. So, did this whole value first thing actually work? Well, the numbers on this chart are pretty staggering. In just the first 5 years, the partnership was up 251%. The overall market, the Dow, was only up 75% in that same time. Remember his goal? He wanted to beat the Dow by 10 points a year. He wasn't just beating it, he was absolutely crushing it by an average of 35 points every single year. So, as you can imagine, his reputation and the partnership started to get a lot bigger. Every great investor is eventually tested. And for Buffett, his first huge public test came from one of the weirdest, biggest corporate scandals of the 1960s. And it all started with a simple fact you probably learned in middle school science class. Oil floats on water. The scheme was just so audacious because it was so simple. This company, Allied Crude, would borrow tons of money, using all the salad oil it had in inventory as collateral. But here's the catch. The tanks weren't full of oil. They were almost completely full of water, with just a few feet of salad oil poured on top. So when the inspectors would come, they'd dip their measuring sticks in from the top and be totally fooled. When the whole thing collapsed, it sent massive shockwaves through the financial world. And one of the biggest casualties here was American Express. They had backed a ton of these fraudulent loans. The company lost $58 million, which was a crazy amount of money back then, and Wall Street completely freaked out. The stock price got cut in half, practically overnight. Everybody was sprinting for the exits. Okay, so this is the crucial moment. While all of Wall Street was reacting to the headlines and the pure panic, Buffett started asking a different kind of question. Sure, he knew about the $58 million loss, but what he really wanted to know was, did this scandal actually damage the underlying business of American Express? So he got out of his office and did his own detective work.
And this is just classic Buffett. He didn't build some super complex financial model. He literally went to restaurants and watched how people paid for their dinner. He went to local banks and just talked to the tellers. And what did he find? That regular people couldn't care less about the salad oil scandal. They were still swiping their Amex cards, still buying traveler's checks. The company's brand, its core business, it was completely rock solid.
So what did he do? He acted, and he acted big. He poured $13 million, that's a full quarter of the partnership's entire assets, into American Express stock. And within 2 years, the shares had tripled. The partnership netted a cool $20 million profit. It was an absolute masterclass. And here's the real takeaway. It proves the power of separating all that market noise from the actual business fundamentals. True value investing is about investigating the business, not just reacting to the stock price.
You see, the American Express investment wasn't just a great trade. It was a real turning point. This period in the 1960s was an inflection point, not just for Buffett's strategy, but for the entire market.
In calculus, an inflection point is just where a curve changes its direction. And that's exactly what was happening to Buffett's career path. He started to move beyond just buying cheap stocks here and there. He started buying controlling stakes in entire businesses, like a farm equipment maker called Dempster Mill and a struggling little textile company you might have heard of called Berkshire Hathaway. And at the very same time, the market itself was hitting a massive inflection point. The old, disciplined value investing of the Ben Graham era was giving way to the go-go years of the late 60s. The focus shifted from buying cheap, solid companies to just chasing fast-moving, high-flying growth stocks. The whole market was getting way more emotional, way more speculative. Now, you'd think that with a track record like his, Buffett would have just crushed it in any market. But as these go-go years really started to heat up, he got more and more uncomfortable. And that led him to make a decision that absolutely shocked everybody. First, let's just take a second to really appreciate this final scorecard. Over 13 years, the partnership gained a mind-blowing 1,156%. The Dow, for comparison, was up just 123%. He was at the absolute undisputed peak of his game, and it was at that exact moment that he decided to walk away from it all. So why? Why on earth would you walk away at the top? Because the music had changed. The market was now obsessed with these hot growth stocks, like Polaroid and Xerox, which were trading at 100 times their earnings. 100 times. That means you're paying a price that would take the company a century of profits to earn back. In that kind of speculative frenzy, Buffett felt like a fish out of water. He just couldn't find the kinds of undervalued, safe businesses his whole strategy was built on. This quote from the last letter he ever sent to his partners, it says everything. He could have jumped on the bandwagon. He could have chased those easy profits of the go-go years. But he refused to play a game where he didn't understand the rules. His commitment to his principles, especially that one about avoiding a permanent loss of capital, it was absolute. And that discipline is what really truly set him apart. Let's just put his performance in its final perspective. Remember, his goal was to beat the Dow by 10 percentage points a year. For 13 straight years, he beat it by an average of 22 points. That is an absolutely stunning record of outperformance, and he was now choosing to just end it. But he wasn't retiring. When they finally dissolved the partnership, Buffett's original $100 investment had turned into a personal fortune of $25 million. He gave his partners their cash back, told them to check out another manager, and then he took his own winnings and consolidated them into his new primary investment vehicle, that old textile company, Berkshire Hathaway. So think about that. He closes the fund that made him famous, right at the top. He steps away from a market he feels is just too crazy. To a lot of people at the time, it looked like the end of the story. They thought his best days were definitely behind him. But, as we all know now, it wasn't an ending at all. It was just the beginning of Chapter 2.
When you hear the name Berkshire Hathaway, you probably think of staggering success, right? One of the most valuable companies on the planet. But today, we're not going to talk about that Berkshire. We're going back to the beginning to tell the story of a totally different Berkshire Hathaway. A dying business that became Warren Buffett's single biggest mistake and, believe it or not, his most important teacher.
So, that's the big question for today. What happens when you pit a genius investor against a truly awful business? This isn't just some old story, it's a look into the very crucible that forged the investment philosophy of a legend.
You see, before it was a holding company, Berkshire Hathaway was a textile manufacturer. And it wasn't just any manufacturer. Oh no, it was an absolute giant, a real titan of industry with a legacy that stretched back more than a century.
The company's roots go deep. I mean, we're talking all the way back to 1889. It just kept growing, merging with other companies, until 1955 when it became the Berkshire Hathaway we know by name. This thing was a true institution with a powerful, storied history.
It is really hard to overstate just how dominant this company was in its prime. It wasn't just a big fish in a small pond. It was like a whale in the entire New England industrial ocean. It was an absolute cornerstone of the whole regional economy. Okay, just let that number sink in for a second. 25%. 1 out of every 4 yards of cotton material made in the entire United States came from this one company. That is an almost unbelievable level of market dominance. Just wild. And here's another stat that really paints a picture of its sheer size. This company was a massive, power-hungry industrial machine. I mean, to consume 1% of an entire region's electricity, that tells you just how colossal its operations really were.
But, as powerful as it was, the world was changing. And that big merger in 1955, the one that was supposed to make it even stronger, well, it actually marked the beginning of a long, painful decline. The Titan was starting to stumble.
Now, this timeline tells a very different story from the first one, doesn't it? This isn't a story of growth. It's about a slow, grinding decay. And check out the dates. This wasn't some sudden collapse. Even after Buffett took over in the mid-60s, the struggle went on for another 20 long years.
The numbers, they were just bleak. In the 10 years after that merger, the company's net worth, the actual value belonging to its owners, was cut in half, just sliced down the middle. This is the catastrophic situation a young Warren Buffett walked right into. And on top of that collapsing value, the company was just burning through cash. $10 million in operational losses. That means they were spending that much more than they were making, just to keep the lights on. It was a financial black hole.
And look, this wasn't a case of neglect or anything. Buffett and his textile manager, a guy named Ken Chase, they fought tooth and nail for 2 decades to try and turn this thing around. But despite all that effort, the results were just consistently, frustratingly awful. They were fighting a battle they just couldn't win.
And this is where we get to the real heart of the story. Why would a famously rational investor keep pouring time, money, and effort into a failing business? Well, the answer is in this classic dilemma, the cold logic of profit versus the very real human cost.
So, on one hand, you have the textbook business school answer. The numbers are clear, the business is a dud. You shut it down, you stop the bleeding, and you move that money somewhere it can actually make a return. But on the other hand, you have the human reality. This wasn't just a line on a balance sheet. It was people's lives. It was an entire community's economy.
Buffett's thinking went way beyond the spreadsheet. He knew the mills were the biggest employer around, and the workforce was older. These folks couldn't just go out and easily find new jobs. He saw that management and the unions were genuinely trying their best, and he held on to this sliver of hope that maybe, just maybe, he could eke out a tiny profit to keep it all going. He was balancing the cold numbers with his sense of responsibility. And it was right here, out of this intense, 2-decade-long struggle, that a core piece of Buffett's philosophy was born. This incredibly difficult experience forced him to forge a new way of thinking, a path right between 2 extreme economic ideologies.
And here it is. He's basically saying, look, I won't shut down a business just for being a little subpar, which would totally upset a pure capitalist like Adam Smith. But he's also saying, I won't endlessly fund a money pit, which would upset a pure collectivist like Karl Marx. He found his own more nuanced place right in the middle.
So his philosophy sits right between these 2 extremes. On one side, you have pure capital efficiency at all costs. On the other side, you have employment at any cost. And right there in the center is Buffett's hard-won wisdom: be humane and patient with businesses that are struggling, but don't be a fool. You don't throw good money after bad forever.
But the story doesn't end with a cool philosophical insight. Nope. There was also a brutal, practical business lesson that would go on to shape the entire future of Berkshire Hathaway. And this was a lesson he learned the hardest way possible.
After 20 years of trying everything, Buffett finally understood that the problem wasn't his management, it wasn't the workers, it wasn't even the machinery. The problem was the very nature of the textile business itself. He was playing a game that was rigged against him from the very start.
And the concept he identified was the commodity trap. Think about it. When your product is a commodity, like simple cotton fabric, you have no pricing power. You're always at the mercy of the market. It doesn't matter how brilliantly you manage the business. You just can't escape the fundamental, brutal economics of the industry. It's a trap.
So Buffett's first major investment was, by his own admission, a terrible mistake. He spent 2 decades on it with deeply disappointing results. But the lessons he learned about finding that middle ground and, crucially, about avoiding these commodity traps, they became the very foundation of the Berkshire Hathaway we know today. It really leaves you with a final thought, doesn't it? What is the true value of a mistake?
So, how does a company that's completely failing, trapped in a dying industry, suddenly become one of the most successful companies in the entire world? It's an amazing story, really. It's about failure, a moment of genius, and a pivot that literally changed everything. This is the story of Berkshire Hathaway's great pivot.
Okay, so let's set the scene. The year is 1985. July to be exact. And for the folks working at Berkshire Hathaway's textile mills, this was it, the end of the line. Not with a big bang, but, with a quiet sense of finality.
Think about that for a second. A business that had been around for 100 years, gone, officially dead, a total failure. So the big question is, how on earth does that moment of defeat become the launching pad for what Berkshire is today? To get that, you really have to understand the corner Warren Buffett had been backed into.
So, let's talk about this unwinnable game he was in. Buffett was basically playing chess against a computer that knew all his moves in advance. He just couldn't win. The American textile industry, man, it had become an absolute nightmare, and he was right smack in the middle of it.
So what was the problem exactly? Well, it really boils down to 2 huge things. First, you've got all this cheap foreign labor just flooding the market. It was completely squeezing their profits down to basically zero. And then, on top of that, just to even try to keep up, they had to pour tons and tons of money into new equipment. It was a classic good money after bad situation, a real trap.
And this right here shows you the impossible choice he was facing. It was a total catch-22. Look at it. If he reinvests, he's just throwing more cash into a pit for terrible returns. But if he doesn't reinvest, well, the mills just get even less competitive. No matter what he did, he couldn't beat the cheap foreign labor. It was a total dead end. There was no way out. Okay, but here's where the story takes a really surprising turn. While the main ship was sinking, there was this little lifeboat that had been launched years earlier, and it was just starting to show its worth. And this is the key. The textile business, even as it was failing, was still kicking off a little bit of cash, just enough. Now, the obvious move would have been to buy more machines, right? But Buffett didn't do that. No, he took that cash and bought something completely different, and that one decision, well, that would become the engine for everything else. So in March of '67, for about $8.5 million, Berkshire buys 2 insurance companies in Omaha, National Indemnity and National Fire and Marine. To most people, this was just a tiny, boring transaction that nobody even noticed. But that one move, that was the big bang. That was the start of the Berkshire Hathaway we all know today. So, we're moving on to the secret sauce here. See, buying an insurance company wasn't just about selling policies and collecting premiums. Not for Buffett. He saw something else, a powerful financial engine that was kind of hidden in plain sight right inside this super boring industry.
So what was it? What was this secret weapon he found? What did he see that everyone else was missing? Well, it all boils down to one simple but absolutely brilliant concept.
And here it is, the big secret, insurance float. Okay, think about it like this. You pay your car insurance premium every month, right? But hopefully you don't get into an accident for years. So what happens to all that money in the meantime? The insurance company gets to hold it? It's this huge pile of cash, your cash, that they get to invest for their own profit before they have to pay out any claims. It's basically a giant interest-free loan that never has to be paid back all at once. And this cycle is just genius when you think about it. Step 1, collect all those premiums. Step 2, that money sits there as this giant float. Step 3, and this is the magic part, a guy like Warren Buffett invests that float and makes even more money from it. And then, way down the line, you pay out the claims as they happen. It's an incredible, self-fueling machine for making money. So, what were the results of this new strategy? Were they any good? Good doesn't even begin to cover it. The results were absolutely staggering. This wasn't just a small change in direction, this was a complete reinvention of the company, right down to its DNA.
Yeah, check out this number. In 1967, the very same year they bought the insurance companies, the money they made just from investing the float was three times what the entire textile business made in 1 year. And this chart really just hammers the point home. Look at that tiny little bar for the textile profits. Now, look at the giant bar for the investment profits. It's not even a contest. And here's the craziest part. They did all that with only 1/10 of the money tied up in it. It was just so much more efficient. It was obvious this was the future.
So you might be thinking, hold on a second, isn't insurance just another boring commodity business like textiles? And you know what? You're not wrong. The products are pretty similar, but that's missing the secret weapon. The product might have been a commodity, but the business model was a gold mine because it came with that float. And when you put that investment vehicle in the hands of someone like Warren Buffett, well, that changes everything.
And of course, he didn't just stop there. He knew he had a winning formula, so he just kept running the same play. The whole JICO story is the perfect example. He saw another fantastic insurance company with another massive float, so he just patiently, slowly, built up his ownership over the years until, boom, JICO became part of the Berkshire family. And that just added billions and billions more to that investment engine.
So what's the big takeaway from all this? The story of Berkshire really shows us that the biggest opportunities aren't always about inventing the next cool gadget. Sometimes they're hidden in plain sight, inside some of the most boring businesses you can imagine. It's all about finding a better business model. And it kind of makes you wonder, right? What seemingly boring industry out there today has a hidden secret, just like insurance did? What are we all overlooking?
All right, let's talk about Warren Buffett. You know the name, right? The folksy charm, the Coke and hamburgers. But how on earth did this one man's very specific personality become the literal blueprint for Berkshire Hathaway, one of the most powerful and dominant companies in history? Today, we're going to deconstruct the man to really understand the machine.
And it all starts with the central paradox of Warren Buffett. You look at him, and what do you see? A friendly, kind of grandfatherly guy. It doesn't exactly scream titan of industry. But the reality? He's one of the most brilliant, most uncompromising financial minds ever. And that contrast right there is the key to absolutely everything. So to really get how this all works, we're going to follow the thread. First, we'll look at the Buffett enigma, the man himself. Then we'll see how his mind created the Berkshire blueprint. We'll explore the shockingly simple empire he built, unpack some of his smartest spies, and finally, we'll just stand back and look at the jaw-dropping results of his decades of dominance.
Okay, so let's dive right in. Who is the man behind this whole operation? Well, at his core, Buffett is driven by three things: an obsession with keeping things simple, a deep, deep respect for pure logic, and an almost allergic reaction to what he considers foolishness. You see, his entire approach to business is built on these personal traits. He's straightforward, he's brutally honest, and he actively runs away from anything complicated. Now, this isn't just a quirky preference, it's a core business strategy. And he wraps it all up in this mix of sophisticated dry wit and a little bit of cornball humor that makes his genius feel, well, accessible.
And you can see this philosophy perfectly in his legendary annual reports to shareholders. Forget about the glossy photos and the select charts you see everywhere else. Buffett delivers 60 to 70 pages of pure, dense information, financial wisdom, and just raw honesty. So, here's the crucial point. It all comes down to this incredible commitment to transparency. He doesn't see his shareholders as just names on a spreadsheet. He sees them as partners, as co-owners of the business. So he gives them the exact same level of detail and honesty that he'd want himself. And that, my friends, builds a foundation of unshakable trust.
Okay, so how does a personal philosophy of simplicity and honesty actually scale up to create one of the biggest companies on the planet? It sounds kind of like a paradox, doesn't it? But really, it's the very foundation of the entire Berkshire blueprint.
You have to understand that Berkshire Hathaway is Warren Buffett. The company's whole structure is a direct reflection of how he thinks. Yeah, it's massive and it's complex, sure, but and this is the key, it is not complicated. It's designed from the ground up to be understandable, even at its immense size. When you boil it all down, Berkshire Hathaway is really just two big buckets. That's it. First, you've got the operating businesses. These are the companies that Berkshire actually owns and runs every single day. And second, you've got the stock portfolio. These are the investments Berkshire makes in other companies. That is the entire blueprint. Simple, right? So let's peel back another layer and see the incredible empire this simple structure has actually built. We're talking about a collection of businesses that sells everything from lollipops to private jets, all living happily under one very logical roof.
Those operating businesses we just talked about, well, they're sorted into three main groups. First, you have the massive insurance operations, the engine of the whole thing. Then you have the regulated, capital-hungry businesses, like the BNSF Railroad and Mid-American Energy. And finally, you have this huge diverse collection of manufacturing, services, and retail companies.
And this, wow, this is where you really see the power of that structure in action. Just look at the growth over 25 years. The earnings from those businesses went from under $400 million to nearly $11 billion. And the stock portfolio? It exploded from $3 billion to almost $88 billion. I mean, come on, that engine works. But how did he fuel that engine? A huge part of the story is in his brilliant acquisitions, especially in insurance. See, insurance companies collect money from you, premiums, up front, but they only pay out claims later. That giant pool of money they hold in the meantime is called float, and for a guy like Buffett, it's basically a massive interest-free loan from the world that he can use to invest. And he made two gigantic moves in the insurance world back in the late 90s. First, he bought the rest of Geico in '96 for $2.3 billion. Then, just 2 years later, he made his biggest deal ever at the time, grabbing the reinsurance giant General Re for about $16 billion in Berkshire stock. Now, these were massive, company-defining deals for sure, but here's the crazy part. Neither of them was his single most valuable acquisition. So what was it? I mean, what could possibly be a smarter move than buying a cash-gushing machine like Geico?
It wasn't a company at all. It was a person. Back in 1985, Buffett hired a man named Ajit Jain. And get this, the guy had absolutely zero prior experience in insurance. He was a brilliant engineer with a Harvard MBA. And that's what Buffett saw.
Buffett's belief in Ajit Jain is so absolute that he actually wrote this incredible instruction to his shareholders. Just let that sink in for a second. This isn't just high praise. It's Buffett telling the world that Jain's value is almost incalculable. This is the man who built the reinsurance group's float to $34 billion by taking on risks no one else on Earth would touch.
So, what happens when you combine this unique philosophy, this incredibly simple structure, and these brilliant people, and you just let it cook for decades? Well, the results are, frankly, undeniable. Let's look at the numbers. Okay, let's start at the very beginning. When Warren Buffett took control of this failing old textile mill called Berkshire Hathaway way back in 1965, its book value per share was just $19. Got that? $19. Okay, so over the next 48 years, by applying all these principles we've talked about, he grew that single share's value from $19 to over $114,000. The transformation is so huge, it's almost hard to wrap your head around it.
And this chart right here, this is the mic drop. From 1965 to 2012, Berkshire Hathaway delivered a compounded annual gain of nearly 20%. Over that same time, the S&P 500, the benchmark for the entire stock market, came in at about 9.5%. So it's not just that he beat the market, he more than doubled its return, year after year, for almost half a century.
That difference, that 10.3% edge, that's everything. You know, to sustain that kind of outperformance for a year or two is amazing. To do it for nearly 50 years, that is a level of sustained dominance that is pretty much unmatched in the history of modern finance.
So, when you look at it all, in a world that is just relentlessly chasing complexity, algorithms, and whatever the next hot thing is, Warren Buffett built a generational empire on simple, logical truths. And it leaves you with a pretty powerful question. What's a simple truth that you could build an empire on?
All right, let's dive into one of the biggest, most fascinating arguments in the entire world of finance. This is a real clash of the titans, a powerful academic theory versus the undeniable real-world track record of probably the most famous investor who's ever lived. So let's start with a question that gets right to the heart of it all. Is poring over charts and reports, doing all that homework on stocks, a total and complete waste of your time? It sounds crazy, right? But for decades, a really influential group of thinkers has argued that the answer is, believe it or not, yes. Okay, so let's first look at their side of the story. It's built around this compelling, if controversial, idea called the efficient market theory. And I gotta tell you, if you buy into this, it will completely flip how you think about the stock market. At its core, the theory is actually pretty simple to grasp. It says that the stock market is like this giant, super fast brain that processes information almost instantly. So by the time you hear about a company's amazing new product or read their incredible earnings report, it's too late. Millions of others have already heard it, and all of that good news is already baked into the stock's price. The party's over before you even got the invitation. And if you believe that basic idea, then these three things just have to be true. First, why would you waste your time analyzing stocks? The price already knows everything. Second, it means the price you see on your screen right now is the correct price. And third, and this is the big one, it means it's impossible for anyone to consistently beat the market average year after year. And this is where the theory gets really wild. This quote sums it up perfectly. It's basically saying that a highly paid financial analyst, with all their spreadsheets and deep dive research, has no better chance of picking a winning stock than a monkey throwing darts at a newspaper's stock page. It's all just random luck. And this really shows you the two completely different universes we're talking about. On one side, you've got the theorists saying it's all just random chance. On the other, you have the analysts who are convinced their hard work and skill gives them an edge. But according to the theory, nope. They both end up with the same results. It's all just a coin flip. So, that's a pretty powerful argument, right? It's logical. It makes a certain kind of sense. You'd think the debate would be over. Case closed. Trying to outsmart the market is a fool's game. But it's not over, not by a long shot, because the theory has one giant, glaring, multi-billion-dollar problem, and his name is Warren Buffett. And this is where the whole story takes a sharp turn, because this one guy, for his entire career, has been a living, breathing, walking contradiction to this elegant theory that so many smart people believe in. Think about it. If it's impossible to consistently beat the market, then how on earth do you explain Warren Buffett? We're not talking about someone who got lucky for a year or two. We're talking about someone who has done it for decades, through good times and bad, spectacularly outperforming everyone else. He's like the ultimate proof that the theory must have a hole in it somewhere. And his record is just, well, it's undeniable. Going all the way back to his early investment partnerships in the 50s, he was just crushing the averages. And then from 1965 on, what he's done with Berkshire Hathaway is nothing short of legendary. It's the kind of long-term success that the theory says flat out should not be possible. So this brings us to the obvious question, right? Does this one person's incredible success just completely blow up an entire field of financial theory? It kind of seems like it should. Well, you'd think so, but the people who champion the efficient market theory, they're not giving up that easily. They have a comeback. And it's a fascinating, mind-bending explanation that has nothing to do with finance and everything to do with pure, hard statistics. Their argument is this. They don't deny that Warren Buffett exists. They don't deny his success. Instead, they say he is simply what's known as a 5 sigma event. So here's the key to their whole argument. They aren't saying he isn't special. They're saying he's so ridiculously special that he's a statistical miracle. He's the exception that doesn't disprove the rule, because the odds of him even existing in the first place are almost zero. Now, to get what they're saying, you just need to know one thing about stats. This little symbol here is sigma, and all it means is standard deviation. Just think of it as one step away from the average. A 1 sigma event is pretty normal. A 2 sigma event, less common. 3 sigma is pretty rare. But a 5 sigma event, that is 5 of those huge steps away from the average. It is so far out on the edge of the probability curve that it's considered an extreme, almost unbelievable statistical fluke. Just how unbelievable are we talking? Well, the odds of a 5 sigma event happening purely by chance are about 1 in 3.5 million. Let that sink in. Their argument is that if you get millions and millions of investors all trying to beat the market for decades, eventually one of them, just through pure dumb luck, is going to look like an absolute genius. But if that number is hard to wrap your head around, let's just flip it around and look at it from the other direction. This means there's a 99.99994% chance that any investor you pick is not a 5 sigma event. It's basically a statistical ghost. It's something so unbelievably rare that you could argue it shouldn't even happen at all. So there you have it. That's the comeback. Buffett's success doesn't prove the theory is wrong. It just proves that if you roll the dice enough times, even a 1 in a million shot will eventually come up. In their eyes, Warren Buffett isn't a brilliant investor. He's just the guy who happened to hold the winning lottery ticket. But there's a third way to look at this whole debate, a different verdict. And it comes from the man himself, the guy at the very center of this storm.
You know, Buffett himself just kind of dismisses all this statistical miracle talk. He says, look, what I do isn't rocket science. It's not beyond anyone's ability. For him, it's not about being a 1 in a million anomaly. It's about having a rational, disciplined approach that, for whatever reason, most other people just don't follow. And that's what it all boils down to. It leaves us with this huge final question to think about. Is Warren Buffett really just a statistical fluke in a perfectly efficient world? Or is it possible that the market can be beaten, but only if you're willing to abandon the same old methods that everyone else is using, the very methods that almost guarantee you'll just get average results? The way you answer that, well, it changes everything.
So today, we're going to crack open the mind of a true Wall Street legend, the man who basically taught Warren Buffett everything he knows, who wrote the literal Bible on financial analysis and earned himself the title the Dean of Wall Street, Benjamin Graham.
You've probably heard this quote a million times, right? The first rule is don't lose. The second rule is don't forget the first rule. It sounds so simple it's almost a punchline. But trust me, behind those few words is a lifetime of wisdom, a philosophy that was forged in the fire of total financial ruin.
And that's the real question, isn't it? How do you get from don't lose money to an entire system for thinking about the market? Well, that's the story we're going to unpack today. How personal disaster and just a relentless pursuit of logic led Graham to build the very foundation of what we now call value investing.
Okay, so here's our roadmap. First, we'll get to know the man himself. Then we'll see how the absolute chaos of the Great Depression completely reshaped his thinking. From there, we'll break down his two most powerful ideas, the critical difference between investing and speculating, and his brilliant concept of a margin of safety. And finally, we'll see how it all comes together in those two famous rules. So who was this guy, Benjamin Graham? Well, he wasn't your typical Wall Street shark, not at all. He was a scholar, a man who loved philosophy, who could read Greek and Latin fluently, and who somehow found himself right in the chaotic heart of the financial world.
I mean, just look at this timeline. The speed of his rise is, well, it's just staggering. In 1914, he's a 20-year-old kid, fresh out of Columbia, literally writing stock prices on a chalkboard for $12 a week. And just 5 years later, he's a partner in the firm. This wasn't some slow, steady climb. It was an absolute rocket ship, and it was fueled by pure brainpower.
So, by the late 1920s, Graham is pretty much on top of the world. He was the poster child for Wall Street success. And then it all came crashing down. For him, the 1929 crash wasn't just some historical event you read about in a textbook. It was a personal financial apocalypse that would change everything about his life's work.
And to really get a sense of just how high he flew, check this out. That $600,000 salary he was pulling in when he was only 25 years old, that's the equivalent of nearly $8 million today. He was fabulously wealthy before most of us have even figured out our careers.
And then this. In 1929, he was financially ruined. The crash didn't just sting him, it completely wiped him out. For the second time in his life, he was facing absolute ruin. And that incredibly painful experience forced him to question every single thing he thought he knew about how the market worked.
So, what do you do when that happens? Well, Graham took refuge in the one place he truly felt at home, his old university, Columbia. Teaching gave him the space to just step back, to think, and to systematically figure out what had gone so horribly wrong. And it was right there, from the ashes of his own financial disaster, that he and David Dodd created the principles that would become the absolute Bible of investing, the legendary book, Security Analysis.
The first, most basic problem Graham decided to tackle was this. He realized that a huge part of the mess leading up to the crash was that nobody even agreed on what the word investment actually meant. It was just a word people threw around so loosely that it was basically meaningless. So his first order of business was to draw a sharp, clear line in the sand.
And this is what he came up with. Now, it sounds a little dense, but every single word here matters. He is creating a crystal clear distinction. If what you are doing doesn't meet these three specific criteria, then in Graham's world, you are not investing. You, my friend, are speculating. So let's break down what he meant by each of these things.
Okay, so let's start with thorough analysis. What does that even mean? For Graham, it wasn't about a quick look at a stock chart or reading a couple of headlines. No way. It was this super rigorous three-step intellectual process. First, you do your homework. You gather all the facts you can find. Second, you put on your skeptic's hat. You critically ask if those facts are even being presented fairly. And only then, after all that work, do you get to make a judgment on whether it's a good buy or not. And this really just lays it all out, side by side. An investor does the hard work of analysis. Their top priority is protecting their initial capital, and they're looking for a satisfactory return, not necessarily a home run. A speculator, on the other hand, they're chasing a quick profit, often with borrowed money, and they pretty much skip all that boring analysis. For Graham, it really all comes down to your intention and your process.
Okay, so now that he defined what an investment is, Graham needed a way to actually do it. He needed a defense mechanism, an antidote to the kind of wild, crazy optimism that had fueled the 1929 crash in the first place. And the tool he came up with was his single most important contribution to finance, the concept of the margin of safety.
And the idea itself is it's so beautifully simple. First, you do the work to figure out what a business is really worth. Then, you just refuse to pay that price. You only buy when you can get it for way, way less. That gap, that discount, that's your margin of safety. It's your cushion against bad luck, bad timing, or, just the simple fact that you might be wrong.
But right, a margin of safety doesn't mean anything unless you know what you're getting a discount from. And that leads us to his other huge idea, intrinsic value. Graham's big insight here was that a company's true worth has pretty much nothing to do with its day-to-day stock price. No, its real value is determined by the cold, hard facts of the business itself.
So how in the world do you calculate something like that? Well, Graham gave us a pretty simple two-step framework. First, try to estimate what a company is going to earn in the future. Second, apply a reasonable multiplier to that number. But, and this is a huge but, he was the first person to tell you that trying to predict the future is basically impossible. We are always going to be a little bit wrong. And that is precisely why the margin of safety isn't just a nice idea, it's absolutely essential. Graham was also really big on this distinction between two types of information. On one side, you've got the quantitative stuff, the hard numbers you can actually prove, like assets and earnings. On the other side, you've got the qualitative stuff, the stories, the hype, the talk about visionary CEOs and disruptive technologies. Graham was deeply, deeply skeptical of all that qualitative talk, believing that if you can't measure it, you're probably just making it up. And this quote right here is his big warning about what happens when people get completely swept up in those qualitative stories. They fall in love with the narrative, they bid the price up to these insane levels that have no connection to reality, and they create a bubble. And as he knew from painful first-hand experience, all bubbles, eventually, have to burst. All right, so let's tie all of this together now. We've talked about the man, the crash, the big ideas. Now let's see how he boiled this entire philosophy down into a couple of simple, practical rules that pretty much any investor can follow. And here we are, right back where we started. But this time when you hear this quote, it's not just some clever phrase, is it? It's the grand finale of a lifetime of experience. It's a philosophy built on rigorous analysis and designed to protect you from the market's craziness and, maybe more importantly, from your own worst instincts. And this is how he actually put that don't lose idea into practice. He gave people two very real, tangible guidelines to follow. The first one is pretty extreme. Buy a company for less than 2/3 of just its net current assets. That means you're basically getting the rest of the entire business for free. The second is more common today. Look for companies with low price-to-earnings ratios, as long as they also have a solid balance sheet. See? Both of these are designed with one goal in mind, to force you to have a margin of safety. And that really leaves us with one final big question, doesn't it? In today's world of meme stocks, crypto, and high-speed trading, is Graham's whole patient, careful approach just outdated? Or, in a market that feels more like a casino than ever, is his disciplined focus on just not losing money maybe the most timeless and essential piece of wisdom there is? When you think about investing, that old saying, buy low, sell high, is probably the first thing that comes to mind, right? The whole idea of sniffing out cheap, undervalued stocks. But what if there's another way? A philosophy that's just as powerful, but it's not about buying what's cheap. It's about buying what's great, and then holding on for a really, really long time. Today, we're going to dive into the mind behind that very idea, the brilliant Philip Fisher. Okay, so to really get a handle on Fisher, it helps to put him side by side with another giant, Benjamin Graham. Now, Graham's whole world was built on the idea that the market makes mistakes. He believed fear and greed make people do irrational things, so stocks get mispriced. His game was to find those bargains and just wait for the price to snap back to its real value. Fisher, well, he was playing a completely different sport. He wasn't looking for market errors, he was looking for pure excellence. His goal was to find those few truly outstanding companies and basically partner up with them for the long haul.
All right, here's our game plan. We're going to look at what made Fisher such a unique thinker, see how his ideas were really born out of the Great Depression, and then we'll get into the nitty-gritty of what makes a great business and great management. And then we'll get to his secret weapon, the scuttlebutt method, before we wrap up with his legacy. To really get Fisher, you have to understand where he came from. I mean, his philosophy wasn't dreamed up during some roaring bull market. Nope, it was forged in the fire of the biggest financial crisis we've ever seen. And that experience taught him to value resilience and quality above pretty much everything else.
Okay, just look at this timeline for a second, because that last point is kind of nuts. After getting his degree and watching the 1929 crash happen right in front of him as a bank analyst, Fisher does the one thing nobody would expect. In 1931, with the market in absolute shambles, he starts his own investment firm. He actually saw an opportunity. He figured, first, any investor still standing was probably furious with their old broker, and second, with business so slow, top executives actually had time to sit down and talk to him.
And this quote, this right here, is the origin story for his entire method. Back at Stanford, one of his professors would take him on these weekly trips to local businesses, not just to look around, but to actually talk with the managers about how things worked. That experience, that direct, on-the-ground conversation, instead of just reading some dry report, that became the bedrock of his whole approach to investing.
So this all brings us to the absolute core of his philosophy. Everything he did, every decision, came back to this simple two-part belief. It wasn't enough for a company to just be in a cool, growing industry. No, it had to have both massive potential and be run by the absolute best people. For Fisher, these two things, the business itself and the people running it, were totally inseparable. So, let's break that down, starting with the first pillar, the anatomy of a truly great business. What was Fisher actually looking for? What were the telltale signs that a company was worth owning?
Fisher basically saw two main ways a company could hit that spectacular long-term growth. The first he called fortunate and able. Think of a company like Alcoa. They were definitely able, a great company, but they were also incredibly fortunate to be in the right place at the right time to cash in on a huge external trend, like the explosion of the aviation industry. But the second type, the one he thought was even more powerful, was fortunate because they are able. This was a company like DuPont. They didn't just ride a wave, they created the whole darn wave themselves through constant R&D, inventing entirely new markets with products like nylon.
Now, to find these gems, Fisher had a pretty serious checklist. He wanted to see sales growth that was consistently crushing the industry average. He insisted on a deep, long-term commitment to research and development. He also knew that even the best products in the world are useless if you can't sell them. So he looked for a top-notch sales team that acted like a bridge between the customer and the lab. And, critically, he demanded high profit margins and super tight cost controls.
And this right here was a huge deal for Fisher. He was absolutely adamant about this. Just growing revenue for the sake of it, that meant nothing to him. It was a vanity metric. For a company to be a real investment, that growth at the top had to find its way down to the bottom line, to profit growth over the long run. End of story. So why the obsession with high profit margins? Well, it's pretty simple, actually. It meant the company could become its own self-funding growth engine. If you're generating enough cash from your own business, you can pay for your own expansion. And that is so important because it means you don't have to sell new shares of stock, which waters down the ownership stake for everyone who already owns a piece of the company. But you see, a brilliant business model was only half the equation for Fisher. Let's move on to that second pillar, which he believed was every bit as important: the actual character and skill of the management team. Fisher wasn't just looking for someone who was good with numbers. He was looking for real leaders. He demanded they have a long-range vision, a willingness to sacrifice a little profit today for a much bigger payoff down the road. He required, and this is key, unquestionable integrity. He believed a company had to be a good place to work for everybody, from the front lines to the C-suite. And finally, he wanted to see a deep bench of talent, not just a one-man show. So this brings up a pretty big question, doesn't it?
I mean, you can probably figure out if a company has a long-range outlook or a deep bench of talent. But how on earth, as an outsider, do you measure something as, well, as fuzzy as integrity?
Well, Fisher's method for this was just so simple and so brilliant. First, you just watch how the managers talk when things are going great. They're usually more than happy to chat your ear off. But the real test, the moment of truth, is step 2. Watch them when something unexpected goes wrong. Do they suddenly go quiet and hide, or are they open and honest about the problems? For Fisher, that single reaction told you everything you needed to know about their character.
Okay, so you've got a checklist for the business, you've got a test for the management, but how do you actually gather all this info? This brings us to Fisher's most famous and maybe his most important contribution to investing.
He called it scuttlebutt, and it's basically what it sounds like. It's hitting the business grapevine hard. The idea is to go way beyond the official press releases and actually talk to a whole network of people who know the company inside and out. We're talking customers, suppliers, researchers, and yeah, even their competitors and people who used to work there.
And this quote right here tells you exactly why he did it. Fisher argued that the annual report, all the financial statements, they only tell you part of the story. The real story, the clues about a company's competitive advantages, where it really stands in its industry, that stuff can only be found by getting out there and talking to people.
Now, let's be clear, scuttlebutt isn't just about collecting random gossip. It's a focused, targeted investigation. The whole point is to piece together this mosaic of different viewpoints to figure out what, if anything, makes this one company truly better than its rivals. It's basically detective work, but for investors.
So when you put it all together, the intense focus on great businesses run by great people and all that detective work of scuttlebutt, you start to see the shape of this really powerful and frankly, timeless philosophy. So let's talk about what that legacy means for all of us today.
When you boil it all down, this is what Philip Fisher was all about. It's this intense, qualitative hunt for the truly exceptional companies, and then having the discipline and the patience to stick with them for decades, just letting their greatness do its work and compound over time.
So what are the big takeaways here? First, focus on the qualitative stuff. The people, the products, the competitive position, not just the numbers on a spreadsheet. Second, always remember you're not just investing in a business, you're investing in its leadership. Third, do the hard work yourself. Do that deep investigative research. And finally, and this might be the most important one, change your time frame. Think in decades, not quarters.
And that leaves us with one last big thought to chew on. We live in a world that is just flooded with data, with algorithms, with instant information. In an age where everybody has access to the exact same numbers at the exact same second, could it be that Fisher's very human, on-the-ground scuttlebutt method isn't some outdated relic, but is actually more valuable now than it has ever been?
Okay, so everyone knows Warren Buffett, right? The Oracle of Omaha. But what about the guy who was, for decades, his right-hand man, his alter ego, the one who actually convinced Buffett to completely change how he invested? Well, that's the story we're diving into today, the story of Charlie Munger, the partner who changed everything. So get this. Picture a young Warren Buffett. He's pitching an investor, a guy named Dr. Edwin Davis, trying to get $100 grand. And right in the middle of the pitch, Dr. Davis just stops him, says yes on the spot. And the reason he gave, it was because Buffett reminded him of someone he'd never even met, a guy named Charlie Munger. I mean, can you believe that? That single moment of trust, all based on a reputation, that was the very beginning of one of the greatest partnerships in business history. So what made Munger tick? What gave him this unique way of looking at things? Well, to really get it, we need to rewind a bit and look at another big idea that was floating around back then. It came from an investor named Philip Fisher, and let me tell you, his approach went way, way beyond just looking at the numbers on a balance sheet. The core of Fisher's idea was this concept he called scuttlebutt. Yeah, scuttlebutt. And it's basically what it sounds like. It's like being a detective. It wasn't about sitting in some stuffy office, crunching numbers. No way. It was about getting out there, hitting the pavement, and talking to actual people to get the full story, the 360-degree view of a business. And what's really fascinating here is just how deep his investigations went. I mean, he talked to everybody, customers, vendors, even former employees. But you know what his secret weapon was? His most surprising source? The competition. Fisher figured out that while a CEO might not tell you their own company's secrets, they were more than happy to spill the beans on what their rivals were doing right and what they were doing wrong.
Now, as you can imagine, this kind of detective work took a ton of time, and that led Fisher to a really powerful conclusion. He realized it was much better to own just a few absolutely outstanding companies that he knew inside and out instead of owning a whole bunch of average ones. I mean, think about it. His portfolio often had fewer than 10 stocks, and get this, just 3 or 4 of them would make up like 75% of his entire investment.
So this whole idea, this philosophy of deep understanding and focusing your bets, it was kind of in the air. And that brings us right back to Omaha, Nebraska. In 1959, Dr. Davis, remember him? The guy who invested in Buffett because he reminded him of Munger? Well, he decided it was finally time for these two brilliant guys to actually meet. He set up a dinner, and yeah, you guessed it, the rest is history. But, their legendary partnership didn't just explode into being overnight. It took time. First, at Buffett's urging, Munger, who was actually a really successful lawyer out in LA, started his own investment partnership in 1962. It took until 1978 for him to officially become the vice chairman of Berkshire Hathaway. But over all those years, their working relationship just grew and evolved into this incredibly close, almost symbiotic thing. And you can see just how deep their connection was in the way Buffett talks. Seriously, if you ever read his letters to shareholders, you'll see this phrase over and over again. Charlie and I. Charlie and I did this. Charlie and I think that. It's almost like he's talking about a single person with two brains. That's how intertwined their thinking really was. So what was it about Charlie Munger? What did he bring to the table that was so special? I'll tell you. It was a lot more than just being smart with money or being a good lawyer. He brought a fundamentally different way of looking at the entire world. He had this term for it, worldly wisdom. And his big idea, his core belief, was that if you want to make really great decisions, you can't be a one-trick pony. You can't just be an expert in one little thing. No, you had to build what he called a latticework of mental models. Basically, you take the big, powerful ideas from all the different fields of study and you weave them together in your head. And, he pulled these ideas from everywhere. He was obsessed with psychology, right? All the little biases that trick our brains. He looked at physics, things like critical mass, history with all its lessons. He'd take a concept from, say, engineering, like redundancy, having a backup system, and he'd apply it to a company's finances to see how safe it was. He used this massive toolkit of ideas for every single problem he faced, especially when it came to investing. Okay, so this broad, multidisciplinary way of thinking, it led Munger to an investment style that was, well, really different from how Buffett started out. You have to remember, Buffett was a die-hard follower of his mentor, Ben Graham, and Graham's whole thing was buying stocks at rock-bottom bargain basement prices. But Munger, with his much wider view of the world, was about to challenge that core foundational belief. And this right here, this really sums up the whole philosophical shift perfectly. The Ben Graham way, that was about finding a fair company, a decent business, and buying it for a great price. It was the classic cigar butt investing, finding a discarded stock with one last puff left in it. But Munger, taking a page from guys like Philip Fisher, he argued for the exact opposite. He said it's way, way better to buy a great company at a fair price. And that was the big idea he had to sell to Buffett. So, the big question is, how did he do it? How did Munger finally get Buffett to change his mind, to cross that line, away from pure deep value investing? Well, it wasn't just a theoretical debate. It all came down to a real-world test, an acquisition that would become legendary, a little company called See's Candies. Now, See's Candies was not some fancy, high-tech startup, not at all. It had the most humble beginnings you can imagine. We're talking 1921. A 71-year-old grandmother named Mary C. opens up a little neighborhood candy shop in LA, and she's selling chocolates made from her own personal recipes. Just a simple family business, built from the ground up. And that date, 1921, is so important here, because by the time Buffett and Munger were looking at this company, it had a real history. It had proven it could survive anything. It went through the Great Depression, sugar rationing in World War II, not to mention decades of competitors trying to knock it off. This was no flash in the pan. This was a business with deep, deep roots. So what was the secret sauce? What made it a great company in Charlie Munger's mind? It all came down to one simple, unchanging rule that Mary C's put in place on day one: you never, ever, ever compromise on quality. And that relentless focus created a level of customer loyalty and brand power that you just couldn't copy.
But here was the problem. The price tag for C's was way higher than what a traditional Ben Graham analysis would say it was worth. It just wasn't a statistical bargain. But Munger, he really pushed Buffett. He made him see the huge intangible value that wasn't on the balance sheet. The brand, the ability to raise prices, that uncompromising quality. And that deal, that single acquisition, was the first big step that started to transform Berkshire Hathaway from just a pile of cheap assets into a collection of truly great businesses. And all of this brings us to a final, really big question. The lesson from Munger, from Buffett, and from a little candy shop started by a 71-year-old grandma, it's a profound one. It forces us all to ask, what is the real price of uncompromising quality? And maybe more importantly, how on earth do you put a number on a business that people are going to love for generations to come?
When you hear the name Warren Buffett, you probably think value investing, right? The whole idea is buying stocks for way less than they're actually worth. So here's the puzzle. How in the world did he end up owning massive stakes in companies like Coca-Cola? I mean, by his own mentor's rules, Coke was not cheap. It's a contradiction that actually tells the entire story of his evolution as an investor, and we're going to break it all down. So today, we're diving into the incredible story of how Warren Buffett's investment philosophy evolved. And trust me, this isn't just about stocks and spreadsheets. It's a fascinating look at how one of the greatest financial minds of all time learned, adapted, and brilliantly mashed up completely different ideas to create a strategy that literally changed investing forever. All right, here's our game plan. We'll start at the very beginning with the gospel of his mentor, Benjamin Graham. Then we're going to look at the huge turning point, a candy company of all things. After that, we'll explore the ideas of Phil Fisher, see how Buffett blended these two masters together, and finally, look at how he put it all into practice.
Okay, so to really get Buffett, you have to start with Benjamin Graham. And I'm not kidding. This isn't just some small detail in his life story. Graham's philosophy is the absolute bedrock of everything Buffett has ever done. Everything else is built right on top of this foundation.
And, their connection was incredibly deep. Buffett didn't just admire Graham, he practically worshipped him. He said Graham was the most influential person in his life besides his own dad. I mean, think about this. He even named his son Howard Graham Buffett. That tells you just how much weight Graham's ideas had for him.
So what was this gospel that Graham preached? Well, it all boils down to three simple words: margin of safety. It's a beautiful concept, really. It just means you only buy something when you can get it for a whole lot less than it's really worth. It's a built-in cushion against being wrong. For Buffett, this wasn't just a rule of thumb, it became the core of his entire thinking process.
And you gotta love how Buffett himself described Graham's method. He called it the cigar butt approach. It's kind of a gross image, but it's perfect. The idea is you're walking down the street and you find a soggy, discarded cigar butt. It's not a quality smoke, but hey, there's one free puff left in it. You're not looking for a great company, you're just looking for a statistically cheap one that has one last bit of profit you can wring out of it.
But here's where the brilliant student started to see a flaw in the master's plan. The problem with cigar butts is, well, they're cigar butts. They're usually pretty terrible businesses. And Buffett started to realize that if you hold a mediocre company for a long time, its lousy economics will just drag you down. And that led to one of his most famous quotes: "Time is the friend of the wonderful business, the enemy of the mediocre." That single idea would change everything for him.
And that brings us to the moment where the ground literally shifted under his feet. The year is 1971, and a simple candy company is about to cause a massive plate tectonic shift in how Warren Buffett saw the world.
So here's the setup. See's Candies, this amazing brand out on the West Coast with a super loyal following, is for sale. But here's the catch. The sellers wanted 3 times its book value, basically 3 times what all its assets were worth on paper. For a diehard Graham follower, this was complete heresy. It was way, way too expensive. But his partner, the legendary Charlie Munger, basically told him, forget Graham for a second. Sometimes you have to pay up for a truly great business. Buffett listened, offered $25 million, and they got the deal.
And Munger's quote here just gives you chills because you can feel the weight of the moment. It was the first time. Just think about that. This was a conscious decision to break from everything they knew. They weren't buying a cheap cigar butt anymore. For the very first time, they were paying a premium for quality. This was a huge deal. So how did this big, heretical bet turn out? Well, this number says it all. Just 10 years after buying C's for $25 million, Buffett got an offer to sell it for $125 million. That's 5 times what he paid. And you know what the craziest part is? He turned it down. The lesson was crystal clear.
Paying for quality isn't just okay, it's incredibly powerful. The door was now wide open to a totally new way of thinking.
Okay, so with the See's Candies deal proving that quality was a massive driver of returns, Buffett started to really dig into the ideas of another investing giant. This guy, Philip Fisher, basically gave him the roadmap for this new path he was on.
Now, you have to understand, Fisher wasn't just a slightly different version of Graham. He was pretty much the polar opposite. If Graham was all about the cold, hard numbers you could find in a financial report, Fisher was all about the things you couldn't find there.
Fisher had this amazing technique he called scuttlebutt. It basically means you have to be a detective for your investments. You don't just read the reports. You get out there and investigate every single part of the business. You talk to its customers, you talk to its competitors, you even talk to ex-employees. You figure out what really makes the company tick. And for Buffett, this idea of doing a deep, qualitative dive was a total game changer.
So what were some of Fisher's big ideas? Well, first, he said a company's future potential is way more important than what it earned in the past. Second, the quality of the people running the show is absolutely critical. And third, and this was radical, he said don't worry so much about diversification. He argued it's actually safer to own just a few companies you understand inside and out than to own 100 that you barely know anything about.
Okay, so now Buffett has these two powerful and totally opposite philosophies rattling around in his head. Graham is yelling, buy cheap, and Fisher is whispering, buy great. But the true, absolute genius of Warren Buffett wasn't choosing one over the other, it was figuring out how to blend them into something completely new.
And this just lays it out so clearly, right? You've got Team Graham over here, all numbers, all about the price, digging through paperwork to find cheap stocks, and then you've got Team Fisher over here, all about the story, the people, doing detective work to find great businesses. And there's Buffett, standing right in the middle, trying to connect these two worlds. And get this, back in 1969, just before that huge See's deal, Buffett actually put a number on it. He said he was 85% Benjamin Graham and only 15% Fisher. So at that point, he was still overwhelmingly a Graham guy. The Fisher ideas were there, but they were just simmering on the back burner.
And here's what that looks like visually. Back then, his thinking was almost all Graham, all about the cigar butt approach. That little sliver for Fisher, that was the idea of paying for quality. It was a tiny part of his brain, but boy, was that about to change.
Now let's fast forward to today. That balance has completely shifted. Now, Buffett never gave us a new percentage, but most people who study him would say it's much, much closer to a 50-50 split. He now has one foot planted firmly in Graham's world of price and discipline, and the other foot planted just as firmly in Fisher's world of quality and long-term potential.
So when you boil it all down, his complete philosophy really rests on three pillars, from three incredible people. From Graham, he kept the absolute foundation, always demand a margin of safety, and have the emotional discipline to not freak out when the market does. From Fisher, he got the toolkit, how to spot great businesses using that scuttlebutt method. And from his partner, Charlie Munger, he got the final pieces of the puzzle, the courage to actually pay up for quality, and a deep, deep understanding of human psychology. So we've seen all the ingredients, right? But knowing the ingredients doesn't make you a master chef. Buffett's true world-changing genius was in how he put it all together into one seamless, practical, and incredibly effective strategy.
And really, this is the key takeaway. Lots of people can read Graham's books. Lots of people can understand Fisher's ideas. What makes Buffett, well, Buffett, is his amazing ability to integrate them. He uses Graham's discipline to buy Fisher's great businesses, but only when Charlie Munger's wisdom tells him the price is fair for the quality he's getting. It's the synthesis, that's where the magic happens.
You know, we'll finish with this amazing thought from the philosopher René Descartes because it just nails the whole story of Buffett. Buffett didn't just collect a library of good ideas. His true legacy is that he applied them. He took these big, separate concepts and wove them together into a practical wisdom that works. And I guess that leaves us all with a pretty big question, doesn't it? It's not about how much we know, it's about what we actually do with what we know.
So, what's the real secret behind Warren Buffett's incredible success? I mean, what truly sets him apart from everyone else? Well, it's not some crazy complex algorithm, and it's definitely not about chasing the latest market fad. It's a philosophy built on buying pieces of actual businesses. And it all boils down to this really clear, disciplined framework of 12 core principles. Let's dive in and break it down. It really all starts with this one single, powerful idea.
You see, while most of us are looking at ticker symbols, charts, and all those daily price swings, Buffett sees something totally different. For him, a stock is just, well, it's an abstraction. It's a piece of paper. It's not the real thing.
So, okay, if he's not investing in stocks, what is he actually buying? He's buying businesses, actual companies, with real revenues, real expenses, and real people on management teams. And just that simple shift in perspective, it changes absolutely everything.
All right, so here's our game plan for this explainer. First, we're going to look at the big picture, the Buffett philosophy. Then, we'll zoom in on his 3 core business tenets. After that, we'll explore his rules for management, money, and the market. Then we get to the fun part, building an economic moat, and we'll wrap it all up with the 30-year mindset that holds it all together.
Buffett's entire approach isn't just some gut feeling. It is a super disciplined framework, and it's built on 12 distinct tenets. You can almost think of these as a checklist he runs through before he even thinks about making an investment. And these are the exact same principles he uses to run his own company, Berkshire Hathaway.
Now, what's really interesting is how he organizes his thinking. These 12 tenets, they fall neatly into 4 buckets: business, management, financial, and market. But look at this. A full quarter of his entire focus is on the business itself. And that right there is our foundational starting point.
These 3 tenets, this is really the heart of the matter. Before he even thinks about the managers or the financials or the stock price, Buffett has to be able to say yes to 3 fundamental questions about the business itself. Okay, first and foremost, can he understand it? And this isn't about trying to be the smartest person in the room. In fact, it's the exact opposite. It's about honesty. It's about having the intellectual humility to admit what you don't know. And here's why that is so critical. Buffett truly believes that your financial success is directly tied to how well you actually understand what you own. Think about it. If you don't really get how a company makes its money, how can you possibly interpret news or industry changes correctly? You can't. This whole idea forces you to be brutally realistic about the limits of your own knowledge. And this quote just nails it. This is his famous circle of competence idea. Listen to this. Invest in your circle of competence. It's not how big the circle is that counts, it's how well you define the parameters. The goal isn't to know everything about everything. Nope. The goal is to know exactly where the edge of your knowledge is, and then to stay firmly inside of it. All right, let's build on that with the second business tenet. So once he understands a business, the next thing Buffett looks for is a proven, stable track record. He is not at all interested in dramatic stories of change or some high-flying revolution. And this really shows you this stark contrast in thinking. Most investors, they get really excited by fast-changing industries or these companies trying to pull off some dramatic turnaround. Buffett, he runs the other way. He knows that old saying, turnarounds seldom turn. He would much rather own a company that has been successfully and maybe even boringly producing the same simple product for decades. I absolutely love this quote because it's just so practical. For Buffett, investing isn't about solving the hardest puzzles or trying to clear 7-foot hurdles. It's about finding the easy 1-foot hurdles that you can confidently step over again and again and again. Okay, so the third and final business tenet shifts our view from the past to the future. A simple business with a consistent history, that's great. But does it have a bright future? Is this a business that's still going to be thriving in 10, 20, or even 30 years from now? And to answer that question, Buffett looks for something he calls a franchise. Now, this is his special term for a truly great business, and it has 3 specific characteristics. First, it sells a product or a service that people consistently need or desire. Second, there's no easy substitute for it. And third, its prices aren't regulated by the government. When you get that combination, man, that gives a company incredible power. So once a business passes those first 3 critical tests, it's simple, it's consistent, and it's got a great future. Then, and only then, does Buffett finally move on to the supporting pillars, the quality of the management, the strength of the financials, and finally, the price of the company in the market. And this table gives us a fantastic overview of those other 9 tenets. So let's actually unpack what we're seeing here. For management, he's not just looking for smart people. He wants to know, is the management team rational with how they spend the company's money? Are they candid and honest with shareholders, especially about mistakes? And do they resist what he calls the institutional imperative, which is basically the tendency for CEOs to just mindlessly copy what their competitors are doing? Then you get to the financials, and he digs deep. He wants a consistently high return on equity, or ROE. He calculates something he calls owner earnings to get to the real cash flow. He wants to see high, steady profit margins, and this is a big one. For every dollar the company keeps, does it create at least one new dollar in market value? That's the ultimate test. And finally, the market tenets. It really all boils down to two simple but profound questions. What is this business actually worth, and can I buy it today at a big discount to that worth?
So, when all of these tenets come together, you've got a great business run by great managers with strong financials at a great price. They create something incredibly powerful, something Buffett famously calls an economic moat. And this is the ultimate goal of his entire analysis. So, how exactly does this work? Well, remember that definition of a franchise. When you have a product people need and there's no close substitute for it, that gives you pricing flexibility. It means you can raise your prices without losing all your customers. And that pricing power, that is the water that fills the economic moat, protecting your business, your castle, from all the competitors trying to break in. And you just cannot talk about moats without this classic, almost cinematic quote from Buffett himself. He said, "What I love, of course, is a big castle and a big moat with piranhas and crocodiles." It just perfectly captures the idea, doesn't it? He's looking for a wonderful business, that's the castle, protected by a wide, durable, competitive advantage, that's the moat, and one that is so strong it's like it's filled with piranhas and crocodiles.
And this brings us to the final and maybe the most crucial element that underpins this entire philosophy. It's not about what a company's going to do next quarter or even next year. The timescale we're talking about here is much, much longer. For Buffett, the true definition of a great company is one that will still be great in 25 to 30 years. That's the test. That's the filter. It just cuts out all the fads, all the trends, all the short-term noise, and it forces you to focus only on businesses with real, enduring advantages. So let's recap the big ideas here. First, invest only in simple businesses you can genuinely, truly understand. Second, look for companies with long, consistent, and maybe even kind of boring operating histories. Third, find out what gives that business a durable competitive advantage, its economic moat. And finally, learn to think in decades, not in quarters. And that brings us to our final question for you. Because this framework, it isn't just for stocks, right? It's a way of thinking about durability and competitive advantage in a much wider sense. So as you go about your day, think about this. What is the most important moat? The unique skill, the knowledge, the reputation that you can build to protect your own future.
Welcome to The Explainer. Now, when you hear the name Warren Buffett, your mind probably jumps to his legendary investment picks, right? But what if I told you his real genius isn't just in picking the right companies, but in picking the right people? Today, we're unlocking how Buffett analyzes the folks running the show, a skill he believes is way more important than any spreadsheet.
All right, so first let's set a baseline. Buffett basically sees the business world in two big buckets. You've got your good businesses, the ones with a unique product or real edge, and then you have the bad businesses, the ones selling a commodity where you're just fighting on price. Think about airlines or a basic steel company. But here's the kicker. Even a great business isn't a guaranteed win. It can still be a horrible investment, and it all boils down to one crucial, often overlooked factor. So, what is this hidden factor that can make or break an otherwise amazing company? Well, it's not some secret financial ratio or a hidden asset on the books. For Buffett, the answer is actually really simple, and it's profound. It's the people in the C-suite. The quality, the character of the management team, that is the ultimate game changer.
Okay, so here's our game plan for this explainer. We're going to start by looking beyond the numbers to really get the core traits Buffett is after. Then we'll dive deep into his 3 critical tests for any management team. Are they rational? Are they honest? And can they fight the urge to just follow the herd? And finally, I'll show you a simple way you can start using this kind of analysis yourself.
You know, Buffett has this simple rule he lives by. We've never succeeded in making good deals with a bad person. It's not just about how smart they are, it's about their character. He truly believes you should only get into business with managers you can genuinely look up to and trust, and he boils it all down to 3 essential qualities. So just think of these 3 questions as the absolute bedrock of Buffett's entire management analysis. He's not looking for a fancy resume or the highest IQ. Nope. He's looking for leaders who think and act like they own the place, who are brutally honest with the actual owners, and who have the courage to say no when everyone else is screaming yes.
All right, let's dig into the first and, according to Buffett, the single most important test of a management team. It all comes down to one decision they have to make over and over again, a decision that will either build massive wealth for shareholders or slowly, quietly destroy it.
And that critical decision is all about capital allocation. I mean, think about it. Once a company pays its bills and covers its costs, what does it do with the profit left over? This question becomes especially important for successful, mature companies that aren't growing like weeds anymore.
So picture this. A mature company is just swimming in cash. What do? Well, they've got a few choices. First, they can just kind of ignore the problem and keep plowing that money back into the business, even if the returns are pretty lame. Or, second, they can get tempted to buy growth by acquiring some other company, often paying way too much. Or they can do the simple, rational thing. Give the money back to the people who actually own the company, the shareholders.
And look, Buffett's logic here is just dead simple, but it's incredibly powerful. If you can't find a way to earn a great return on a dollar, you have no business keeping that dollar. Give it back to the owners so they can invest it somewhere better. It's a really basic concept, but you would be shocked at how many managers get this completely wrong.
Now, when a manager does make that rational choice to return the cash, they've really got two main tools they can use. They can pay out dividends, which is just straight cash in shareholders' pockets, or the company can buy back its own stock on the open market.
And this is where a rational stock buyback can be pure magic. Because if a company's stock is trading for less than it's actually worth, every single dollar they spend buying back their own shares immediately creates more value for all the shareholders who stick around. It's a huge sign that management is truly working for the owners.
All right, let's move on to key number 2, candor. For Buffett, honesty isn't just the best policy, it's the only policy. He has a massive amount of respect for managers who are completely, totally honest with their shareholders, especially when the news is bad. This isn't just about not lying, it's about a deep commitment to transparency.
Buffett thinks an annual report shouldn't be a glossy marketing document. It has one job: to tell the owners what they actually need to know. It should give any reasonably smart person the tools to figure out roughly what the business is worth, what the risks are, and whether the people in charge are doing a good job or not.
And you know what? Buffett absolutely practices what he preaches. In his own famous Berkshire Hathaway annual reports, he has a section where he lays out his own mistakes and blunders for the whole world to see. It's an incredible display of humility, and it's how he's built up decades of trust with his shareholders.
This quote really gets to the heart of why candor is so vital. It's not just about being straight with other people. Buffett's big fear is that the CEO who spins a rosy story to the public eventually starts believing his own hype, and that is when truly terrible decisions get made.
Let's get to the final key. And honestly, this one might be the most insightful of them all. It's a strange, invisible force that Buffett said was one of the most surprising discoveries of his entire career. Something that makes really smart, experienced people do totally irrational things.
He calls this powerful force the institutional imperative. The best way to think about it is like corporate peer pressure, but on a massive, almost unstoppable scale. It's this weird lemming-like urge for managers to just copy what all their competitors are doing, even if it makes absolutely no sense, just because, well, everyone else is doing it.
And this imperative, it creates this kind of corporate insanity machine. It leads to these predictable, destructive habits. The company just keeps doing what it's always done, resisting any real change. New projects magically appear out of nowhere just to use up all the available cash. If the leader has some crazy idea, like a terrible acquisition, an army of consultants will produce studies to prove it's a genius move. And in the end, companies just mindlessly copy each other, sometimes right off a cliff.
But Buffett saw a hero who fought back against this. He loved to tell the story of a guy named Jack Ringwald. When the entire insurance industry was writing policies at prices that were guaranteed to lose money, Ringwald had the courage to just stop. He just walked away from the herd, proving that just because everyone is doing it doesn't make it right.
So what fuels this bizarre behavior? Well, Buffett says it boils down to some pretty basic human stuff. You've got the CEO who just has to be doing something big, like a huge takeover. You've got the endless scoreboard watching against their peers on sales, on profits, on their own paycheck. And, of course, you've got simple, old-fashioned ego, the belief that you're the one who can make a dumb deal smart.
And if you think being brilliant protects you from this, think again. Buffett once pointed to a list of 37 failed banking firms, all run by people with off-the-charts IQs. Why did they all fail?
His answer was simple: mindless imitation of their peers. Being smart is no defense at all.
Okay, so this is all great in theory, right? But how can you actually use this framework? How do you look past the slick PowerPoint presentations and really measure these qualities for yourself? Well, Buffett actually gives us a pretty clear method.
Here's your 3-step toolkit. It's not complicated, but it does mean you have to roll up your sleeves and do a little digging. First, go back and read annual reports from a few years ago. Second, compare what management said they were going to do back then with what actually happened. And third, read their reports side by side with their competitors. Are they being honest and original, or are they just repeating the same old industry jargon? This process tells you a lot about the character in the corner office.
And that really brings us to the final big question I want to leave you with. Think about the companies you admire, the ones you follow. How many of their leaders would actually pass these 3 simple tests: rationality, candor, and the courage to be independent? Applying this filter doesn't just make you a smarter investor, it makes you a much, much sharper observer of how the business world really works.
You know, have you ever wondered what it would be like to look at a company and see what Warren Buffett sees? Well, that's exactly what we're going to do today. We're going to break down the 4-part mental model he uses to find what he calls wonderful businesses. And trust me, this is so much more than just picking stocks. It's really a masterclass in figuring out what makes a business genuinely great. So let's dive right in. Okay, let's start with this quote because, honestly, it tells you almost everything you need to know about how Buffett thinks. He's basically saying, look, you could have the most brilliant manager in the world, but if you put them in charge of a terrible business, the business is going to win every single time. It's the economics of the business itself that matter most. And that idea, that's the key to everything else we're going to talk about. So here's our game plan for building out this mental model. First up, we're going to talk about something called the buggy whip test. It's foundational. Then we're going to take a sledgehammer to a couple of Wall Street's most beloved metrics. After that, we'll get into what Buffett uses instead, things like owner earnings and what he calls the profit margin mindset. And then we'll wrap it all up, putting it together into one powerful filter. All right, so let's dig into that foundational piece, the buggy whip test. It's a really simple but powerful thought experiment. Just imagine this. You're the best manager in the world, and you run a company that makes, well, whips for horse-drawn buggies. But then the car gets invented. See the problem? No matter how brilliantly you run that company, you can't fight that tide. The basic economics of your business are just broken, and no amount of genius management is ever going to fix it. And this really gets to the core of his whole philosophy. Buffett isn't out there looking for cheap bargain bin companies. He's hunting for wonderful companies. So the big question is, how does he find them? Well, he's got a specific set of tools he uses to cut through all the usual noise. And it all starts by challenging one of Wall Street's absolute favorite, and in his opinion, most misleading numbers. Okay, time to dive into the first big principle. And this one's a little controversial. Buffett basically argues that Wall Street's favorite report card for a company, earnings per share or EPS, is actually pretty flawed. So let's pull back the curtain on what he calls the EPS smokescreen. So on one side, you've got the typical Wall Street game, right? Everyone is obsessed with earnings per share. Did it go up? Did it beat the estimates? But Buffett, he's asking a totally different question. He wants to know, for every single dollar that we, the owners, have put into this business, how many cents of profit did the managers actually squeeze out of it? And that, my friends, is what return on equity, or ROE, tells you. It's a direct measure of how good the management team really is. So why does he call EPS a smokescreen? Well, think about it like this. If a company just hangs on to its profits instead of giving them back to shareholders, of course its earnings are going to grow year after year. Buffett says it's about as impressive as a savings account earning interest. It doesn't actually tell you a thing about whether the managers are any good at their jobs. And that's why return on equity is so crucial. This little ratio tells you exactly how many dollars in profit a company is making for every single dollar shareholders have invested in it. It's all about efficiency. Are the managers creating real, actual value with your money? Or are they just letting it sit there, kind of like that savings account we talked about? For Buffett, ROE is the ultimate report card for how management is doing. But of course, Buffett doesn't just take the standard ROE number at face value. Nope, he tweaks it to get closer to the real truth. First thing he does, he totally ignores the day-to-day craziness of the stock market. He values a company's investments at what they originally paid for them. Why? Because that stops a roaring bull market from making a mediocre company look amazing. Second, he gets rid of any weird one-time events, like if they sold off a building. He only cares about the core business and its ability to make money year in and year out.
And there's one last little test he applies here. That high return on equity, it has to be achieved without a mountain of debt. See, it's actually pretty easy to make your returns look amazing if you just borrow a ton of money. But that also adds a ton of risk. Buffett is adamant. A truly wonderful business should be able to produce fantastic results all by itself, without needing the artificial boost of leverage.
All right, so let's move on to the next piece of the puzzle. Now that we've kind of taken apart EPS, Buffett sets his sights on another one of Wall Street's darlings, cash flow. He argues that we need something much more honest, a metric he calls owner earnings. So first, let's just be clear on what we mean by conventional cash flow. It's actually a pretty simple formula. You just take the company's net income and you add back stuff like depreciation, things that are expenses on paper but aren't actual cash going out the door. And look, on the surface, that sounds like a perfectly reasonable way to see how much cash a business is generating. But, as we're about to find out, there's a huge, fatal flaw in that logic. And this is where it gets dangerous, as Buffett is quick to point out. Imagine a company's actual earnings. Its profits don't look so hot. Well, how convenient is it for management to just change the subject and start talking about their big, beautiful cash flow number? It happens all the time. And it's a great way to trick investors into paying way too much for a business that isn't nearly as profitable as it seems. And this gets right to the heart of the problem. That standard cash flow calculation, it conveniently leaves out a huge, very real cash expense. I'm talking about all the money a company has to spend on things like new factories, new equipment, and new technology just to stay in the game, to keep up with the competition. Buffett says those costs, what we call capital expenditures, are just as real as paying the electricity bill or paying your employees. You can't just ignore them. So what's Buffett's fix? He came up with a much more honest calculation he calls owner earnings. It's simple, really. You start with net income. You add back those non-cash things like depreciation. But then, and this is the absolute key, you subtract the money that the company had to spend just to maintain its competitive position. What's left over? That's the real, honest-to-goodness cash that an owner could pull out of the business without hurting it. Now look, Buffett is the first to admit that trying to estimate those future capital expenditures, it's not a perfect science. You gotta use some judgment. But he loves to quote the famous economist John Maynard Keynes here, who said, "I would rather be vaguely right than precisely wrong." And that's the whole point. It's way better to have a roughly correct picture of the real economics than a perfectly precise number that's totally misleading. Okay, our third tenet is a little different. We're moving away from specific formulas and more into something you can't always put a number on, a company's relentless focus on its profit margins. For Buffett, keeping costs low isn't some special program you run when times are tough. It has to be baked right into the company's culture. And this analogy he uses is it's perfect. He says, in a really great business, being efficient and watching costs is as automatic as breathing. Think about that. You don't wake up in the morning and decide, hey, today's the day I'm going to practice breathing. You just do it. And that's how cost control should be. It's not a reaction to bad news. It's an instinct that's there every single day in every part of the company. Buffett really sees managers falling into two camps. You've got your high-cost operators. These are the ones who are always finding new ways to add overhead. Another department here, more corporate perks there. Bureaucracy just kind of grows and grows. And then you have the low-cost operators. These are the people who are obsessed with efficiency. Even when the company is rolling in money and profits are at an all-time high, they are still looking for ways to cut expenses. And believe me, Buffett absolutely practices what he preaches. Just look at his own company, Berkshire Hathaway. We're talking about a massive corporation worth hundreds of billions of dollars. And yet, its headquarters is famously tiny. They don't have a legal department, they don't have a public relations department or a strategic planning department. It is the ultimate example of that low-cost mindset in action. Okay, so we've covered a lot of ground, right? We've talked about return on equity, we've decoded owner earnings, and we've talked about the profit margin mindset. Now it's time to put it all together. Let's combine all these ideas into one single Buffett filter that we can use to start seeing any business the way he does. So here it is, the complete 4-part filter. Number 1, forget EPS, focus on a clean return on equity that isn't pumped up with debt. Number 2, calculate the real owner earnings to understand the true cash power of the business. Number 3, look for that culture of cost control that leads to consistently high profit margins. And finally, number 4, this is the ultimate test.
For every single dollar the company keeps and reinvests, does it create at least one new dollar of market value for you, the shareholder? If it doesn't, that money should be coming back to you. It's that simple.
So let me leave you with a little challenge. Take this 4-part filter we've just built and apply it to some of the big, famous companies you hear about every day. Ask yourself, which of them are truly wonderful businesses, and which ones, even with their superstar CEOs, might just be modern-day buggy whip companies in disguise? It's a really fascinating exercise, and it's a powerful first step towards seeing the business world through the eyes of a true master.
All right, today we're cracking open the playbook of, well, the most famous investor on the planet. I'm talking about Warren Buffett, of course, and we're going to break down his blueprint for investing. And you might be surprised at just how simple and rational it really is.
So let's just get right into it. This is really the big question, isn't it? The multi-trillion-dollar one. How does a guy like Warren Buffett, year in and year out, figure out what to buy? I'll give you a hint. It's got nothing to do with fancy algorithms or chasing the latest hot stock tip. Nope. It's all about a mindset, a really disciplined one that knows how to separate the crazy emotions of the market from the actual, tangible facts of a business.
Okay, so to really get inside his head, we're going to follow this simple roadmap. First, we'll look at a little test he uses called the $1 premise. Then we'll dive into the absolute heart of his philosophy, the huge difference between price and value. From there, we'll get into the nitty-gritty of how he actually calculates what a business is worth, talk about this critical idea called a margin of safety, and then, finally, we'll wrap it all up with what your job as an investor really is. Sound good? Let's do it. All right, first stop, the $1 premise. You can think of this as Buffett's quick and dirty test, kind of like something you'd scribble on the back of a napkin. It's his way of seeing if a company's management is actually doing what they're supposed to be doing, which is creating real value for the owners, the shareholders.
And the beauty of this thing is just how simple it is. Look, when a company makes a profit, right, it's got two choices. It can give that money back to the shareholders, that's a dividend, or it can keep the money, retain it, and put it back into the business to grow it. Buffett's test is just this. For every single dollar that management decides to keep, did they manage to create at least one new dollar of market value in the long run? Think about it. If a company keeps, say, $1 billion over 10 years, but its stock is only worth $500 million more, well, that management team has literally destroyed value. It's such a simple yet powerful way to keep score.
And this whole idea of creating real value, it leads us straight into the single most important concept in Buffett's entire universe. And that's the constant battle between price and value. Seriously, if you can wrap your head around this one difference, you'll see where all the opportunity in investing really comes from.
So here's the best way to think about it. The price is that number you see zipping across your screen all day. It's what the stock market says something is worth right now. And the market? Well, it can be totally irrational. It's moody, it's driven by fear one day and greed the next. Value, on the other hand, is completely different. That's what the business is actually worth. It's a number you get by doing some calm, rational analysis, by looking at the company's real assets and earning power. And here's the absolute key. Price and value are almost never the same. And that gap between them, that's your big opportunity is hiding. Okay, so if value is the magic number we're after, how on earth do you figure it out? I know, it sounds super complicated, right? Like something only Wall Street quants with giant computers can do. But the truth is, the core idea is surprisingly simple, and it's been around for a really long time.
Yeah, Buffett would be the first to tell you he didn't make this stuff up. The secret sauce for valuation was actually spelled out way back in 1938. It was in a book called The Theory of Investment Value by a guy named John Burr Williams. So this isn't some newfangled financial trick. It's a principle that's stood the test of time. And that brings us to the official definition of what's called intrinsic value. Here it is. A business is worth all of the cash it's going to spit out for its owners from now until the day it shuts down. Simple, right? But wait, there's one really important catch. A dollar you get 10 years from now is worth less than a dollar you have today. So what you have to do is take all that future cash and discount it back to figure out what it's all worth in today's money. It's a powerful idea because, as Buffett points out, it lets you compare any two businesses, whether they're making horse-drawn carriages or brand new smartphones. The easiest way to get this is to just think of a business like a bond. A bond is simple, right? It pays you a fixed amount of interest, the coupon, every year. Well, a business is kind of the same. Its coupons are the cash it generates, what Buffett likes to call owner earnings. So your job is just a 3-step dance. Step 1, figure out what all those future cash coupons are likely to be.
Step 2, discount all of them back to today's dollars. And step 3, add them all up. And that final number, boom, that's the intrinsic value of the business. But, and this is a huge but, here's the key to how Buffett actually uses this. He will only even try to do this calculation for businesses where he feels like he can predict those future cash flows with a high degree of certainty. He wants them to be as reliable as a bond coupon. If a business is too complicated or the future is too murky, he doesn't guess, he doesn't force it, he just says, nope, and puts it in what he calls his too hard pile and moves on. Now, this next part is where Buffett really breaks from what they teach you in business school. Remember that discount rate we talked about? You need some kind of interest rate to pull all that future cash back to the present. Well, the academics say you should take a safe rate, like a government bond, and then add extra percentage points to it. They call it an equity risk premium, basically to account for the fact that stocks are bouncy. Buffett, he says that's nonsense. He just uses the rate on a long-term U.S. government bond. That's it. No extra padding. And why? Why does he do that? It's because his entire definition of risk is totally different from Wall Street's. For academics, risk is just volatility, how much the price of a stock jumps around. To Buffett, that's just noise. For him, real risk is the chance that you will permanently lose your money. And where does that risk come from? It comes from not knowing what you're doing. So by only investing in simple, predictable businesses that he understands inside and out, he feels he's already gotten rid of most of the real risk. Okay, so all of this brings us to one of the biggest, most pointless debates in investing. You hear it all the time. Are you a value investor or a growth investor? Are you supposed to be looking for boring, cheap companies or exciting, fast-growing ones? Well, to Buffett, that whole debate is just plain silly. He famously said they're joined at the hip. They're not two different things you have to choose between. Think about it. A company's growth is just one part of the equation when you're calculating its value. How fast a company grows directly impacts how much cash it's going to produce in the future, right? So you can't separate them. They are two sides of the same coin. But, and this is so important, growth by itself isn't always a good thing. Not at all. Growth only creates value if the company can earn a high return on the money it's reinvesting. If a business is a cash machine that earns great returns, then yeah, you absolutely want it to keep its profits and grow like a weed. But if a company earns really low returns, then growing is actually a terrible idea. It destroys value. A classic example here is the airline industry. For decades, it grew and grew and grew, but because the returns on all that capital were so lousy, all that growth created almost zero value for shareholders. So let's say you've done all the work, you've found a wonderful business, and you've run the numbers to figure out what it's worth. Are you done? Not even close. Now comes the final and maybe most important piece of the puzzle. It's the one thing that protects you from the crazy world, and maybe more importantly, protects you from yourself. It's called the margin of safety. And this is a big idea that Buffett got directly from his teacher, the legendary Benjamin Graham. And this margin of safety does two amazing things for you. First, it's your cushion. It's your protection. Look, nobody's perfect. You're going to make mistakes in your calculations, and sometimes bad stuff just happens to good companies. The margin of safety protects you from that downside. But second, and this is the fun part, it's also where your huge returns come from. If you were right about the value and you bought it at a massive discount, you're set up to make a lot of money as the price eventually catches up to reality. Let's just use some simple numbers to make this crystal clear. Imagine you figure out a business is worth $100 a share. The margin of safety principle says you do not go out and buy it for $95. No way. You wait. You wait until the market offers it to you for a big discount, let's say $75. That's a 25% margin of safety. Now, think about it. Even if you were a little bit wrong and the company's true value is actually only $90, your $75 purchase price still protects you and gives you room to make a good return. Okay, so after going through all of this, the $1 tests, price versus value, calculating intrinsic value, and the margin of safety, what does it all mean? What is your actual job as an investor, according to Buffett's blueprint? Well, it boils down to a very simple two-step mission. And here it is. This is the whole game in a nutshell. Forget all the complicated jargon you hear on TV. Your job is just two things. Step 1, figure out, roughly, what a business is worth. And step 2, have the patience and the discipline to only buy it when you can get it for way, way less than that. That's it. That's the whole secret. Everything else is just a distraction. And that really brings us to the final question, doesn't it? The actual formula for valuing a business, this whole idea.
has been out there for everyone to see for over 70 years. The logic is dead simple. So, is the secret to great investing really about having some complex formula or a fancy spreadsheet? Or is it just about having the uncommon discipline to stick to a simple plan, especially when the whole world and the market is panicking and telling you to do something stupid? I'll let you think about that one.
So what if I told you that you could look at the future of a stock price, not with some crystal ball, but through the eyes of arguably the world's most successful investor? Well, today, that's exactly what we're going to do. We're going to build a visual roadmap, a tool based on Warren Buffett's timeless wisdom. It's designed to help you and me separate the real signal from all the noise in the market. So, let's get into it.
All right, here's our game plan for today. We've got 6 key stops. First, we'll start with the one simple idea that pretty much changed investing forever. Then we're going to build out our visual model, exploring the 3 crucial ingredients that really determine long-term success. And trust me, by the end of this, you're going to have a brand new lens to look through for every single investment decision you make.
You know, every great strategy, every big idea, it always starts with a core principle. And for Warren Buffett, it all comes down to a 9-word mantra he learned from his mentor. It's something that just cuts through all the jargon and complexity you hear from Wall Street. It's a really simple idea, but man, it changes everything.
And there you have it. Investing is most intelligent when it is most businesslike. Just 9 simple words. But Buffett himself says these are the foundation of his entire success. So the big question is, what does it actually mean to invest like a business owner?
Well, here's what it means. It means you stop looking at stocks like they're just lottery tickets or blinking lights on a screen. You start seeing them for what they really are, a tiny slice of ownership in a real, living, breathing company. That one mental shift, that's the key that unlocks absolutely everything else. It's the difference between being in a casino and being in a boardroom.
Okay, so a philosophy is great, but a framework you can actually use, that's even better. How do we take this whole business-like idea and turn it into a tool that we can apply? Well, in this next section, we are going to build a visual model that brings this whole philosophy to life.
So yeah, what does this business-like approach really look like when the rubber meets the road? How can we visualize the difference between making a really smart investment versus just taking a risky bet? The answer, it turns out, is in a simple but really powerful diagram.
And here it is. This is our roadmap. Think of this as the anatomy of a long-term stock price. This one picture really captures the entire philosophy. You can see it's built on 3 main pillars: the price you pay for the stock, the quality of the actual business you're buying, and the value that business can create down the road. Let's break down each one.
All right, we're going to start on the left. This is the world of market prices. The flashing numbers, the crazy charts, the stuff that most people think is the entire game. But for a business-like investor, this is just the starting line. It's all about finding the right price to enter the race.
Okay, take a look at the vertical axis of our diagram here. It highlights this fundamental choice that every single person in the market has to make. Are you a speculator or are you an investor? See, the speculator is basically just playing poker, but with stock certificates. The investor, on the other hand, is buying a business. They're not asking what the price will be tomorrow, they're asking what the value will be for years to come.
So the investor's first job is to become a kind of appraiser, to figure out the true, underlying, intrinsic value of the business. And then comes the hard part. Patience. You have to wait for the market's mood swings to create an opportunity, a moment when you can buy that dollar of value for, say, 50 or 60 cents. That gap, that discount between the price and the real value, that's your margin of safety. It's your buffer against being wrong.
This quote from Buffett just perfectly captures what's at stake. The market is just a tool. For people who've done their homework and really understand the business they're buying, it offers up these incredible opportunities. But for those who are just gambling on price movements, well, it's a surefire way to get into trouble.
Okay, now let's shift our focus to the absolute heart of our diagram, the business itself. Because, let's be honest, getting a bargain price on a failing company isn't a bargain at all, right? So the critical question becomes, what are you actually buying?
And here's a super important distinction that Buffett makes. A fantastic company is not automatically a fantastic investment. Why? Because if the market has already gotten excited and bid the price up into the stratosphere, that overvalued zone on our chart, you're probably setting yourself up for a fall. The real magic happens at that intersection of a great business and a great price.
So how does Buffett measure the quality of a business? Well, he basically uses a 3-part test.
First, is it inside his circle of competence? Meaning, do I actually understand how this business makes money? This isn't about being a genius, it's about being honest about what you don't know. Second, does it have good economics or what he calls an economic moat? Think of a castle with a huge moat around it. Does the company have a durable advantage that protects it from competitors? And third, is it run by people who are both talented and trustworthy? Because remember, you're literally handing them your money to manage. If a company can pass all three tests, you've probably found a quality business.
So let's say we've done it. We've found a great business and we bought it at a fair price. So we're done, right? Not so fast. The story doesn't end there. We now have to look to the final column of our diagram, the future. Because a company's value isn't some fixed number. It's a living thing that can be grown or destroyed by its leaders.
Our diagram here shows three possible futures for the business you just bought. On the bottom path, you have extinction. This is where poor management makes bad decisions and actually destroys the value you paid for. The middle path is, well, it's mediocrity. The company just kind of keeps pace with the average market return. But that top path, value creation, that's where the real magic happens. This is where you have brilliant managers who act like true partners, and they reinvest the company's profits so wisely that they compound your initial investment year after year after year.
Price, quality, and future growth. We've looked at each piece of the puzzle on its own. Now let's take a step back and see how they all fit together to form this incredibly powerful, unified investment strategy.
And when you see it all together like this, the strategy just becomes crystal clear, doesn't it? You start by deciding to be an investor, not a speculator. You find a fantastic business trading at an undervalued price. Then, you make sure you're partnering with management that is dead set on that top path of value creation. An undervalued price, a high-quality business, and a bright future. That is the formula for long-term success.
I think this quote is just the perfect way to wrap it all up. The skills you need to be a great investor and the skills you need to be a great business person, they aren't separate things. They're two sides of the exact same coin. Each one makes the other stronger, creating this amazing virtuous cycle of intelligent decision-making.
So here it is, the ultimate takeaway. The next time you're about to click buy on a stock, just pause for a second. Pull up this mental framework we've just built and ask yourself one simple question. Am I buying a piece of paper or am I buying a business? I promise you, your answer to that question will define your entire journey as an investor.
Picture this. It's 1973. The stock market is in a total free fall. Investors are absolutely panicked, and all the smart money is running for the hills. But one man, Warren Buffett, does the complete opposite. He takes more than $10 million and plows it all into a single stock that everyone else thinks is sinking. Well, this is the story of one of the greatest investments of all time.
Now, to really get the genius of Buffett's move, you got to put yourself in the shoes of an investor back then. You have to feel the fear. The year kicked off at an all-time high, but by spring, the Dow had already tanked over 100 points. I mean, we're talking about the big can't-miss stocks getting absolutely hammered. And by June, that slide was just picking up speed. The mood on Wall Street wasn't just gloomy, it was getting downright apocalyptic.
And make no mistake, this was a full-blown panic. You had brokers pointing to rock-solid stocks like IBM, which had just crashed through key price levels, and they were telling their clients, this is a terrible omen for the entire market. The only advice you were hearing on the street was simple: sell, sell, sell. And all the while, in the middle of all that chaos, Warren Buffett was just quietly, methodically buying up shares of the Washington Post Company. By June, right as the panic was hitting its peak, he'd already poured in over $10.6 million, scooping up nearly 500,000 shares. While everyone else was running from the fire, Buffett was calmly walking straight into it, checkbook in hand. So this is the big question, right? How could one person be so incredibly certain when the rest of the world was so terrified? What on earth did he see in this newspaper company that all the supposed experts on Wall Street were completely missing? Well, that's exactly what we're going to unpack here. All right, so here's our game plan. First, we're going to dig into the history of the company itself. Then we'll break down the three key pillars of Buffett's thinking. First, understanding the business as a franchise. Second, finding that margin of safety in the price. And third, making sure there was rational management running the show. And finally, we'll look at the incredible results of that partnership. Okay, first things first. To understand the investment, you really have to understand the asset. And this wasn't just some random company. It was the Washington Post, a true institution with a really dramatic and fascinating history.
So the paper's modern story really starts back in 1933 when it was bought out of bankruptcy by a man named Eugene Meyer. Decades later, after a family tragedy, control of the company unexpectedly passed to his daughter, Katharine Graham. Now get this, she had zero experience running a major corporation, but as she famously said, things don't stand still. You have to make decisions. And boy, did she make some brilliant ones, like hiring the legendary editor Ben Bradley and giving the green light to the Watergate investigation that would literally change American history. And it was her decision to take the company public in 1971 that put it right on Warren Buffett's radar.
So, with that history in mind, what was the first thing that Buffett saw that the rest of the market was completely blind to? Well, he didn't just see a newspaper. He saw what he called an economic franchise, what was, for its time, a nearly perfect business model.
This quote from Buffett says it all. You have to remember, back in the 70s and 80s, before the internet, a city's main newspaper was an absolute economic fortress. And Buffett knew this better than anyone because he already owned a few smaller papers himself. He understood the dynamics inside and out.
This slide really helps you visualize that fortress. I mean, think about it. Back then, most big cities only had one major paper. They had a practical monopoly, and they were essential. They were the town's bulletin board. If you wanted to sell your house or announce a big sale at your store or even just find a job, you had to go through the paper. This gave them unbelievable pricing power. They were basically a toll booth collecting a little royalty on almost every bit of local commerce. And the best part? They didn't have to spend a ton of money to keep growing. It was a business with a huge, deep moat. A moat that, of course, the internet would eventually drain, but back in 1973, it was a beautiful thing.
Okay, so Buffett knew he was looking at an absolutely incredible business. But the next and maybe the most critical question was, what's the price? And this, my friends, is where the story gets truly remarkable. This is where he found what he called a massive margin of safety. So right in the middle of the 1973 market panic, Wall Street said the entire Washington Post company, the newspaper, Newsweek magazine, all of its valuable TV stations, was worth a measly $80 million. But Buffett knew that was just the stock market price, not the business value. So he sat down and did his own calculation to figure out what it was really worth.
So let's walk through his math here step by step to see how he came to his conclusion. Okay, step one, a very simple, super conservative calculation based on its owner earnings. That's the real cash the business was spitting out. Already put the value at around $150 million. That's nearly double the market price, right out of the gate. But he knew there was more. Step two, when you factor in its monopoly pricing power, which let it reliably raise prices year after year, the value jumps up closer to $350 million. And then he had one more crucial insight. He saw that its profit margins were temporarily low because of some recent union disputes. He figured that if those margins just went back to their historical average, which he thought was inevitable, the company's true intrinsic value was actually somewhere between $400 and $500 million.
So here's the bottom line, the crucial point. The market was offering him a dollar's worth of a fantastic business for less than 25 cents. He even said later that most media executives at the time would have privately agreed with his valuation. The only difference was, he was the one with the conviction to actually act on it. But, a great business at a cheap price still isn't the whole story. There's a third critical ingredient you need. You need rational, shareholder-friendly people running the company to unlock all that value. And for Buffett, he found that in Katharine Graham.
Katharine Graham turned out to be an exceptional manager of the company's money. She took a really firm and very difficult stance with the unions to get costs under control and get those profit margins back up. But her real genius was what she did with all the extra cash the business was generating. Instead of wasting it on silly acquisitions, between 1975 and 1991, the company bought back an incredible 43% of its own stock, usually when it was cheap. This was just a massive gift to the long-term shareholders who stuck around, like Buffett.
So there you have it, the three key ingredients: a great franchise, a cheap price, and smart management. So now, let's look at how this perfect storm actually played out in the real-world results. And the results were just stunning. Return on equity, which is a key way to measure how profitable a company is, was already a very respectable 15.7% when Buffett invested. But just 5 years later, it had more than doubled to over 31%, absolutely crushing the industry average. This was the proof that Katharine Graham's tough decisions were working, and the company's true earnings power was finally being unleashed. And what's even more impressive, they achieved these incredible returns while keeping a fortress-like balance sheet. While the average competitor was loaded up with debt, the Washington Post had almost none. They were generating these amazing returns from being excellent at their business, not from taking on a bunch of financial risk.
And the final payoff for Berkshire Hathaway shareholders? Well, that initial $10.6 million investment, which they held for decades, eventually grew to be worth over $1 billion. It's just a staggering, mind-blowing return that proves the power of buying a wonderful business at a fair price. Or in this case, a ridiculously cheap price.
But Buffett's influence didn't just create a ton of wealth. It helped shape the entire culture of the company. After he invested, Katharine Graham invited him to join the board, and he became a mentor, especially to her son, Don. This quote from Don Graham, written years later, just shows how deeply Buffett's philosophy of long-term, shareholder-focused thinking became part of the company's DNA.
So what's the big lesson we can take away from all this? This one investment gives us a timeless playbook. Find a simple business with a strong competitive advantage. Figure out what it's really worth. Wait patiently for the market to offer it to you at a huge discount. And make absolutely sure you're partnering with honest and rational people. You know, it sounds simple, but it is definitely not easy.
And it's so important to remember, the ultimate success here wasn't just measured in dollars and cents. It all started when Buffett wrote a simple letter to Katharine Graham, just to reassure her that his intentions were friendly. That one letter led to an invitation to join the board, which then sparked one of the most famous and lasting friendships in the history of American business. Which really leaves us all with one final question to think about. The story of the Washington Post is the ultimate example of Buffett's famous advice to be greedy when others are fearful. And it forces us to ask ourselves, in our own moments of panic, is our first instinct to follow the crowd and react to the fear? Or have we done the hard work to see the underlying value that everyone else is missing? This is, without a doubt, one of the greatest investment stories ever told. It's all about how Warren Buffett put millions of dollars into a company that, honestly, everyone else was absolutely sure was going to fail. It's a true masterclass in seeing value where other people only see a complete disaster. And it really all boils down to one simple but incredibly powerful test. So it all starts with this idea that Buffett calls the $1 premise. Now, this is his ultimate test for any management team, and it's so simple it's brilliant. Think about it. When a company makes a profit, it can do one of two things. It can give that money back to you, the shareholder, as a dividend, or it can hold on to that money and reinvest it back into the business. Now, if the people running the show are doing their jobs right, every single dollar they decide to keep should create at least another dollar in market value. It's a simple concept, right? But it is brutally effective at showing you which businesses are good and which ones are just kind of mediocre. And hey, this isn't just some abstract theory. Take the Washington Post Company, for example. Between 1973 and 1992, for every single dollar it kept in the business, it generated a whopping $1.81 in market value. Now that is a true value-creating machine. So keep that test in your head, because it is the absolute key to understanding our next company, which at one point seemed to be doing the exact opposite. All right, let's get to the star of our show, Geico. Long before it became this famous cautionary tale, it was an absolute giant, a titan of industry, and it was all built on one of the most brilliant, disruptive ideas in the history of insurance. You know, the original idea back in 1936 was just genius in its simplicity. The founder, Leo Goodwin, had two killer insights. First, he said, let's only insure a very specific low-risk group of people, government employees. Second, and this was the real game changer, let's sell directly to them and cut out the insurance agent by getting rid of that middleman who was taking a huge 10 to 25% cut of every premium. Geico could offer way lower prices to the safest drivers. This wasn't just a gimmick. It was a massive, sustainable, competitive advantage baked right into the DNA of the company. And for decades, man, this model worked like a charm. Geico went into this golden age, expanding its customer base to include other careful drivers like professionals. Profits just skyrocketed, shareholders got incredibly wealthy, and the company looked completely and utterly unstoppable. But you know how it goes. Long stretches of incredible success can make a company complacent. Geico was about to get a very, very painful lesson in what happens when you forget the one thing that made you great in the first place. So what went wrong? Well, it wasn't just one mistake, it was a total cascade of them. The company started chasing growth at any cost. They abandoned their roots and started insuring much riskier drivers. At the exact same time, you had runaway inflation driving up the cost of car repairs.
But the real killer blow, the one that almost ended them, was internal. Management kept setting aside way too little money to pay for future accident claims. They were basically burning through cash and had no idea how big the fire had gotten. I mean, this timeline says it all. Just look at this collapse. From a high of $61 a share in 1972, the stock gets completely annihilated, falling all the way down to just $2 by 1976. The market wasn't just worried, it was pricing Geico as if it was already bankrupt.
And this right here is why. The final underwriting loss for 1975 was a staggering $126 million. That's a negative sign in front of a very, very big number. For a company that had been a profit machine for decades, a number like this was just unthinkable. It sent shockwaves through the market and pushed Geico right to the edge of the cliff. But in the middle of all this panic, all this chaos, there was one investor who was looking at the situation completely differently. And this is where Warren Buffett enters the story, not as some kind of wild gambler, but as a totally rational, cool-headed analyst. You see, for Buffett, this wasn't some new, exciting idea. He had history with this company. Way back in 1950, when he was just a student, he took a train down to Washington, D.C., showed up at Geico's headquarters on a Saturday, and basically knocked on the door. He ended up spending 5 hours with an executive who gave him a masterclass on the entire business. He understood the company's DNA, that incredible low-cost advantage, on a level that almost nobody else did.
And this really gets to the core of the whole story. On one side, you have the entire market screaming, it's over, it's broken, it's going bankrupt, sell, sell, sell. But Buffett saw something totally different. He believed that the core business, that brilliant low-cost model, was still perfectly fine. The company wasn't dying. It had just been badly injured by a series of terrible management decisions. The problems, he thought, were fixable.
So, while everybody else was stampeding for the exits, Buffett started walking in with his checkbook. Quietly, he started buying. He invested over $4 million, picking up shares for an average price of just a little over $3. This was not a guess. It was a calculated, confident bet that the powerful core business would survive its incompetent managers. Of course, for Buffett's bet to actually pay off, Geico needed a savior. And that meant they needed a new leader with the stomach to make some incredibly painful decisions. Enter John Jack Byrne. Byrne's plan, which he called Operation Bootstrap, was absolutely brutal, but it was also brilliant. He immediately raised capital to stop the bleeding. Then he did something almost unheard of. He decided to shrink the business to save it. He shut down 100 offices, laid off nearly half the workforce, and pulled out of states that were losing money. But most importantly, he forced every single policyholder to reapply with new information. This let Geico finally price its risk correctly, and they kicked out 400,000 policies that were losing them a fortune. So remember this number, right? This catastrophic $126 million loss. This was the bottom of the pit that Jack Byrne was starting from. Now look at this. In his very first full year, the company swung from that massive loss to a profit of over $58 million. The turnaround wasn't just fast, it was immediate and stunning. It was all the proof anyone needed that Buffett's thesis was spot on. The core business was always sound. It just needed someone competent at the wheel. Buffett had this amazing quote that just perfectly captures Byrne's genius. He was a relentless motivator. He was constantly reminding his team that their very survival depended on one thing, being the absolute low-cost provider. I mean, the guy shared a secretary with 2 other top executives just to prove a point. He made being cheap a religion at the new Geico. Okay, so the company was saved and the turnaround was nothing short of spectacular. But how did Buffett's investment actually do? And maybe more importantly, did the new revitalized Geico pass his ultimate test of a great business? Let's look at the numbers. All told, Berkshire invested $47 million. By 1980, just a handful of years after the company was on life support, that investment was already worth $105 million. I mean, that's a home run, no question. But that's not even the real story, not the real test of Geico's greatness. That was still to come. And so we come all the way back around, full circle, to that ultimate test. After being dragged back from the brink of death, was this new, disciplined Geico a truly great company? Was it capable of creating exceptional long-term value for its owners? This is the big one. This is the whole ball game. We saw earlier that the Washington Post created a $1.81 in value for every dollar it kept. So how would this legendary turnaround story stack up against that incredible benchmark?
The answer is just unbelievable. Between 1980 and 1992, for every single dollar of earnings that Geico retained, it created $3.12 in market value. It didn't just pass the test, it absolutely obliterated it. That right there is the hallmark of a truly extraordinary business paired with absolutely exceptional management.
And that brings us to a final question for you to think about. The Geico story is such a powerful reminder that sometimes the market just gets it spectacularly wrong. It confuses a temporary, fixable problem with management for a terminal illness in the business itself. So the question for all of us today is, what great franchises are out there right now, being treated by everyone as if they're broken? Today, we are digging into one of the most legendary media deals in history. But this wasn't just about assets and networks. Nope. This was an incredible multi-billion-dollar bet on one man's management genius. And let's start right here, because this quote, it gets right to the absolute heart of the story. You see, for Warren Buffett, this was never just a financial transaction. It was about partnership. This whole massive deal didn't hinge on spreadsheets, but on one person Buffett trusted implicitly, a guy named Tom Murphy.
So here's how we're going to break down this incredible case study. First, we'll meet the managers themselves. Then we'll witness the historic deal go down. We'll break down their legendary methods, see how they handled an absolute river of cash. And finally, we'll understand Buffett's ultimate bet.
All right, first up, who were these masterminds behind Capital Cities, the company that was about to pull off this massive deal? Well, it really all comes down to two names, Tom Murphy and Dan Burke. You know, their story is just a textbook example of how you build an empire from basically nothing. It all started with a single, struggling TV station in Albany. Murphy brings in Burke, and together they form one of the most successful corporate partnerships in American business, just methodically gobbling up over 30 properties over 3 decades. And this is so important. They weren't just successful, they were revered. Their reputation for being brilliant operators and incredibly shrewd managers was so strong that it became the very foundation for the biggest deal of their entire lives. Okay, so this all builds up to 1985. Murphy and Burke are ready for their biggest move yet, and they set their sights on a target that honestly seemed impossibly huge for a company like Capital Cities, the television network giant ABC. And you've got to love the contrast here. I mean, on one side, you've got the establishment, ABC's 79-year-old chairman, Leonard Goldenson, backed by a whole wall of expensive bankers. And on the other side, you've got Tom Murphy, a guy who negotiated his own deals, with his trusted friend Warren Buffett in his corner. See, Goldenson was worried about who would lead ABC after he was gone, and he just knew, Murphy and Burke were the best in the business. So how in the world did they pull off this historic $3.5 billion acquisition? Well, Murphy put together this complex financing puzzle. They'd borrow over $2 billion, sell off almost $1 billion in assets they didn't need, and for that final, crucial $500 million piece, Murphy called Buffett. Berkshire Hathaway jumped in, buying 3 million newly issued shares, and just like that, the deal was sealed. Okay, so they've got the keys to the kingdom. ABC is now theirs. Murphy and Burke didn't waste a single second. They immediately went to work putting in place that legendary 2-part management philosophy that made them famous to begin with. Part 1 was radical decentralization. Their philosophy was just beautifully simple. Hire the absolute best people you can possibly find and then get out of their way. And you just got to hear this anecdote. So Dan Burke would send Murphy these weekly reports from the Albany station, and Murphy never, not once, replied. The message couldn't have been clearer. I trust you, run this thing like you own it. And if you want to see why part 2 of their method was so important, just look at these numbers. It's a night and day difference. Capital Cities was running at a super lean 28% operating margin, while ABC was just bloated at only 11%. That massive gap showed exactly where Murphy and Burke needed to aim their legendary cost consciousness. They moved fast. The changes they made were immediate, they were deep, and they were incredibly symbolic. Sure, 1,500 people were let go, but they were given generous severance. But it was the cultural changes that sent the loudest message. Executive dining rooms? Gone. Private elevators? Eliminated. Company limousines? Done. When Tom Murphy showed up for his next visit and took a cab, everybody knew
The era of corporate excess was officially over.
And that quote right there, that just sums up the whole thing, doesn't it? The Murphy method wasn't about breathing down people's necks. It was about setting incredibly high expectations, giving managers the freedom to hit them, and then holding them accountable. The formula was simple: high expectations, high freedom. So they've turned this thing into a lean, mean, profit-making machine. But that creates, well, a pretty great problem to have. What in the world do you do with the overwhelming river of cash that the new capital cities/ABC was now generating?
And I'm not talking about a little bit of pocket change. We are talking about an incredible $2.3 billion in free cash flow in just 5 years. That's cash, free and clear, after all the bills were paid. Now, for most CEOs, this is a dangerous moment. This is where something called the institutional imperative kicks in. That irresistible urge to spend it, to grow the empire, to make more deals just for the sake of getting bigger. It's a really common trap.
Murphy and Burke saw 3 logical choices. They could buy more companies, pay down their debt, or buy back their own stock. But this is where their real genius, their incredible discipline, just shines through. They looked at the market for other media companies, saw that prices were way too high, and they simply refused to overpay. So what did they do instead? They chose to pay down debt and just hoard cash. I mean, look at this transformation. In just 6 years, they cut their long-term debt almost in half, while their cash on hand went from a tiny $16 million to a staggering $1.2 billion. They turned the company into an absolute fortress. All right, let's bring this whole thing back to Warren Buffett, because we have to understand why this investment became one of his greatest ever, even though, on the surface, it looked like he was breaking one of his most sacred rules. Buffett's entire philosophy, everything he learned from his mentor, Benjamin Graham, is built on this one powerful idea: the margin of safety. You buy a great business for a cheap price. That gives you a cushion, a buffer, in case you're wrong. But here's the big puzzle, right? With capital cities, Buffett paid a price that was really close to what it was trading for on the market. The numbers showed a very thin, if any, traditional margin of safety. So why on earth did he make what was, at the time, his single largest investment ever? The answer is so simple, it's brilliant. It wasn't in a spreadsheet. The answer was a person. Buffett himself said it. If it hadn't been for Tom Murphy, he would not have made the investment. Tom Murphy was his margin of safety. He was betting on the manager, not just the math. And if you need proof that his bet on the man paid off, look no further. This number is the ultimate proof. For every single dollar that Murphy and Burke kept in the business to reinvest, they created over $2 in market value for shareholders. That right there is the sign of truly extraordinary management. And that's the powerful idea the Capital Cities/ABC story really leaves us with. It forces us to ask this fundamental question: what truly drives value? Is it the quality of the business you buy, or is it the quality of the manager you trust to run it? In this legendary case, well, the answer couldn't be any clearer.
So, what if I told you that one single investment, made way back in 1988, would end up generating more cash for an investor than his entire original purchase price year after year after year? Well, that is the absolutely incredible story of Warren Buffett's legendary bet on Coca-Cola. It was a move that left the entire financial world completely and totally stunned.
And that, right there, is the big mystery we're going to solve today. Because, on the surface, this bet made 0 sense. The company looked old, the stock price looked way too high, and the potential for growth seemed, well, pretty limited. So what was the secret? What was that hidden value that only Warren Buffett could see?
First off, let's just try to wrap our heads around the sheer scale of this decision. This wasn't some small speculative play. Buffett committed over $1 billion. Now, to put that into perspective for you, this one single bet on a soda company made up a full 1/3 of Berkshire Hathaway's entire portfolio at the time. I mean, it was a massive, all-in bet the farm kind of move.
And Wall Street? They thought he was nuts. Seriously. All they saw was this 100-year-old mature business. He paid 5 times its book value and over 15 times its earnings. That's a huge premium compared to the rest of the market. To all the experts, it was a classic mistake of overpaying for a slow-growing giant. Turns out they were very, very wrong.
So, how did Buffett know? Well, the first piece of this puzzle wasn't hidden in some complex stock chart or analyst report. Nope, it was inside the company itself. Because you see, the Coca-Cola of 1988 was not the same sleepy company it had been just a decade earlier. It had been completely and utterly reborn.
Just look at this contrast. It's like night and day, really. The 70s were a total disaster. The company was completely unfocused, dabbling in everything from shrimp farms to wineries. Morale was terrible. There was constant infighting. But then, in the 80s, under this dynamic new CEO named Roberto Goizueta, it transformed into a disciplined, focused, and incredibly profitable machine.
And let's not sugarcoat it. Things were bad. The company was basically wandering in the desert. They were fighting with their own bottlers, making huge embarrassing mistakes overseas, and just watching their profit margins shrink year after year. For an entire decade, the company's value on the stock market went absolutely nowhere. It had totally lost its way.
And then came Goizueta. In this quote, it just perfectly captures the change he brought. His very first move was to get his top 50 managers in a room and just lay it all on the line. He demanded they be brutally honest about all their failures, and then he demanded total, unwavering commitment to a new, focused strategy. That was the moment the entire culture shifted.
And the results? They were immediate and just dramatic. Take a look at the pre-tax margins here. They'd been falling for 5 straight years, hitting a low of just under 13%. By the time Buffett invested, Goizueta had cranked them up to a record 19%. The company was simply making way more money on every single can of Coke it sold.
And here's another key number that you know caught Buffett's eye: return on equity. This basically shows how well a company uses its investors' money to make profits. In the 70s, it was a pretty respectable 20%. But under Goizueta's leadership, it shot up to an incredible 31%. This wasn't just a good business anymore. This was the sign of a truly exceptional one.
Okay, so Buffett sees this great company in the middle of a jaw-dropping turnaround. But that was only part of the story. Let's move to the next piece of the puzzle and see how this new Coca-Cola fit his personal investment checklist like a glove, ticking every single box.
You see, Buffett has this very clear set of rules. He's looking for simple businesses he can actually understand. They have to be run by rational managers who are absolutely obsessed with shareholder returns. He needs to see high and sustainable profits, and this is a big one, a company that avoids doing dumb things just because all its competitors are.
And that last point is so important that it actually has a name: the institutional imperative. You can think of it as the corporate version of peer pressure. It's this powerful, almost irresistible force that makes companies make really bad decisions just to keep up with the Joneses. Goizueta's genius was that he was able to completely resist this.
While everyone else in the consumer world was diversifying and getting distracted, Goizueta was focusing. I mean, Pepsi was out there buying Pizza Hut and Taco Bell, Anheuser-Busch was getting into theme parks. What did Goizueta do? The exact opposite. He sold off the wineries, he sold off the shrimp farms, and he focused every single ounce of the company's energy on the most profitable business on earth: selling syrup. It was a bold, brilliant, and totally contrarian move.
And this quote just sums up his entire philosophy. It wasn't complicated. It was a crystal clear mission to do one thing and one thing only: make as much money as possible for the shareholders. Every single decision was measured against that simple goal. This is exactly the kind of rational, focused management Buffett dreams about. The proof, as they say, is in the pudding. This number, 17.8%, is the annual growth rate of what Buffett calls owner earnings, his favorite way to measure a company's true cash-generating power. Think of it as the real cash a business has left over after all the bills are paid. Under Goizueta, this number had more than doubled from the previous decade. Coca-Cola wasn't just a company, it was a cash machine.
Okay, so we have a reborn company with brilliant management, ticking all of Buffett's boxes. But that still leaves the biggest question unanswered. What about the price? So let's get to the final part of the puzzle, the actual math that proved Coca-Cola was in fact a spectacular bargain.
And this was the big hang-up for Wall Street. And you know what? It's a fair question. The business was fantastic. No one was doubting that. But was it really worth that premium price tag? For Buffett, the answer wasn't about the price. It was about figuring out the company's true underlying value. And this is one of Buffett's most famous and most important ideas. Price is what you pay. Value is what you get. The sticker price of a company, in this case about $15 billion, is just a number. It doesn't tell you anything about what the business is actually worth. To make the decision, he had to calculate its true or intrinsic value. And this table basically shows you his thinking. He ran the numbers under a few different scenarios. Even if you assumed Coke would only grow at a slow and steady 5%, its real value was almost $21 billion. At a more reasonable 10 or 12% growth, the value was well over $30 billion. And if it just kept up its recent pace, the value was getting close to $50 billion.
So, this right here, this is the aha moment. This is the whole ball game. The market was selling a dollar bill for 50 cents. While everyone else on Wall Street was fixated on the $15 billion market price, Buffett's own conservative math showed him he was buying a business worth at least double that. This huge gap, this canyon between the real value and the sticker price, is what Buffett famously calls the margin of safety. It's the absolute bedrock of his entire investing philosophy. And in the case of Coca-Cola in 1988, the margin of safety wasn't just good, it was enormous. He simply could not lose.
And that's the whole story. He wasn't buying the sleepy, unfocused soda company of the 1970s. He was buying the reborn, hyper-efficient global machine of the 1980s. He saw the incredible business, the brilliant management, and most importantly, he did the simple math that proved it was all on sale.
So, the final question really isn't just about stocks. It's about, well, pretty much everything. When you're making your next big decision, are you just reacting to the sticker price, the easy number right there in front of you? Or are you willing to do the work, look under the surface, and calculate the true, lasting value? The difference, as Warren Buffett showed us, can be worth billions.
All right, today we are digging into one of Warren Buffett's most fascinating investments. It's a story that seems to break all of his own rules, but in doing so, it actually gives us a much deeper look into how he really thinks. So, how in the world did Buffett end up making a huge bet on a defense contractor that looked like it was going out of business? Let's get into the incredible story of General Dynamics.
To really get how bizarre this investment was, you just have to put it side by side with a classic Buffett company. So on one side, you've got Coca-Cola. It's simple, it's a global powerhouse, and it makes fantastic returns on its capital. It's the Buffett dream. And then you've got General Dynamics in the early 90s. It's in a dying industry, its only real customer is the US government, and its profit margins were just awful. It was, by every single one of Buffett's own rules, an absolute nightmare of a business.
So yeah, that's the big question, right? It makes no sense on the surface. It's a puzzle that totally confused Wall Street back then, and honestly, it holds a really powerful lesson for all of us today. And to figure it out, we've got to go back a bit and look at the crazy situation that even made this opportunity possible in the first place. To really wrap our heads around why this investment was so strange for Buffett, we need to rewind to the early 1990s. This was a time of massive, world-changing events that basically turned the entire defense industry completely upside down. The end of the Cold War, it was great for the world, right? A victory for democracy. But if you were a defense contractor, it was a disaster. All that talk about a peace dividend basically meant that their number one customer, the government, was about to take a giant pair of scissors to its budget. This uncertainty just sent their stock prices into a nosedive, and General Dynamics hit its lowest point in a decade. And just look at the numbers here. This wasn't just a little dip. This was a complete freefall. In only 3 years, the company's sales just evaporated, falling by 65%. They went from this $10 billion giant to, a shadow of what they used to be. For all intents and purposes, the business was dying on the vine. So, right in the middle of all this chaos, a new guy steps into the picture. In January of 1991, General Dynamics brought in a new CEO, William Anders, and his job was monumental. Basically to save a sinking ship. So Anders comes in, and he starts with a usual crisis playbook. He did all the things you'd expect. He started cutting costs everywhere. He slashed $1 billion from their spending plans and R&D. Thousands of people lost their jobs. And, this is super important, he tied his whole executive team's pay directly to the company's stock price. He was aligning their interests with the shareholders. But he figured out pretty quickly that just pinching pennies was not going to be enough to solve this. Anders knew he had to do something drastic. Just cutting costs wasn't going to save them. He needed a whole new game plan, something radical. So he actually commissioned a deep dive study on the whole defense industry, and what he learned from that led him to a brand new and pretty brutal strategy for survival. He developed this incredibly simple 3-part test that he applied to every single piece of the company. First, he'd ask, is this product a leader in its market? Is it the best? Second, Can it actually make money and be efficient now that the industry is smaller? And third, if the answer to either of those was no, the rule was simple and absolutely ruthless. Sell it. No sentiment, no exceptions. Just get rid of it.
And man, he did not waste any time. He took that test and just started executing. He sold off the Cessna aircraft business, he sold off the missile division, and in less than 6 months, he had taken apart big chunks of the old General Dynamics empire and raised a staggering $1.25 billion in cold hard cash. And of course, Wall Street absolutely loved it. That kind of decisive action gets attention. The stock price more than doubled in just 1 year. But that was just the warm-up act. What Anders did next with all that cash, that's the part that really got Warren Buffett's attention. Okay, so think about this. You're a CEO, and you're suddenly sitting on over $1 billion in cash. The pressure to go out and do something big with it, buy another company, expand, diversify, it's immense. But Anders, he decided to fight against one of the most powerful forces in the business world. He resisted what Buffett has famously called the institutional imperative. It's this weird, almost mindless tendency for big companies to just grow, to get bigger for the sake of getting bigger, to build an empire, even if it makes absolutely no sense and destroys value for the people who actually own the company, the shareholders. Anders just looked at the facts. The study he'd commissioned was crystal clear. When defense companies tried to branch out into other businesses, they failed 80% of the time. And building more factories in an industry that was shrinking, well, that was just dumb. So he did the most logical and yet the most radical thing you could imagine. He decided to just give the money back. He announced a massive stock buyback. He used the company's own cash to buy its own stock off the market from investors. The result was absolutely stunning. He bought back and retired almost a third of all the company's shares. That meant for every single shareholder who held on, their piece of the pie just got a whole lot bigger. And that move right there, that supreme act of rational shareholder-focused thinking, was like a giant flare going off in Omaha, Nebraska. This was not business as usual, and Warren Buffett definitely took notice. But here's the best part of the story. Buffett didn't buy the stock because he thought it was a great long-term investment. Not at first. His plan was actually super short-term. He saw the buyback announcement and he thought, hey, I can buy some stock now and then sell it right back to the company in a little while for a quick, easy profit. It's a classic Wall Street move called arbitrage. So he went out and bought 4.3 million shares, all with the idea of just making a quick buck. But then, as he was getting ready to sell, he got a little curious. He started reading up on this CEO, Bill Anders, trying to figure out what his whole game plan really was. And as he's reading, he has this sudden realization. This is Buffett's aha moment. As he said himself, his eyes just popped. He realized he wasn't looking at some simple financial trick. He was watching a masterclass in how to allocate capital. He saw a CEO who wasn't just managing a dying business, he was intelligently and methodically turning its assets into cash for the sole benefit of its owners. So right then and there, Buffett just throws his old plan out the window. The quick arbitrage trade was off. He decided he wasn't going to sell. He was going to become a long-term owner of General Dynamics because he suddenly realized where the real value was hiding. See, his bet totally shifted. He wasn't betting on fighter jets or nuclear submarines anymore. He was betting on Bill Anders. He saw a manager who was incredibly rational and completely focused on shareholders. He saw a company that was trading for less than it was worth on paper, its book value, and was generating tons of cash with a clear plan to unlock that value. The business itself was still terrible, but the guy running it was brilliant. And sure enough, Anders just kept proving Buffett right. He kept going. He sold the famous F-16 division to Lockheed. He sold the Space Systems unit to Martin Marietta. That brought in another $1.7 billion. And what did he do with all that new cash? He didn't build a fancy new headquarters. He mailed it directly back to shareholders with a huge $20 per share special dividend. So when you boil it all down, that's the real lesson of this incredible story. Buffett's bet paid off in a massive way, not because the defense industry suddenly got better, but because he was right about the management. He figured out that a truly rational, shareholder-focused CEO can sometimes be a more valuable asset than a great business. In the end, he bet on the jockey, not just the horse. Which leaves us with this one last really interesting question. It kind of challenges the conventional wisdom,
Buffett himself has famously said that when a manager with a reputation for brilliance takes on a business with a reputation for bad economics, it's the reputation of the business that stays intact. But this whole story, the General Dynamics story, it kind of makes you wonder, doesn't it? It suggests that sometimes, just maybe, the right manager can actually make all the difference.
Welcome to The Explainer. Today, we're digging into one of the all-time great investing stories. We're going to rewind the clock to 1990 to break down Warren Buffett's absolutely stunning, super controversial, and, well, ultimately legendary bet on Wells Fargo. This was a massive move he made when pretty much everyone else on the planet was convinced the bank was about to go up in flames.
All right, let's just soak this quote in for a second, because it perfectly captures the mood on Wall Street back then. And look, this wasn't just some random guy's opinion. This came from a top money manager for the Fishback brothers. These guys were the undisputed kings of short selling. When they said a company was toast, people didn't just listen, they ran for the exits. So when they called Wells Fargo a dead duck, they were basically writing its obituary.
So, to really get just how gutsy Buffett's move was, we need to paint a picture of the time. This wasn't just a little stock market dip, you know? This was pure, gut-wrenching panic that had its claws in the entire West Coast banking scene. Seriously, the question on every investor's mind wasn't if a bank was going to fail, but which one was going to be next.
And just look at how fast everything fell apart. The stock starts the year totally fine, trading up at $86 a share. But then the recession fears in California start to bubble up, and the selling begins. And then, bam, look at October. Short interest, which is just a fancy way of saying the amount of money betting against the stock, jumps by 77% in 1 month. That's basically the entire market screaming, "Get out now!" And the result? The stock got chopped in half from its high in just a few short months.
And right at ground zero for all this anxiety was Wells Fargo. The reason why was simple, and frankly, pretty terrifying. It had more money loaned out to commercial real estate. We're talking office buildings, shopping malls, than any other big bank in California. And think about it, in a recession, what's the first thing to get hammered? Those are the loans that stop getting paid. So, to the market, Wells Fargo wasn't just a little risky, it was sitting on a ticking time bomb.
But while the entire financial world was in a full-blown stampede for the exits, there was one guy way out in Omaha, Nebraska, who was calmly sharpening his pencil. He saw the same panic, he heard the same scary predictions, and he decided to do the exact opposite of everyone else.
In a move that left Wall Street's jaw on the floor, Buffett's company, Berkshire Hathaway, started buying. And he wasn't just dipping a toe in the water, no, he plunged in, investing an absolutely staggering $289 million. He was scooping up shares at an average price of under $58, miles below that $86 high from just a few months earlier.
And you really have to appreciate the sheer conviction here. This was no small speculative bet. With this one move, Berkshire Hathaway became the single largest owner of Wells Fargo. They now own 10% of the entire company. He wasn't just voicing an opinion, he was literally betting the farm.
Well, as you can imagine, this aggressive move instantly set the stage for an epic showdown. The source material calls it a heavyweight fight for the future of Wells Fargo, and that's exactly what it was. In one corner, you had the most famous, most respected investor on the planet, and in the other corner, you had pretty much everyone else.
The battle lines were drawn in the sand. In the bull corner, Warren Buffett, all by himself. And in the bear corner, a whole chorus of powerful voices, from the biggest short sellers to Wall Street's top analysts. And they weren't just disagreeing with him, they were openly mocking him. Some were even saying things like, well, he won't have to worry about who spends his fortune much longer. Ouch.
Now, the core fear, the thing that kept all the bears up at night, was this terrifying comparison to Texas. See, just a few years earlier, the Texas economy had absolutely cratered because of an oil crisis, and it took down its biggest banks with it. So now analysts were looking at California's wobbly real estate market and seeing the exact same disaster movie about to play out, and they cast Wells Fargo in the tragic leading role.
And when Tom Barton said he thought the stock was a teenager, let me translate that Wall Street code for you. He was predicting that the stock price, which had already been smashed down from its high of $86, was going to keep on falling, all the way down into the teens. We're talking $19, $18, maybe $15 a share. He was forecasting a near total wipeout.
So this brings us to the billion-dollar question, right? What on earth did Buffett see that all of these incredibly smart, successful Wall Street pros were missing? Well, to figure that out, we have to open up his playbook, because his way of looking at it completely ignored the market's panic and instead focused on just a few simple but really powerful ideas.
Okay, first things first, he looked at the management. Buffett has always said that banking is basically a commodity business. I mean, money is money, right? A dollar from one bank is the same as a dollar from another. So the only thing that really makes a difference is who's in charge. And he had huge respect for the CEO of Wells Fargo, a guy named Carl Reichert. He saw him as a rational, no-nonsense manager who was obsessed with keeping costs low. So obsessed, in fact, that Wells Fargo was a crazy 20 to 30% more efficient than its competitors. This guy wasn't trying to build a personal empire. He was just trying to make money for the owners.
And this leads to the most crucial point. Buffett was looking for something he calls earnings power. He essentially put on noise-canceling headphones to block out all the scary headlines and the terrible quarterly reports. He was asking a totally different question. If you strip away all this temporary real estate panic, in a normal year, how much money can this business actually make?
And this, right here, shows you the night and day difference between his view and the market's. The market looked at 1991 and saw the official number, a measly $21 million in profit. It looked like the bank was on life support. But Buffett looked at the exact same company and saw a financial engine that had the underlying power to churn out about $1 billion in profit.
So how could the numbers be so different? Well, to get ready for the recession, the bank had to set aside a huge amount of money for potential bad loans. We're talking over $2.5 billion. These were massive accounting charges that just wiped out their reported profits. Now, this totally terrified investors, but Buffett saw it differently. To him, this wasn't a sign of weakness. It was a sign of smart, prudent management preparing for a rainy day. These were just temporary charges on paper, not a permanent problem with the bank's ability to make money.
So, this whole way of thinking, focusing on the managers, looking for the real earnings power, and understanding the accounting, it all led him to his single most important rule. This is the bedrock principle of his entire philosophy, and it's what lets him act when everyone else is paralyzed by fear.
And that principle is the margin of safety. The idea is actually super simple, but it's incredibly powerful. You figure out what a business is really worth, its intrinsic value, and then you only buy it when you can get it for way, way less. It's like buying a dollar for 50 cents. It's not just about getting a bargain. It's about building in a giant cushion for error, just in case you're wrong or things get even worse. So let's do some of his quick back-of-the-envelope math. He looked at the last normal year, 1989, and saw the bank made about $600 million. Then he did a simple calculation to figure out what a business that earns that much is worth. His answer? About $6.6 billion. And get this, that was assuming the bank never grew its earnings again. It was a super conservative estimate. And this is what the panic-stricken market was willing to sell the whole company for, just $3 billion. For that price, you could buy everything, all the branches, the brand name, the millions of customers, and that $1 billion a year earnings engine. The price wasn't being set by logic, it was being set by pure fear.
And this is what Buffett's calm, rational math told him the business was worth, at a minimum. That gap between $3 billion and $6.6 billion, that wasn't just an opportunity. It was a canyon. It was one of the biggest disconnects between price and value that he had ever seen in his life.
And that's the whole ballgame right there. Warren Buffett could buy a business he thought was worth at least $6.6 billion for just $3 billion. He was getting it for a 55% discount. That was his margin of safety. Now, this is so important. He wasn't betting that there were no problems in real estate. Of course there were. He was just betting that the price he was paying more than made up for those problems. So, what does this whole story teach us? Well, it boils down to a few timeless lessons. Fear is what creates the gap between a stock's price and a business's real value. Our job is to tune out the noise, look right past the temporary problems, and find that true, durable earnings power. Because when you find a great management team, and the market is panicking and offering you their business at a massive discount, you might just be looking at the opportunity of a lifetime. And that really leaves us with one final thought, a question for you to ask yourself. The next time a crisis hits and the headlines are all screaming about doom and gloom, the crowd is going to be focused on one thing, all the risk. The real question is, will you be one of the few with the clarity and the courage to look for the discount?
What if I told you that one of Warren Buffett's greatest investments wasn't really a bet on a stock, but a bet on a single person? Well, today, we're going to unpack this incredible 30-year saga that really showcases two of his core principles, and it all revolves around one company, American Express.
And this quote right here, this is everything. It's the key that unlocks why he made a jaw-dropping $1.4 billion investment. See, for Buffett, American Express wasn't some new, flashy stock pick. Nope, it was more like an old friend, a business he'd been watching, studying, and learning from for decades.
Buffett's history with Amex goes way back, like 30 years before this big investment, back to the kind of crazy salad oil scandal in the 1960s. So while everyone else was panicking because a client had defaulted on loans that were supposedly backed by giant vats of salad oil that, well, didn't actually exist, what did Buffett do? He famously bet 40% of his entire partnership on the company. A move like that, man, it forces you to learn everything about a business, right down to its very DNA.
And that, right there, is the first big lesson. This whole thing didn't start with a hot tip from a broker. It started with a deep, long-term, almost intimate understanding of the business itself. So what was it about this business that he saw that made it so incredibly powerful?
So what was this powerhouse that Buffett saw? Well, at its heart, American Express wasn't all that complicated. It was just this beautifully simple and, more importantly, predictable money-making machine. And it was almost entirely driven by one single, dominant part of the company.
I mean, just look at this breakdown. It's kind of nuts, right? The part of the business that handled the charge cards and the traveler's checks, they called it travel-related services, or TRS. It wasn't just a piece of the pie. It was the pie. It made up almost 3/4 of all sales. This one division was the engine room of the whole operation. And that engine, it didn't just create profit on a spreadsheet. It absolutely gushed what Buffett loves to call owner earnings. You can just think of it as the real cash that's left in your wallet after you've paid all the bills and set aside some money for future repairs. Amex's card business was spitting out mountains of this stuff, which led to a billion-dollar question for the people in charge. What on earth are you going to do with all this cash?
Now that sounds like a pretty great problem to have, doesn't it? A fire hose of cash just spraying into your bank account. But here's the thing about a fire hose. It can do a lot of damage if you point it in the wrong direction. And for years, that is exactly what was happening at American Express.
The CEO at the time, James Robinson, he had a choice. He could take all that cash and give it back to the owners, the shareholders, or he could use it to build a bigger, more impressive empire for himself. He chose the empire. He fell right into a classic trap that Buffett calls the institutional imperative, this relentless, almost mindless need for a company to grow bigger, even if it means getting a lot worse.
So Robinson's big plan was to take that beautiful, reliable cash flow from the card business and build a giant financial supermarket. His first acquisition, a company called IDS, was fine. It worked out. But the second one, Shearson Lehman, was an absolute train wreck. It wasn't just a bad business, it became a financial black hole, literally sucking cash out of the healthy card business just to stay alive. And if you want to put a number on just how much damage was done, try $4 billion. That's how much of the shareholders' money got poured into the failing Shearson business over time. A company can only bleed out like that for so long before something's got to give, and in this case what gave was the leadership.
So finally, in 1992, the empire building came to a screeching halt. Robinson was out, and a new CEO, Harvey Galoob, was in. And Galoob's philosophy? It was the polar opposite of his predecessors. He wasn't interested in building an empire. He was interested in building real, actual value.
Galoob saw exactly what Buffett had been seeing for decades. The crown jewel, the absolute heart of the company, was the card business. He started using words like franchise and brand value, and he made it perfectly clear that the focus was shifting right back to that core. His mission was simple: cut away all the junk. And man, Galoob did not waste any time. Over just 2 years, he put on a clinic in how to clean up a messy corporation. First, he took the data division public, which brought in over $1 billion. Then, he sold off a money management arm for another $1.5 billion. And then, the big one. He finally dismantled that financial black hole, Shearson Lehman, freeing the real business from this massive anchor that had been dragging it down. So, okay, the company was being fixed, the fat was being trimmed, the focus was back on the card business, it's all looking good. But for Buffett to go from being a preferred shareholder to a massive common stock owner, he needed one last, final, undeniable sign of rationality from this new management team.
What could that possibly be? And here we go. This is the moment the whole story has been building towards. After all the cleanup, all the refocusing, Harvey Golub and his team did one thing that proved, beyond any shadow of a doubt, that they were now firmly on the side of the shareholders.
First, they set some really aggressive new financial goals for this new, leaner, meaner company. We're talking strong earnings growth and a fantastic return on equity. But it was the third part of their plan that was the real game changer, the one that got Buffett's attention.
In September of 1994, the board dropped a bomb. They announced they were going to buy back 20 million shares of their own stock. Now, this wasn't just some symbolic press release. This was a massive, confident bet on themselves.
And this was it. This was the ultimate signal of rational capital allocation. Instead of taking all that company cash and going out to buy another risky empire-building business, management was effectively saying, you know what? Our own stock, right here, right now, is the single best investment we can possibly make. They were investing in themselves.
That was the green light. That was the signal Buffett was waiting for. He finally had the combination he's always looking for, a fantastic business run by a rational management team. And he did not wait a second longer. He started buying. First, during that summer, he converted the preferred shares he already owned into common stock. Then, for the rest of 1994, he just went on an absolute buying spree on the open market. By the time he was done, he had built a monster position, 27 million shares at an average price of just $25 a share.
And as if to prove that Buffett had made the exact right call, the rational behavior just kept on coming. The very next spring, American Express doubled down, announcing an even bigger buyback, 40 million more shares. That was about 8% of the entire company. Management was right there with him, betting big on their own business.
So when you boil it all down, the lesson here is so clear. Buffett wasn't just betting on a great business. He was betting on something far, far rarer. A great business that was finally in the hands of a great, rational management team. See, one without the other is just potential. But when you get them together, that is a powerful, powerful combination for creating wealth. And that really leaves us with one final thing to think about. This whole story gives us the perfect lens to see it through. See, true growth creates value for the owners. Just getting bigger often destroys it. And the key to telling the difference, as Buffett showed us, is to just watch what management does with the cash.
You know, when you think of Warren Buffett, you think of simple, rock-solid investing rules. And for decades, one of his biggest was to stay away, like far away, from technology companies. So what on earth happened in 2011 that made him not just break, but absolutely shatter that rule in the most dramatic way possible? And this quote, I mean, it just says it all, right? For years, this was his stance. He saw the tech industry as this wild, unpredictable beast. You know, a hero one day could be a zero the next, all thanks to some new invention. He just couldn't see 10 or 20 years into the future with any certainty, and for him, if you can't do that, you don't invest, period.
And yet, he didn't just dip a toe in the water. No, he cannonballed into the deep end with a massive $10.8 billion bet. To put that in perspective, at the time, that was the single biggest chunk of money he had ever spent on one single stock.
And the company he picked? None other than the granddaddy of tech, International Business Machines, IBM. This move just sent shockwaves through Wall Street. Everyone, from top analysts to his own shareholders, was left scratching their heads, asking one simple question: why? So, in this explainer, we are going to crack this case. We'll look at the big paradox itself, the incredible turnaround that totally remade IBM, its secret financial weapon, the business mode Buffett actually saw, and then how he figured out it was a bargain. All right, let's dive in. Okay, so first things first, let's just lay out this paradox because it's a big one. By the end of 2011, Berkshire Hathaway had scooped up nearly 64 million shares of IBM. This wasn't some tiny speculative bet. This was a massive core holding that seemed to go against everything we thought we knew about the man and his methods. Now, the first major clue to understanding what Buffett was thinking is this. The IBM he bought in 2011 wasn't your grandfather's IBM, not by a long shot. It was a completely different animal, and that transformation was all thanks to two incredible CEOs. I mean, just look at this timeline. It is wild. Back in '92, IBM was basically on life support, losing a mind-boggling $5 billion. Then Lou Gerstner comes in and starts this long, painful shift away from making hardware to selling software and services. His successor, Sam Pemelsano, just slammed the accelerator on that plan, even selling off the iconic PC business. So by the time Buffett came along, this company was a completely remade, revitalized giant.
Okay, but the company turnaround, that was only half the story. Buffett himself said the other half was what he called simply brilliant financial management. It was a masterclass in making shareholders richer, not just by growing the business, but by being incredibly smart with its cash.
And when we say brilliant, just check out these numbers. It's kind of hard to wrap your head around. Over about 2 decades, these guys went out and bought back over half of the company's own stock. Think about that. Every share that was left automatically owned a bigger and bigger slice of the IBM pie.
And if you're wondering, well, how does that stack up? Just look. Compared to other tech giants, IBM's buyback strategy wasn't just aggressive, it was in a completely different league. The goal here wasn't just to grow the company, it was to grow the value of each individual share for its owners. And boy, did they succeed.
And this leads us to one of those classic head-scratching Buffett ideas that sounds totally backwards at first. While most of us are checking our phones hoping our stocks go up, 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 Buffett was hoping IBM's stock price would stay flat or even go down. Why on earth would he want that?
Well, let's walk through the math, because this is really the key to the whole thing. IBM had a $50 billion buyback plan. Now, if the stock is cheap, say $200 a share, that $50 billion buys up a ton of shares and Berkshire's piece of the pie grows to 7%. But if the stock is expensive, say $300, that same money buys way fewer shares and Berkshire's stake only grows to 6.5%. See? For a long-term owner, a cheap stock is a gift because it lets the company buy more of itself for you.
All right, so we've got this amazing financial engine running in the background. But what was fueling it? What was the actual business that made all this possible? Well, this is where Buffett realized IBM wasn't really a tech company anymore. It was a fortress of services.
Yeah, forget everything you've thought you knew about IBM. This wasn't about selling boxes anymore. By 2011, more than 80% of its business came from things like consulting and IT outsourcing. We're talking about essential, super sticky services that the biggest companies and governments in the world need to run their operations every single day.
And this is the moat Buffett was looking for. These are the qualities that make a business truly durable. The revenue is predictable. And once a company, like, say, a giant bank, has IBM running its entire IT backbone, the cost and risk of switching to someone else is just enormous. It's not like changing your phone plan. It's like performing open-heart surgery on your entire business. That's a fortress.
Okay, so at this point, Buffett's got it. He sees the real business. He loves the financial management. So what's the last piece of the puzzle? The price. Was it a good deal? He needed to find what he calls his margin of safety.
Well, that shift to services we talked about, it completely transformed the company's finances. We're talking a total night and day difference. Profit margins nearly doubled, return on equity went through the roof. The business wasn't just stable, it had become an absolute cash-generating machine.
And here it is, the grand finale. This is where it all comes together. Buffett paid about $169 a share, but when he did his own math, he figured the company was actually worth somewhere closer to $300 a share. To put that another way, for the price he paid to just break even, IBM's business barely had to grow at all, like 2% a year. He was convinced it could do way, way better than that. It was a huge margin of safety. He was buying $1 for 60 cents. So you see, when you look at it this way, it wasn't some crazy, out-of-character move at all. It was classic Buffett through and through. Just like with Coca-Cola, he found a wonderful, durable business that the rest of the market just wasn't looking at correctly, and he got it at a great price.
So let's bring it all home. Let's go back to that original question. Why on earth did the world's biggest tech skeptic bet the farm on a tech company?
The answer is, he didn't. He never broke his own rules. Not really. He just looked right past the tech label and saw the actual business underneath. A steady, predictable, cash-gushing services giant with fantastic management. He didn't bet on technology, he bet on a fantastic business.
And you know, Buffett actually explained it perfectly himself, using this quote from Thoreau. He said he'd been reading IBM's annual reports for 50 years, but one day he finally stopped just looking at it as a tech company, and he actually saw it for the services fortress it had become. It was an epiphany hidden in plain sight.
Which, of course, leaves us with a really interesting question to chew on. In today's world, with all the noise about disruption and the next big thing,
What incredibly stable, predictable, and maybe even boring businesses are right there in front of us that we're all looking at but not really seeing?
So back in 2013, Warren Buffett goes and makes this massive, multi-billion-dollar bet on ketchup. Yeah, I know. It sounds almost ridiculously simple, right? Kind of boring even. But trust me, the way this deal for H.J. Heinz went down, it was one of the most fascinating moves of his entire career. So the real question is, what did the world's greatest investors see in a simple bottle of ketchup that pretty much the rest of the market was missing? Well, let's deconstruct this thing. All right, so to really get this deal, you got to first understand something crucial about Warren Buffett. The man loves boringly predictable companies. While everyone else is chasing the next flashy tech stock, Buffett's out there looking for businesses that are just simple, consistent, and easy to wrap your head around. I mean, there's this great story where years ago, some analyst described IBM as boringly predictable. And Buffett said that was the highest compliment he could imagine. That's the key right there. And that kind of stability, a business that just keeps on churning out profits year after year, that's exactly what he saw in Heinz. And look, for that kind of predictability, he was willing to pay up, big time. Together with their partner, a firm called 3G Capital, Berkshire Hathaway slapped $23 billion on the table for this food giant. This wasn't just another stock pick, you guys. This was a monumental, take the whole company private kind of deal.
But here's where it gets really interesting. They didn't just pay what the market thought it was worth. Nope. They paid $72.50 a share. That was a full 20% premium over what the stock was trading at the day before. That is such a bold move. It's basically like Buffett and his partners were shouting from the rooftops to the entire market, hey, you are all fundamentally undervaluing this business, and we know exactly why.
So, yeah, that begs the big question, right? What on earth did Buffett see that everyone else was missing? I mean, why would you pay a 20% premium for a ketchup company? The answer, it turns out, really gets to the core of his whole investment blueprint. And believe me, it's about way more than just condiments.
Okay, so the first piece of the puzzle here lies in two of Buffett's most important rules: a long, steady history and a clear path for future growth. And man, did Heinz check both of those boxes.
You have to appreciate just how deep Heinz roots go. This company was founded way back in 1869, and they brought out that iconic ketchup we all know just a few years later, in 1876. Just to put that in perspective for you, Buffett's own great-grandfather started a grocery store the very same year H.J. Heinz was getting started. It's crazy. So, we're not talking about some flash-in-the-pan startup here. This is a multi-generational institution. And that kind of staying power, that brand, that is exactly the kind of thing Buffett loves to see. But look, a great history is only half the story, right? A company can have this amazing past and still have a totally shaky future. For Buffett, a deal like this only makes sense if there are also really good long-term prospects. So the big question on the table was, okay, great history, but where's the future growth going to come from?
And the answer, it turns out, was in emerging markets. See, by 2013, a full 25% of all of Heinz's sales were already coming from these super high-growth regions. They'd been quietly making these really smart moves, buying up companies like Foodstar in China and taking a big stake in a Brazilian food company. They were perfectly positioned to sell to this rising global middle class.
Okay, but this next part, this is the real kicker. When you actually break down where their sales growth was coming from over the last 5 years, a staggering 80% of it was coming from those emerging markets. This wasn't just some little side trend. This was the main engine driving the entire company forward. And all of a sudden, Heinz starts to look less like this old, boring American company and a lot more like a dynamic, global growth story.
So, okay, the story is fantastic, but for a guy like Buffett, a good story is never, ever enough. At the end of the day, he's a numbers guy. So the next step was to basically ignore the stock price on the screen and ask a much more fundamental question. What is this business actually worth? It was time to calculate its intrinsic value.
And to do that, he uses this special metric that he pretty much made famous. It's called owner earnings. The easiest way to think about it is it's the real honest-to-goodness cash flow of the business. It's the cash that's left over after you've paid all the bills and you've put enough money back in to maintain the business, to keep things humming along. And for Heinz, once you backed out some one-time weird expenses, that number was sitting right around $1 billion a year. A cool billion in cash. From there, the process is actually pretty straightforward, at least in theory. So you start with that $1 billion in owner earnings. Step 2. You try to figure out how fast that billion is going to grow in the future, thanks to all that emerging market stuff. And then step 3, you take all that future cash and discount it back to figure out what it's all worth in today's money. And guess what? When they actually ran the numbers, the whole story held up beautifully. Even if you were super conservative, assuming just 5% growth forever, the math said the shares were worth about $82. And remember, they were paying $72.50. That right there is what Buffett calls his margin of safety. In this case, about 12%. And if you were just a little more optimistic, still totally reasonable, by the way, the value jumped to over $96 a share. So yeah, no matter how you sliced it, the math worked. But buying a great company at a good price, that was only half the story here. The real genius, the absolute masterstroke, was in how they put the deal together. This is where it gets really, really clever. So check this out. Here's how they structured it. Berkshire and their partner, 3G, each kicked in $4 billion for the regular stock, the equity. That gave them a 50-50 ownership split of the company. But then, and this is the key part, Buffett put in another $8 billion, but not as an owner. This time, he was basically acting like a bank, a high-interest lender, using something called preferred stock. And man, this preferred stock was just loaded with all these incredible perks, these sweeteners. First off, it paid a guaranteed 9% dividend every single year. That's $720 million in cold hard cash flowing into Berkshire's bank account, like clockwork. Second, there was a big bonus payment they were going to get down the road when the stock was eventually redeemed. And third, they got things called warrants, which are basically like super cheap lottery tickets that gave them the right to buy another 5% of the entire company for next to nothing. I mean, what an unbelievably sweet deal for Berkshire. So what does all this mean? It means when you look at Berkshire's total $12 billion investment, their blended return was 6% a year, right from day one. And get this. That's before you even count the value of those warrants, or the bonus premium, or any of the upside from their actual ownership stake. The deal was structured to be a winner right out of the gate. This whole setup created this incredible safety net for Berkshire. See, that preferred dividend, legally, it had to be paid before any of the common stockholders, like their partner 3G, saw a single penny. So Berkshire was always first in line to get paid. Even if Heinz went through a really tough time, Berkshire was still going to get its check. It's the perfect example of Buffett's all-time favorite investment setup. Heads I win, tails I don't lose much. Okay, so at this point, this whole thing sounds like a perfect textbook Buffett investment, right? But there was a twist. The deal actually had 2 pretty big things about it that were, well, really unusual for a Berkshire Hathaway deal. So, was this a perfect classic Buffett deal after all? Well, in 2 really important ways, the answer was, surprisingly, no. All right, first, the deal used a ton of debt. Buffett is famous for warning people about using too much leverage, but the new Heinz was absolutely loaded with it. We're talking something like $6 of debt for every $1 of equity. And the second thing was management. Buffett's classic move, his MO, is to buy a great company and then leave the management team alone to do their thing. But here, the plan from the start was to bring in a completely new team from his partner, 3G Capital. So what gives? Why the big change in philosophy? Well, it all came down to a massive amount of trust in his partner. You see, the new team was going to be led by Jorge Paulo Lemann, this brilliant Brazilian investor who Buffett had known and really respected for years. They'd served on the board of Gillette together back in the day. Lemann's firm, 3G, had this incredible track record of buying companies and just running them with ruthless efficiency. So this wasn't some blind bet on a new management team. It was a very calculated bet on a proven world-class winner. So when you put all the pieces together, you've got a great brand, a clear growth story, a good price, and just a brilliantly clever deal structure. You can totally see why this deal happened. But those couple of ways it strayed from the classic Buffett playbook, well, that leaves us with one last, really fascinating question. So was the Heinz deal just a one-off masterpiece, something that was only possible because he had this unique partner and a perfect opportunity? Or did it signal a real evolution in his strategy, a brand new playbook for Berkshire's next chapter, one where they'd team up with partners and use leverage to go after even bigger and bigger deals? That's the multi-billion-dollar question this deal left for the entire investment world to chew on. All right, let's jump right in. We're going to break down the investment playbook of an absolute legend. But first, we've got a little puzzle to solve.
It's one that ties together some huge brands you definitely know, and it uncovers a really powerful, kind of surprising strategy.
So let's get right to it. What do Burger King, ketchup, and beer all have in common? I know it sounds like the start of a bad joke, right? You've got Burger King, Heinz ketchup, and Anheuser-Busch beer. On the surface, they've got nothing to do with each other, but they're all linked by this one single, totally ruthless and, well, incredibly successful investment philosophy.
So to really get this, you gotta look at what went down when the investment firm 3G Capital bought Burger King back in 2010. I mean, their approach was radical. Within weeks, they fired half the people at headquarters, gone. They sold off the fancy corporate jet, the executive offices, the whole shebang. They got so granular with cost cutting that managers actually needed to get permission just to make a color photocopy. Can you believe that? And the result? Well, profits doubled. Cash flow went through the roof. This wasn't just trimming the fat. It was like a complete rewiring of the company's financial DNA. And that right there is the answer. The common thread is a long-term vision. See, 3G Capital's crazy cost-cutting, it wasn't about making a quick buck and flipping the company. Nope. They and their frequent partner Warren Buffett look at companies like Burger King, Heinz, and Anheuser-Busch as these massive platforms to own and grow for decades. They're not just buying a company, they're basically buying an entire industry. And of course, this whole philosophy is captured perfectly by Buffett's most famous line, right? My favorite holding period is forever. When you start thinking like that, holding forever, it completely changes the game. It's not just about what you buy anymore, it's about how you manage every single thing you own. Okay, so this whole idea brings us to a huge problem that really every single investor faces. For most of us, the investing world feels like this constant tug of war between two main strategies, and it feels like there are only two choices. So on one side of the rope, you've got your active portfolio managers. You know the type. They're constantly buying and selling, juggling hundreds of stocks, always trying to guess the market's next little move so they can beat the average. Then on the other side, you have index investing. This is the total opposite. It's a passive, buy and hold kind of thing where you just own a big basket of stocks. The goal isn't to beat the market, just to match it. But here's the funny thing. Even though they seem like polar opposites, they actually share a core belief. Both of these strategies are trying to make you feel safe by spreading your money out over a ton of different stocks. The logic is simple, right? If you own a tiny piece of everything, then no single company going bust can totally wreck your portfolio. But does that conventional wisdom actually hold up? Let's look at the numbers. Over a 30-year period, almost 60% of professional active managers, I'm talking about the people who get paid millions of dollars to pick stocks, failed to beat a simple plain vanilla index fund. All that work, all that buying and selling, and for what? Worse results. So what's the unavoidable outcome here? Mediocre results. Just meh. By trying to own a little bit of everything, yeah, you've probably protected yourself from a total wipeout, but you've also pretty much guaranteed you'll never hit it big. You've diversified away the risk, sure, but you've also diversified away any chance of amazing returns. It's a strategy that some people cleverly call diversification. And this is where Warren Buffett steps in with this powerful third option. It's an alternative for what he calls the know-something investor. You know, someone who's actually willing to put in the work, do the homework, and get a real edge. He calls it focus investing, and it's pretty much the exact opposite of what everyone else tells you to do. The idea is actually really simple, but it's so powerful. Instead of owning 100 so-so companies, you find a few, just a handful of truly spectacular ones. Then you concentrate your money in them, and you have the discipline to just sit back and hold on for the long, long haul. And Buffett is super blunt about this. He basically says, if you're an investor who can actually understand how a business makes money, then spreading your cash thinly across a bunch of average companies is just a huge mistake. It's like admitting you have no idea what you're doing. But look, this isn't just some gut feeling Buffett has. There's real logic behind concentrating your bets. Let's dig into why it works, because there's a serious intellectual and even mathematical foundation to this whole thing. The whole strategy really stands on three main pillars. First up, you've got the wisdom from another investing legend, Philip Fisher, who always said you should own a few great companies you know inside and out. Second, it's just basic probability, right? It makes sense to put most of your money where your chances of success are the highest. And third, it's actually backed by some pretty serious math.
There's this formula from information theory called the Kelly criterion, which helps figure out the perfect amount to bet when the odds are in your favor. You know, a really easy way to wrap your head around this is the blackjack analogy. Imagine you're at the table, the dealer's showing a bad card, and you know the deck is packed with face cards. Are you going to make a tiny minimum bet? No way! The odds are stacked in your favor, so you bet big. And from this point of view, investing is exactly the same. And this really gets to the heart of what Philip Fisher was talking about. I mean, think about it. Why on earth would you want to own your 50th best idea when you could just put more money into your number 1 best idea? It's all about focusing your brain power and your cash where they're going to make the biggest difference. Okay, so this all sounds pretty good in theory, doesn't it? But what does it actually look like in the real world? How do you do it? Let's break down the actual practical steps for building a focused portfolio. First thing, how many companies are we talking about? Well, the ideal focused portfolio has just 5 to 10 businesses. That's it. Think about that. Only 5 to 10. It's an incredible filter because it forces you to say no to almost everything. You only invest in your absolute highest conviction ideas. We're talking about those amazing businesses with what Buffett calls moats, durable competitive advantages that keep competitors away. It takes serious discipline. Second is conviction, and this one's a biggie. For every single stock you decide to buy, you need to have the confidence to put at least 10% of your entire net worth into it. Just let that sink in for a second. That is a very high bar. What it means is, if an idea doesn't make you want to bet big, then it's probably not a bet you should be making at all. It just automatically weeds out all the mediocre ideas. And number 3, your time horizon. This strategy just plain doesn't work if you're a short-term thinker. The suggested minimum holding period is 5 years, but like we said, ideally, it's forever. And that long-term view is so important because it gives the actual business enough time to do its thing, and for that performance to shine through, separating the real results from all the day-to-day noise of the market. And I can't stress this enough. This point is absolutely critical. In the short run, stock prices are all over the place. They're driven by fear, by greed, by headlines, just random noise. But over 5, 10, or 20 years, a stock's price is always going to follow the success of the actual business. So patience isn't just a nice little virtue here. It is a strategic necessity. So let's tie this all together. What's the big takeaway? Well, the core message of focus investing is that it completely flips the idea of risk on its head. Conventional wisdom screams at you that putting all your eggs in a few baskets is super risky. But Buffett's logic says, no, wait a minute. For the investor who really understands what they own, the real risk is diversification, owning so many average companies that you completely kill your chances for great returns. For the know-something investor, concentration isn't risk, it's opportunity. And so that leaves us with one last really important question for you to think about. Take a hard look at your own portfolio. Is it actually diversified in a smart way? Or is it just diversified? Is it just a big collection of average ideas that, yeah, protects you from losing it all, but also guarantees you'll never, ever have those big wins? Answering that one question honestly, well, it just might change how you invest forever.
Welcome to The Explainer. Today, we're digging into the powerful mathematical and psychological framework behind one of the most successful and, honestly, one of the most demanding investment strategies out there, focus investing. This is a strategy that requires more than just financial smarts. It demands a totally different way of thinking about risk, reward, and, well, yourself.
Focus investing is, famous for its bumpy ride. We're talking about those gut-wrenching swings that can make you question every single decision you've ever made. And as the investing legend Charlie Munger points out right here, the number one skill you need isn't some complex financial formula. It's psychological fortitude. It's about having the stomach to ride those waves without smashing the panic button.
So where does that kind of mental toughness come from? I mean, are you just born with it? Not really. The real secret to ignoring the market's day-to-day craziness isn't just about being tough. It's a disciplined way of thinking. It all comes down to their ability to think in probabilities, to see past today's stock price and focus on the long-term mathematical odds of their investments.
To really nail this down, we're going to break down their entire framework. We'll start with the essential mindset. Then we'll get fluent in the language of risk, which is probability. From there, we'll check out a formula that tells you exactly how much to bet, see how it all plays out with a great analogy from the racetrack, and finally, we'll tie everything back to the psychology of making truly great decisions.
All right, let's jump into our first section, the mindset of the masters. It all kicks off with the perspective on the market that, frankly, is the complete opposite of how most people think about investing.
So here it is, the core trade-off. Focused investors don't try to get rid of volatility. They accept it. They see it as a necessary cost of doing business. They know the ride is going to be bumpy, but they have this deep-seated belief that over the long haul, the solid economics of the companies they own are going to win out. They're betting that the tree, in the end, is going to grow way taller than any storm. Munger's insight from his poker days is just the perfect parallel. Look, in poker, you don't win by playing every single hand. No way. You win by folding and folding and folding, patiently waiting for that one rare moment when the odds are just massively in your favor. And when that moment finally comes, you don't just toss in a few chips, you bet heavily. That exact same discipline is what separates the greats in investing.
Okay, so how do you actually spot those huge odds Munger's talking about? It's not about gut feelings, and it's definitely not about hot tips from your buddy. It means you have to master the language of risk. And that language for centuries has always been the same. It's probability.
When you get right down to it, every single investment decision is an exercise in probability. Think of the stock market as this giant, messy warehouse filled with countless unknowns. The investor's job is to rummage through all that uncertainty, find what is least unknown, and then try to quantify the chances of a good outcome. And probability gives us the scale from 0 to 1 to do exactly that.
What's really cool is that the tools for this aren't new at all. They were actually developed centuries ago by mathematicians like Blaise Pascal and Pierre de Fermat, who were trying to figure out problems for gamblers. They laid the groundwork, and then later, a guy named Thomas Bayes built the system for putting it all into practice.
Now, the key tool that came out of all this thinking is something called Bayesian analysis. And listen, don't let the name freak you out. At its core, it's just a really structured way of changing your mind. You start with a belief, but then as new facts and evidence roll in, you systematically update your odds. It's basically the perfect weapon against being stubbornly wrong.
Let's make this super simple. Imagine you bet your friend that you can roll a 6 with one regular die. Before you roll, your odds are crystal clear. You have one chance out of 6. That's about a 16% shot at being right. But now, your friend rolls the die, cups their hand over it, peeks, and gives you a little clue. Hey, it's an even number. Well, right away, the numbers 1, 3, and 5 are gone. They're off the table. Your world of possibilities just shrank in half. And that one tiny piece of new information just doubled your probability of winning to 33%. Then they give you one final clue, and it's not a 4. Boom, your odds shift again. Now you're down to just 2 possibilities, a 2 or a 6. Your chance of being right has jumped all the way from 16% to a 50-50 shot. This simple, step-by-step process of updating your beliefs based on new evidence, that's the absolute heart of Bayesian thinking.
And right there is how this whole thing connects directly to investing. Warren Buffett himself is basically describing his job as a non-stop Bayesian exercise. He is constantly weighing the probability of an outcome against how much he could gain or lose. It's not a perfect science, he'd be the first to tell you, but it's the fundamental logic of the game he plays.
Okay, so knowing the odds is step 1. Huge. But step 2 is just as critical. How much capital do you actually put on the line? I mean, if you think you have a 70% chance of being right, do you bet a little or a lot? For that answer, we go back once again to a formula that came from the world of gambling. This is the Kelly optimization model. It's a really powerful little formula that gives you a precise mathematical answer to that "how much should I bet?" question. It creates a direct link between your level of confidence, your probability, and the exact percentage of your money you should invest to get the fastest growth over the long run. Whoa, look at this table. The Kelly model is not messing around. Just look at this. If your probability of winning moves from 55% to 75%, which doesn't seem like a huge jump, the formula tells you to quadruple your bet size, from 10% of your bankroll to a massive 40%. It's built to force you to bet heavily when you have a real edge. And if you're 100% certain, it says bet the house.
But, and this is a huge but, here's the critical warning. The real world is a messy place, and our estimates of probability are never, ever perfect. The single biggest danger here is being overconfident. If you misjudge the odds and overbet, you can go broke. You risk total ruin. That's why the smart, practical solution is to build yourself a margin of safety. A lot of pros use what's called a half-Kelly approach, betting only half of what the pure formula tells them to. All right, now let's look at what might be the single best analogy for tying all of this together. It connects probability, odds and price absolutely perfectly. And it comes, of course, from Charlie Munger, who famously said the stock market isn't a casino, it's a racetrack.
Munger's specific analogy is a pari-mutuel racetrack. Now, that's a system where the odds aren't fixed. They actually change based on how the crowd is betting. So everyone at the track can see the favorite horse, right? The one with the amazing record. But because it's the favorite, so much money gets bet on it that the payoff odds shrink down to almost nothing. In that situation, the best horse is very often the worst bet.
So here's the big insight, the thing you have to get. You have to separate the quality of the asset from the price you pay for it. A fantastic company that's trading at some astronomical price is just like that champion horse paying 3-2 odds. It might be a really bad bet. The most sensible, profitable strategy is to wait patiently for a high-quality opportunity when the market, for some reason, is offering you very inviting odds.
And this brings us right to the final and, maybe the hardest piece of the whole puzzle. It's one thing to understand all the math, but it's a completely different challenge to have the psychological discipline to actually act on it. This is where the cold, hard logic of the formulas slams right into our own messy human nature.
The racing analyst Andrew Bayer came up with a perfect model for this. He divides bets into two types. First, you have prime bets. These are those rare, beautiful moments when your analysis gives you high confidence and the market is offering you favorable odds. That's when you bet seriously. Everything else, that's just an action bet, a little wager you make to scratch that psychological itch to play. The single greatest danger for any investor is confusing an action bet for a prime one.
So, let's just end on this thought. The mathematics of probability and bet sizing are unbelievably powerful tools. But without discipline, they are totally useless. The ultimate challenge isn't doing the math. It's having the patience to wait, sometimes for years, for a true prime bet to show up, while you ignore that constant nagging itch for action. So the real question to ask yourself is, which game are you actually playing?
So what if I told you there's a small group of investors, all from the same intellectual background, who consistently, and I mean spectacularly, beat the stock market for decades? Their success isn't just some story about getting rich. It's a full-on challenge to one of the biggest, most fundamental theories in all of modern finance. To really get how they did it, we have to start right here with this core idea from Benjamin Graham, who's basically known as the Dean of Wall Street. What he's saying is that in the short term, stock prices are just a popularity contest, a voting machine. But over the long haul, what really matters is the true, measurable weight of a business. This one concept, it's the key that unlocks absolutely everything we're about to get into.
All right, so how are we going to unpack this whole thing? Here's the plan. We'll kick things off with a famous speech that really shook up the academic world. Then, we'll uncover the simple but incredibly powerful strategy these investors all shared. We'll look at their amazing track records and then see how the hard data actually backs them up. And finally, we're going to completely redefine what risk really means and lay out the mindset you need to think just like they do.
Okay, so picture this. The year is 1984. Warren Buffett, who is probably Benjamin Graham's most famous student, is standing in front of a pretty skeptical crowd of academics at Columbia University, and he's about to quietly, but completely, demolish the theory that they all hold sacred. See, back then, the big idea in academia was something called the efficient market theory. It basically said that all the information out there is already reflected in a stock's price, so it's impossible to consistently do better than the market averages. If you did, hey, you just got lucky. But Buffett stood up and presented a group of investors from what he called the intellectual village of Graham and Doddsville. They all learned from the same guy, Ben Graham. They all had totally separate portfolios, but they all crushed the market for decades. This, he argued, just couldn't be luck. So what was this secret sauce? What was the shared discipline they all had? Well, it wasn't just about finding cheap stocks. It was a two-part philosophy that really went against everything conventional Wall Street wisdom was preaching at the time. First, and this is absolutely the bedrock of it all, they all looked for a margin of safety. This is Graham's #1 rule. It means you don't just buy good businesses. You have to wait patiently until you can buy them at a price that is way below what they're truly worth. That discount, that's your buffer. That's your protection against being wrong or just having bad luck. And this quote from Buffett's partner, the brilliant Charlie Munger, just perfectly captures the second part of their secret. You see, when these rare opportunities popped up, a great business at a fantastic price, they didn't just dip their toe in. No way. they bet big. They concentrated their money in their absolute best, highest conviction ideas.
Now, this isn't just some nice-sounding theory. The proof is in the performance. Let's take a look at the actual real-world track records of some of these legendary focus investors.
And you might be surprised who we're starting with. It's not some modern Wall Street hotshot, but the world-famous economist John Maynard Keynes. Turns out he managed the endowment fund at King's College, and he believed it was a huge mistake to spread your money too thin across a bunch of companies you barely know anything about. Instead, he wanted to put his full confidence and his capital in just a few select holdings. The results of this approach were, frankly, staggering. Over an 18-year period, a period that included the Great Depression and World War II, mind you, Keynes delivered an average annual return of 13.2%. And during that same time, the broader UK market went absolutely nowhere. It was an incredible achievement, and it was all built on concentration. Okay, now let's jump forward to 3 of the modern super investors that Buffett himself pointed to in that 1984 speech. All of them, Charlie Munger, Bill Ruane, and Lou Simpson, were students of Graham's ideas, and they were all hardcore practitioners of this concentrated, low-turnover, focus investing style. What these numbers really show you is the sheer scale and, just as important, the longevity of their outperformance. I mean, look at Munger. He beat the market by a crazy 18 percentage points per year for over a decade. Ruane and Simpson also put up market-beating numbers for over 20 and even 40 years. And the kicker? They all did this by typically holding fewer than 15 stocks. Now, a skeptic might look at Keynes, Munger, Ruane, and Simpson and say, okay, that's impressive, but it's just a few examples. Maybe they were just lucky statistical outliers. And you know what? That's a totally fair question. So to answer it, we have to move on from just stories and dig into a large-scale statistical analysis.
So, a study was designed to do just that. Researchers took about 1,200 companies and then used a computer to randomly build 12,000 different portfolios. They split these into 4 groups: big, diversified ones with 250 stocks, some with 100, some with 50, and then a focus group with just 15 stocks each. The whole goal was to see which type of portfolio actually had the best chance of beating the market. And the results were stunning. Seriously, if you held one of those super diversified portfolios with 250 stocks, your chances of outperforming the S&P 500 were just 1 in 50. That's only 2%. But, and this is the amazing part, if you held a concentrated 15-stock portfolio, your odds of beating the market jumped all the way up to about 1 in 4, or 27%. The data is pretty clear. Concentration dramatically increases your probability of outperformance. This brings us to what is, maybe, the most important mental leap you have to make to become a focused investor. This isn't just about a strategy you can copy. It's about completely rewiring how you think about the word risk. And here's the critical difference. Academia and Wall Street define risk as volatility, the ups and downs of a stock's price. To them, a bumpy ride is risky. But Buffett and the other super investors, they have a completely different definition. To them, the only risk that really matters is the risk of a permanent loss of capital, the risk that the actual business you've invested in is going to fundamentally fall apart. And believe me, this distinction isn't just academic, it is the key to survival. Just look at this timeline. Every single one of these legends went through these agonizing multi-year periods where they lagged the market badly. Bill Rohn's Sequoia Fund underperformed for 4 years in a row. I mean, can you imagine? If they had defined risk as just price volatility, they would have been forced to panic and sell at the absolute worst possible moment. But their focus on business value let them hold on.
So, to break free from the madness of watching daily price quotes, Buffett suggests using a different measuring stick. He calls it look-through earnings. Think of it this way. Imagine you're a part owner of a local coffee shop. You wouldn't measure your success by what some stranger offers to pay for your share each day, would you? Of course not. You'd measure it by your share of the actual profits the shop is making. This forces you to adopt a long-term business owner's perspective.
So what does it really take to put all of this into practice? We've seen the strategy, we've seen the results, but the final and honestly the most important piece of the entire puzzle isn't analytical at all. It's psychological. These are pretty much the core tenets that bind all of these super investors together. It's a commitment to seeing stocks as pieces of a business, not as lottery tickets. It requires a long-term horizon and
Crucially, the right temperament, being patient, independent, and emotionally detached from all the daily noise. You have to be willing to do the hard work to understand your few investments better than almost anyone else out there. And Buffett, the man who kicked off this whole conversation, he just summarizes it perfectly. He has always said that investing isn't a game where the person with a 160 IQ automatically beats the person with a 130 IQ. As this quote shows, success is ultimately determined not by how smart you are, but by your emotional discipline. Which really brings us to our final question, and it's one that's worth thinking about long after this is over. When you look at your own investments, what do you really see? Is it a flickering list of prices and symbols driven by the day-to-day fear and greed of the crowd? Or is it a carefully selected collection of real businesses whose long-term success will ultimately be weighed, not just voted on? So, the stock market. We think of it as this big, complicated battlefield of numbers and news, right? But what if I told you that the biggest threat to your wealth isn't a market crash or a recession, but something a whole lot closer to home? Today, we're going to dig into a story that might just change how you see investing forever. Seriously, think about it for a second. What's the thing that really keeps you up at night as an investor? Is it a sudden crash that just vaporizes your portfolio? A long, grinding recession? Or maybe just that classic fear of picking the absolute wrong company to invest in? And look, those are all real fears. But what if the true enemy is a blind spot you never even knew you had? Yeah, because what if the greatest risk isn't out there in the market at all? What if it's right here, inside our own heads? That's exactly what we're diving into now, the investor's inner enemy. Okay, so here's the kicker. It's not the stock market. According to the absolute master of finance, Ben Graham, the person most likely to mess up your financial future is you. It's a shocking idea, right? But he argued it's not the market's craziness that gets us, it's our reaction to that craziness. And that one little shift in perspective changes absolutely everything. This quote just hits the nail on the head, doesn't it? We have this picture of finance as this super logical world of spreadsheets and cold, hard data. But the second we humans step into the arena, we bring all our messy emotions with us. Fear, greed, all our biases. Our behavior becomes, well, exactly like the quote says, erratic, contradictory, and occasionally goofy. It's a very human game. And this whole idea is so powerful, it actually spawned its own field of study called behavioral finance. It's this amazing blend of economics and psychology that tries to explain why we do the irrational things we do with money. It's why we get that urge to buy high out of FOMO and then panic sell when everything's crashing. And the really wild part? Decades before this field even had a name, Ben Graham was already all over it. So who was this guy, Ben Graham? Who was this person who totally understood the human side of things way, way before almost anyone else? Let's get into his timeless wisdom to see how he figured this all out, and more importantly, how he gave us the tools to fix it. Okay, so Ben Graham, this guy is an absolute giant in the investing world. They call him the father of financial analysis. He literally wrote the book on how to value a company. But his real genius, the part people sometimes miss, was his incredible grasp of psychology. He knew you could be the world's best mathematician, you could have the most amazing spreadsheets, but if you couldn't control your own emotions, you were gonna fail, period. Now, Graham's most famous student, you've probably heard of him, Warren Buffett, he actually boiled down his mentor's entire philosophy to these 3 core ideas. First, you gotta see stocks as what they are, tiny pieces of an actual business, not just blinking lights on a screen. Second, always invest with a margin of safety to protect your downside. But it's that third one, that's our focus today, and it's the one that changes the whole game, having the right attitude. And just listen to what Buffett says about this. The advantage you get is enormous. He's not talking about a small edge here. He's saying that the right mindset, just the right attitude, puts you ahead of 99% of everyone else playing the game. It's not a secret stock tip. It's a way of thinking. And that is a huge, huge advantage. Okay, but how do you actually teach an attitude, right? It's not like a math formula you can just write down. It's a mindset. So Graham, being the genius he was, did something, well, brilliant. He didn't just write another chapter in a textbook. He created a story, a powerful little story to make this lesson stick. He invented a person, a character that was designed to be the perfect embodiment of the market's wild, emotional roller coaster. Also, he could teach us how to deal with it. All right, so let's meet him. Let's meet this character. His name is Mr. Market. and he is about to become your brand new and probably most difficult business partner. So here's the deal, and it's actually really simple. Just imagine that you co-own a private business with this guy named Mr. Market. And every single day, no matter what, he knocks on your door with an offer. He'll either buy you out of your share of the business, or he'll sell you his half. And here's the key. He's the one who names the price for that day. But, of course, there's a catch. As you're about to find out, your new partner has some, let's just say, some pretty serious personality quirks. To be blunt, the guy is a total manic-depressive. Now, here's the really important part. The actual business you own together is rock solid. It's stable, its value doesn't just change wildly day to day. The problem isn't the business, it's your partner, Mr. Market. He is completely emotionally unstable. His opinion of what the business is worth is totally unhinged from reality. His prices are driven purely by his crazy mood swings. Some days, this guy is just completely euphoric. He's on top of the world, sees nothing but blue skies and sunshine. That's Mr. Market in a bubble, and he'll offer you some crazy, sky-high price for your share. But then on other days, total despair. He's convinced the world is ending and everything is doomed. That's him in a crash, and he'll come to you with a price so low it's basically a joke. But Mr. Market has this one other key trait, and this is where all your power comes from. He absolutely does not care if you ignore him. He has no ego. If his price today is ridiculous, too high or too low, you just say no thanks, buddy, and shut the door. He won't get mad. He'll just come back tomorrow, completely cheerful or completely miserable with a brand new price. So, all of this brings us to the real punchline of the story. It's not just about knowing that Mr. Market is moody. It's about understanding what his job is in your financial life. And it all comes down to his pocketbook, not his wisdom. And this line from Graham just says it all perfectly. It is Mr. Market's pocketbook, not his wisdom, that is useful. Think about that. He is there to serve you, not to guide you. You should never, ever, ever mistake his daily price for what the business is actually worth. His moods create opportunities. That's his useful pocketbook. But his opinion? Totally worthless. So this is it. This is your massive advantage as an investor. You have the total freedom to just ignore him. You hold all the cards. Your only job is to do your homework, figure out what the business is really worth on your own, and then just wait. You buy from him when he's terrified and selling things for cheap. And you sell to him when he's giddy and offering you a fortune. You get to use his irrationality to your rational advantage. And that leaves us with one last really important question. Because Mr. Market is always out there, every single day, screaming a price. So, the next time he's in a total, full-blown panic, what are you going to do? Are you going to get swept up in his fear? Or, now that you know the story, will you see him for what he is, your manic, irrational, but sometimes very useful partner, and be ready to act? The choice and all the profit is yours. Have you ever made a financial decision that, looking back, made absolutely zero sense? You know, maybe you panic sold a stock or held on to a total loser for way, way too long. Well, trust me, you are not alone. It turns out our brains are actually wired with all these hidden biases that can lead us totally astray. So today, we're going to dive deep into the fascinating world of behavioral finance to break down the psychology behind why we do what we do with our money. Okay, let's kick things off by meeting a character. He was invented over 60 years ago by the legendary investor Benjamin Graham. He called him Mr. Market, and the best way to think about him is as your emotional, kind of manic business partner. Every single day, Mr. Market shows up and he offers to either buy your shares or sell you his. But here's the catch. His mood is all over the map. Some days he's totally euphoric. He thinks the future is amazing and he'll offer you a ridiculously high price. But on other days, he's completely depressed, sees nothing but doom and gloom, and he'll offer to sell you everything he owns for pennies on the dollar. Graham's point here is timeless. Mr. Market is irrational, he's emotional, and you should never, ever let his mood dictate your strategy. So on our journey today, we're going to see how a little piece of Mr. Market's irrationality actually lives inside all of us. We'll start by officially meeting him, then we'll uncover the trap of overconfidence, we'll explore the wild psychology of gains and losses, reveal the hidden dangers of checking your portfolio too often, and look at that powerful urge to just follow the crowd. But most importantly, we're going to finish up by looking at how you can start to outsmart your own brain. So how do we even begin to get a handle on this emotional roller coaster that Mr. Market represents? Well, the key is in this fascinating field that studies exactly this, that intersection between our own psychology and the financial choices we make. It's called behavioral finance. And it all starts with a simple but really profound observation. People, even really, really smart people, often make illogical assumptions and, let's be honest, kind of foolish mistakes with their money. It pulls from decades of psychological research to explain why we do these irrational things. And what researchers are finding is not only fascinating, but it's incredibly useful for anyone who's just trying to protect their money and become a smarter, more disciplined investor.
So one of the biggest and, frankly, most damaging mistakes we all make comes from this one powerful bias we all seem to share. It's this deeply held belief that we know more than we actually do. And this bias? It is the engine behind so many poor financial choices.
Just think about this for a second. When researchers ask a big group of people this exact question, an overwhelming majority, I'm talking like 80 to 90% of people, rate themselves as above average. Now, of course, that's just statistically impossible. We can't all be better than average. And it's not really arrogance, it's just a fundamental part of our psychology called illusory superiority. And get this, it's not just about everyday stuff like driving. Even highly trained experts fall for this. For example, one study found that doctors believed they could diagnose pneumonia with 90% confidence, but in reality, they were only right about half the time. That gap between how good we think we are and how good we actually are is just massive. The Nobel Prize winner Daniel Kahneman said it perfectly. Our comforting conviction that the world makes sense rests on a secure foundation, our almost unlimited ability to ignore our own ignorance. Now, in the world of investing, this overconfidence gets put on steroids by something called overreaction bias. See, we have this tendency to just fixate on the most recent bit of information, a great earnings report, a bad news headline, and we mistakenly think it's signaling some huge, permanent trend. This makes us think we've spotted some brilliant insight that nobody else has seen, which then causes us to rush into a decision without really thinking it through. So to put this bias to the test, the brilliant economist Richard Thaler ran this really simple but powerful experiment. He took all the stocks on the New York Stock Exchange, and he sorted them based on how they'd done over the last 5 years. He made a winner's portfolio with the 35 stocks that had done the absolute best, and a loser's portfolio with the 35 that had done the absolute worst. Then he just sat back and watched what happened to both of those portfolios over the next 5 years. And the result was pretty stunning. The portfolio that was filled with stocks that everybody had given up on, the losers, it ended up outperforming the darlings of the market, the winners, by almost 40%. This just goes to show how our tendency to overreact, which is fueled by our own overconfidence, can lead us in the exact wrong direction. It causes us to buy high and sell low.
Okay, so overconfidence isn't the only trap. Our emotions themselves are hardwired to process gains and losses in a way that often works directly against our own best interests. It's a system that was probably great for keeping us safe out on the savannah, but it's not so great for managing a 401k. For decades, economists just assumed that people were these rational actors who followed something called utility theory. That just means we should only care about how a decision affects our total net worth. But then, two psychologists, Daniel Kahneman and Amos Tversky, came along and introduced something called prospect theory. And what they showed was that we don't really think about our final wealth. Instead, we feel and react really intensely to the individual wins and losses along the way. And here's their most revolutionary discovery: loss aversion. Through tons and tons of experiments, they proved that the psychological pain of losing $1 is about 2.5 times more powerful than the pleasure of gaining $1. I mean, think about that. You need to gain $250 just to offset the emotional sting of losing $100. We are fundamentally wired to avoid losses way more than we are to seek equivalent gains. And this leads to some very specific and very damaging real-world behavior. To avoid that sharp pain of admitting we made a mistake and actually booking a loss, we hold on to failing investments for way too long, just hoping and praying they'll get back to even. It can make us way too conservative in our retirement accounts, picking lower return stuff just to avoid any short-term bumps. And it just paralyzes us, keeping us from selling a bad investment and putting that money into a much, much better opportunity. Okay, so we're overconfident and we're terrified of losing. But there's another factor in our modern lives that just pours gasoline on this whole psychological fire, and that's how often we check our investments.
Researchers Richard Daler and Shlomo Ben-Artzi combined these ideas into a concept they called myopic loss aversion. Myopic just means short-sighted. It's this toxic combination of our natural aversion to loss with the constant short-term checking of our portfolios. And with today's technology letting us see our balances jump around every single second of the day right on our phones, we are just constantly triggering this painful, irrational response. And this is where the problem becomes really, really clear. If you check your stock portfolio every day, it's basically a coin flip. You've got about a 50-50 shot of seeing a loss on any given day, which triggers that 2.5 times pain of loss aversion. But just look what happens when you zoom out. If you only check once a year, the chance of seeing a loss drops below 30%. Check once a decade, it's less than 10%. The more frequently you look, the more pain you are absolutely guaranteed to feel, and the more likely you are to make a bad emotional decision based on short-term noise.
Now, on top of all these individual biases, there is another powerful psychological trap. It's that irresistible, almost magnetic urge to just do what everybody else is doing, even when it makes no logical sense. Ben Graham had this great story that just captures this herd mentality perfectly. An old oil prospector dies and gets to heaven, only to find out that it's completely full of other oilmen. So the prospector, disappointed, is about to leave when St. Peter says he can stay, but only if he can clear some room. So the prospector puts his hands to his mouth and yells, "Oil discovered in hell." Instantly, the pearly gates fly open and a stampede of oilmen rush out, all heading south. St. Peter, super impressed, ushers the prospector in. But the prospector pauses, scratches his chin, and says, "You know what? I think I'll go with the rest of the boys. There might be some truth to that rumor after all."
And Warren Buffett puts a modern professional spin on this. He points out that for a lot of money managers, there's this huge incentive to just go along with what everyone else is doing. I mean, think about it. If you make a bold, unconventional bet and it goes wrong, you could lose your job. But if you do what everyone else is doing and that goes wrong, well, you can't really get blamed. You just failed conventionally. For a lot of people, it's just professionally safer to be wrong with the crowd than to risk being right all by yourself.
So, let's recap. We're overconfident, we hate losses, we check our phones way too much, and we're basically programmed to follow the herd. So the big question is, how on earth do we overcome our own psychology and start making better decisions? Well, the answer really lies in shifting our focus. Let's look at a total masterclass from Warren Buffett. In 1988, he made this massive $1 billion investment in Coca-Cola. Over the next decade, that investment went up tenfold, a legendary home run. But here is the absolutely crucial part. In 4 of those 10 years, Coke's stock actually underperformed the market. Most investors, feeling that sting of loss aversion, would have sold during those down years. But what did Buffett do? He completely ignored the short-term price swings. He didn't care about Mr. Market's daily mood. He was focused only on the long-term value of the Coca-Cola business itself. And that brings us full circle, right back to where we started with Ben Graham's warning. He knew that the market is just this chaotic place full of hope and fear and greed. He understood that prices were going to fluctuate irrationally because, well, they're driven by human emotion. The secret isn't trying to predict those fluctuations, but to build a process that protects you from them, a process that separates the daily noise of the stock price from the actual underlying value of the business. So this leaves us with a final, really practical thought. Overconfidence, loss aversion, herd mentality, these aren't character flaws you can just decide to turn off. They are part of our human wiring. But just knowing they exist, that's the first and most powerful step. The next step is to build a system to counteract them. Maybe that means writing down your investment thesis before you buy. Maybe it's setting firm rules for when you'll sell, or just automating your investments so emotion is taken out of the equation. The goal is to build a rational process that you can fall back on when your own mind and Mr. Market inevitably get emotional.
So in the world of investing, you've basically got these 2 great schools of thought, 2 philosophies that are, well, fundamentally at odds with each other. On one side, you have the towering theories of modern finance, all born in the halls of academia. And on the other side, you have Warren Buffett. So how in the world did a kind of folksy investor from Omaha end up in a decades-long intellectual fight with Nobel Prize-winning economists? Well, let's dive in and find out.
To really get Warren Buffett, you first have to understand his mentor, the legendary investor Benjamin Graham. Graham wrote this, and wow, it just cuts right to the heart of our story. He's basically saying that the biggest enemy for an investor isn't some market crash, it's your own emotions. That daily up and down noise of stock prices, it can be like psychological torture, and it pushes you to make terrible decisions. This whole idea that you need to be strong enough to just ignore the market's mood swings, is the absolute bedrock of one of these worlds of investing.
Okay, so this right here sets up the two worlds we're going to explore. Over on the left, you had the academics. To them, the market is a system of prices, something you measure with formulas, and you worry about things like volatility. For them, risk is that bumpy ride. The more a stock's price jumps around, the riskier it is. Simple. But on the right, you have the business owner mindset, the one championed by Buffett. They look at the market and see a big collection of actual businesses. Their focus is on the real-world value of a company. And for them, risk has nothing to do with the ride. It's the very real chance you could permanently lose your money. These two worldviews, they just could not be more different.
Let's start with the academics. For the first time in history, our financial thinking was really being shaped in university halls, not on Wall Street. A handful of professors became these new high priests of modern finance, and their ideas are still taught to thousands and thousands of business students every single year. In just over a decade, three key people laid the foundation for what we now call modern portfolio theory, or MPT. It all kicked off in 1952 with Harry Markowitz, who came up with this then revolutionary idea that risk and return are just two sides of the same coin. Then, in '63, Bill Sharpe gave us beta, a really simple way to measure risk. And finally, in '65, Eugene Fama proposed the efficient market hypothesis, which would, believe me, change the investing world forever. So let's break down what each of these core ideas really means.
So the first piece of the puzzle is this thing called covariance. Markowitz's big idea was, hey, let's stop looking at individual stocks and start looking at the whole portfolio. He realized that if you own a bunch of stocks that all go up and down together, you're not really protecting yourself at all. Covariance is just a fancy way to measure that relationship, so you can build a portfolio of stocks that kind of zig and zag at different times, which smooths out the whole ride. For him, the key to managing risk was all about diversification.
Okay, next up is Eugene Fama's efficient market theory, or EMT. And folks, this one is a real game changer. Fama argued that the market is just packed with so many smart people that any new piece of information gets absorbed into a stock's price instantly. The implication here is absolutely profound. If the price already reflects everything there is to know, then trying to find undervalued stocks is totally pointless. According to this theory, you just can't consistently beat the market, except by pure dumb luck.
And the final pillar is beta, which was created by Bill Sharpe. Beta basically became the academic world's go-to definition for risk. It's just a simple number that tells you how jumpy a stock is compared to the market as a whole. A beta of 2 means the stock tends to swing twice as much as the overall market. So in this worldview, high volatility just equals high risk. And this risk, which Sharpe called systemic risk, is the one thing you can't get rid of through diversification. It's just a price of admission for being in the market.
And this brings us to the other side. So while the academics were busy building their elegant theories, Warren Buffett was busy building a fortune. For over 25 years, he gave little to no thought to any of this, covariance, beta, or the idea that the market was efficient. He was living in a completely different intellectual house. So let's see how he built it. For Buffett, it's actually pretty simple. A stock is not a squiggly line on a chart, it's not a ticker symbol, it is a small piece of a real-life business. The moment you buy a stock, you become a part owner of that company. And if you can adopt that mindset, all the daily noise of the market just becomes totally irrelevant. What actually matters is the long-term performance of the business itself.
And with this mindset, Buffett just throws down the gauntlet. He looks at the academic definition of risk, this idea that volatility, or beta, is risk, and he calls it an absurdity. And think about it from a business owner's perspective for a second. If you own a fantastic business and for some reason its stock price temporarily drops, are you in more danger? Of course not. You've just been handed a golden opportunity to buy more of that great business at a cheaper price.
So this is it. This is the first great battleground between these two philosophies, the very definition of risk. It's maybe the most important concept in all of investing, and they couldn't be further apart on what it actually means.
This slide just illustrates the divide perfectly. For modern portfolio theory, risk is volatility. A stock that swings wildly is risky, period. The whole goal is to smooth out that ride. But for Buffett, risk is something completely different. It's the chance of a permanent loss of your capital, that the money you invest won't give you back at least the same amount of purchasing power you started with. A dip in price isn't risk, it's an opportunity.
The real risk is in the business itself, not its stock chart.
You know, Buffett says that the single greatest difference between his view and the academic view really comes down to your time horizon. He asks you to imagine buying some Coca-Cola stock. If you plan to sell it tomorrow morning, he'd say that is an incredibly risky bet. It's no better than flipping a coin. But if you buy that exact same stock with a plan to hold it for, say, 10 years, for Buffett, that's practically zero risk, as long as you bought it at a sensible price. Time completely transforms volatility from a risk into an opportunity.
So the second major point of conflict flows directly from the first one, diversification. Right? If you believe that price volatility is the enemy, you're going to want to own a little bit of everything to protect yourself. But if you don't really care about short-term price swings, well, your approach is going to be radically different.
This is one of Buffett's most famous and, frankly, most provocative quotes. Now, he's not saying diversification is bad. He's saying it's for a very specific purpose, to protect people who don't have the time or the skill to really truly understand individual companies. If you don't know which business is a winner, then yeah, of course, you should own a little bit of everything. But if you do know how to analyze businesses, why on earth would you put your money in your 50th best idea instead of putting more into your absolute best one?
And there it is. That's the trade-off. Following the principles of modern portfolio theory, diversifying super broadly, that will almost certainly protect you from doing much worse than the market average. But as Buffett points out, it will also guarantee you don't do much better. It is a formula for achieving average, and as he says, almost anybody can figure out how to do average by 5th grade.
So this leads us to the final showdown, and it's a direct challenge to Eugene Fama's whole efficient market theory. Because if that theory is right, then what Warren Buffett has managed to accomplish, well, it should be totally impossible.
So, how do we resolve this paradox? The theory, the one they teach in every business school, says that consistently outperforming the market is a statistical impossibility. And then you have the evidence, Warren Buffett's track record spanning nearly half a century, which has absolutely crushed the market average. And you know what? He's not alone. Plenty of other investors who follow the same value investing principles have also had incredible success. So, how can the theory be true?
You know, Buffett's critique of EMT is actually quite smart and nuanced. He agrees that, yeah, the market is frequently efficient. Most of the time, prices are more or less right. But the academics, he says, they made a critical error. They took a pretty good observation and they stretched it into an absolute law. And the difference between frequently and always is, as he puts it, night and day. It's in those rare moments when the market is inefficient, when it's driven by fear or greed, that investors who've actually done their homework can find incredible opportunities.
And this is just Buffett's final, witty jab at the whole theory. He jokes that investors like him should actually fund university programs that teach EMT. And why would he do that? Because it's a massive advantage to compete against people who have been taught that it's useless to even try. The theory itself creates the very market inefficiencies that he and other value investors get to exploit.
So today, every single investor stands at this intellectual and emotional crossroads. There are two very distinct paths forward, and each one is backed by its own powerful logic. The choice you make really defines what kind of investor you're going to be.
Okay, let's just summarize the two paths real quick. You've got the MPT path, which is all focused on price. The goal here is to manage the volatility of your portfolio through super broad diversification, just to make the journey as smooth as possible. Then you've got the Buffett path, which is focused on value. Here, the goal is to concentrate your money in a few outstanding businesses that you understand inside and out, and to learn to completely ignore those short-term bumps in the road.
And that really brings us to the final question, one for you to think about. The next time the market takes a dive, and believe me, it will, think about your immediate gut reaction. Do you see those falling numbers and feel the panic of a trader watching their portfolio shrink? Or do you see the prices of great businesses going on sale and feel the excitement of a business owner who's ready to seize an opportunity? Your answer really reveals which path you're truly on.
All right, let's jump right in. What if I told you that the most important skill for investing has nothing to do with math and everything to do with psychology? We're going to dive into why mastering your own mind is the real key to winning in the wild world of the stock market. So let's get started.
So here's what we've got on tap. First up, we're going to look at two totally different ways to invest. Then we'll get into a really weird paradox, why a super simple strategy is so tough to actually pull off. After that, we'll look at the emotions that really drive the market, how you can use that to your advantage, and finally, we'll talk about the one thing that can save you from all that irrationality.
Okay, so every single investor, you included, gets to a fork in the road. And this isn't just about picking stocks. It's about choosing a whole philosophy. On one side, you've got what everyone else is doing, the mainstream. And on the other, well, that's a path that's a whole lot less crowded.
So let's break this down. It's basically two completely different worlds. You've got the mainstream army over here. These are the folks who follow what's called modern portfolio theory. They basically think the market is super efficient, that every bit of info is already baked into the stock price. Their goal, a nice, smooth ride, no big bumps. But then you have the rebels path. This is the Warren Buffett way. These investors think, no way, the market can be totally irrational. They tune out all that daily noise and focus on just one thing. What is this company actually worth in the long run? Its real intrinsic value.
And this quote just nails it, doesn't it? Choosing that second path, it's not just some academic debate. It's a choice that can make you feel like a total outsider. You're literally standing on one side of a field, looking at this massive army doing the exact opposite of you. You're stepping away from the herd on purpose. And believe me, that brings a whole new set of mental hurdles to overcome.
And that leads us to this really interesting puzzle. The ideas behind the Warren Buffett way, they're actually super simple, and pretty much everyone agrees they work. So if the playbook is right there for everyone to read, why isn't everyone a billionaire investor? Why are there so few Warren Buffetts out there? Let's dig into why something so simple is so incredibly hard to do.
I mean, think about it. For more than 20 years, his methods have been out in the open. You can find him in business schools, in best-selling books, all over Wall Street. And you'll have a really hard time finding anyone who says, nah, Buffett's logic is flawed. On paper, it just clicks. It makes perfect sense.
So that's the million-dollar question, right? If everybody agrees it's the right way to do it, why does almost nobody actually do it? Why do so many of us read the book, nod along thinking, yep, that's smart, and then the second our own money is at stake, we do the total opposite?
Well, here it is, the big secret. It isn't some complicated algorithm. It's not a secret stock tip, it's temperament. The one thing that separates the winners from everyone else is that Warren Buffett is rational, not emotional. He can operate with total logic in a world that, let's be honest, is completely driven by feelings.
Right. So you have to remember, the market isn't some cold, calculating machine. It's not a spreadsheet. It's made up of millions of people. And what drives people? Fear, greed, hope, all those messy human emotions. And that's where this really cool field called behavioral finance comes into play.
Now, this whole idea isn't brand new. You had renegades like Buffett and his partner Charlie Munger who got this stuff decades ago. They knew psychology was the real game. But, for the longest time, the mainstream just saw them as weird. It was a fringe idea. That is until 2002. That's when a psychologist, a guy named Daniel Kahneman, won the Nobel Prize in economics. That was the moment everyone had to stop and say, okay, maybe there's something to this. And today, behavioral finance is a totally legit, powerful way to understand how markets actually work. So what the heck is it really? Well, behavioral finance is pretty simple. It's all about how our human brains, with all our biases, our gut feelings, our emotions, mess with our financial choices. It's this recognition that we aren't the perfect logical robots that a lot of old-school economic theories thought we were.
And this quote gets to the very heart of it. Our emotions are just stronger than our reason. When everyone gets greedy, stock prices can shoot up way, way past what a company is really worth. And when fear kicks in, those same prices can crash way below their true value. It's like reason gets tied up and thrown in the trunk, while emotion just grabs the steering wheel and floors it.
And this chart shows you exactly that. In the short run, what has a bigger impact on stock prices? Is it how the company is actually doing, its fundamentals, or is it how investors feel about the company, their sentiment? As you can see, a lot of the time, pure emotion has a much bigger effect. The story, the hype, the fear, that can become way more powerful than the actual facts. But here's the kicker. This isn't just random chaos. As Charlie Munger puts it so well, this irrationality actually creates predictable patterns. That's the key. You're not trying to guess the exact moment people are going to lose their minds, but you know that when they do, they tend to act in very similar predictable ways. And if you can spot those patterns, that's where the real opportunity is. All right, so if we know the market is emotional and creates these patterns, how do we actually use that? How does knowing all this psychology stuff give you a real edge? Let's talk about how you can turn all that chaos and emotion into your secret weapon. It really comes down to two huge advantages.
Number 1, you get a set of guidelines to help you sidestep the classic mistakes that almost everyone else makes. And number 2, you learn how to spot when other people are making those mistakes on a massive scale, which is your chance to profit from them.
And this is where it gets really dangerous. The power of the crowd. Look, one person making a bad call, that affects them. But when a million people make the exact same bad call at the same time, that's what moves the entire market. It creates this powerful urge to just go along with everyone else, the fear of missing out. And that collective bad judgment just feeds on itself, getting bigger and bigger.
Okay, so if the market is this crazy emotional ocean, how do you not drown, right? How do you stay stable and think clearly when everyone else is either panicking for the lifeboats or celebrating on the deck of the Titanic?
This quote just says it all. In a storm like that, it's not always the biggest ship that makes it through. It's the one with the captain who stays calm, follows the map, and trusts the compass. And in the world of investing, that compass is rationality. So if you remember just one thing from all of this, let it be this. The only antidote to making dumb, emotional mistakes with your money is rationality. That's it. It's not a fancier spreadsheet, it's not a secret tip, it's just being rational. But being rational isn't just about being a genius. It's really a mix of a few things. Yeah, you need to be smart about it, but you also need patience, a lot of it, the grit to just stick to your plan when things get scary. And you have to apply it consistently, not just when it's easy, but for the long, long haul. And that leaves us with one final question, and this one is for you. Now that you know what's really driving the crowd, the choice is all yours. So when you see that herd stampeding, driven by pure emotion, are you going to follow them, or are you going to lead?
In a world that wants everything yesterday, what if the most powerful tool for building wealth is the one nobody seems to want to use anymore? Today, we're talking about patience. We're going to make the case for why it might be the ultimate and most overlooked advantage in the financial markets.
So Leo Tolstoy, he probably wasn't thinking about stock portfolios when he wrote War and Peace, but wow, this line is just perfect. He said the two strongest warriors are time and patience. And as you're about to see, those exact same forces are really the foundation for understanding how wealth is truly built.
All right, here's our game plan. We'll kick things off by looking at the market's two opposing forces. Then, we'll dive into the psychology that drives the crowd. After that, we'll get into the actual math that proves why patience is rewarded. We'll check the data, ask a really interesting question, why so few people are doing this, and then wrap up by figuring out what this all means for you.
Okay, so let's step onto the battlefield. To really get a handle on the value of patience, you first have to understand that there are two totally different games being played in the market every single day.
I want you to think of the market as a time continuum. Way over on the far left, you've got the total chaos of speculation. We're talking microseconds, days, maybe weeks. The only goal is to make money faster than the next person. But way over on the far right, that's the landscape of real investing. It's a quiet world of years, even decades, and it's all about patient long-term growth.
And if you had to put a face to that right side of the continuum, well, it's got to be Warren Buffett. He is the absolute archetype of the patient warrior, just quietly letting time do all the heavy lifting for him.
And this leads us to a really, really important question. If being patient is so powerful, then why are so many people crowded onto that short-term speculative side of the field? What's going on there?
Well, it really boils down to three powerful psychological drivers. First, you've got good old-fashioned greed, that siren song of getting rich quick. It's timeless. Second, there's hubris, that little voice in your head that says, yeah, I can outsmart the daily chaos of the market. But the third one, honestly, is the most troubling, a real crisis of faith. After all the volatility we've seen, a lot of people just don't believe the long game even works anymore.
Now, what's so fascinating is that we can actually move beyond psychology and use economic theory to prove why patience has to be rewarded. The key comes from this landmark paper by two professors, Schlafer and Vishny, who basically laid out a kind of physics for how time and return work together.
So let's break down their idea. The first piece of the puzzle is cost. Now, when we say cost, we're not talking about fees or anything. It's simply the cost of time. The longer your money is tied up in an investment, the higher the cost is, just in terms of opportunity.
The second piece is risk. And again, this isn't just about the risk of losing your money, it's about the risk of uncertainty. The longer you're willing to wait,
the more unpredictable the journey becomes, right? So more time means more uncertainty, which the model calls higher risk.
And finally, the third piece is return. This is the good part, right? This is the payoff. It's the reward you get for taking on that cost of time and bearing that risk of uncertainty. Okay, so let's put it all together. Look at the short-term speculators. Their cost of time is low, and their risk from uncertainty is also low because they get an answer really fast. So it makes sense that the potential return is also going to be small. But for long-term investing, it's the complete opposite. The cost is high. We're talking years of commitment. The risk is high, years of uncertainty. So for the whole system to be in balance, the potential return must be larger. It's basically the market's way of paying you for taking on that extra burden.
That's a really elegant theory, right? It just makes sense. But the billion-dollar question is, does it actually work in the real world? When we crunch the numbers, is patience really rewarded with bigger returns?
So let's ask the question as directly as we can. If you buy good stocks and just hold them, do those big returns we just talked about in the theory actually show up?
And the answer from the data is an absolute, undeniable yes. Just look at this. We're looking at S&P 500 stocks over a 43-year period. In any single one-year period, your chance of a stock doubling was tiny, like 1.8%. But stretch that out to 3 years, and suddenly it jumps to over 15%. And if you can hold on for 5 years, nearly 30%, almost 1 out of every 3 stocks, doubled in value. The pattern is crystal clear.
And let's just be clear about what doubling your money in 5 years really means. That's an average annual compounded return of nearly 15%. That is the real, tangible reward that the market is offering you just for being patient.
Okay, so this leads to a really strange paradox. You see, in finance, whenever there's a chance to get big returns like this, you'd expect a flood of smart investors, they call them an army of arbitrageurs, to rush in and compete for it, which would drive those returns down. So, if the long-term rewards are this good, where is everybody?
Because the data shows that, weirdly enough, that army of long-term investors, it never really showed up. The battlefield on that side has stayed pretty empty, and those big long-term returns, they haven't been competed away. This tells us something really fundamental has changed about who's even playing this game anymore.
And this timeline, wow, it just tells the whole story. Back in the 1960s, the average holding period for a stock was about 8 years. By the 80s, it was chopped in half to 4 years. By the year 2000, just 2 years. And today, it's measured in months. This isn't just some blip. It's a slow, generational march away from investing and towards speculation.
And the consequences are pretty much exactly what you'd guess. With everyone piling into the short-term game, it's become this chaotic knife fight for smaller and smaller profits. And meanwhile, this powerful magnet pulling everyone towards speed has left the long-term field wide open, with just a, quote, rarefied few left to pick up all those excess returns.
So let's bring this all home. What on earth does this all mean for you, an individual just trying to navigate this whole landscape?
The number one takeaway is this. The market's collective obsession with speed has created a deep, structural, and lasting inefficiency. You've got this massive crowd fighting over scraps on one side of the field, while leaving an absolute feast totally unattended on the other.
At the end of the day, the market is just the sum of millions of our choices, and as a whole, it has chosen speed over patience. It has chosen speculation over investing. The evidence shows the cost of that choice and the incredible opportunity that it creates. So the only question left is, what will you choose? Will you join the frantic crowd, or will you choose to fight alongside those two strongest warriors, time and patience?
Welcome! Today, we're diving into a really fascinating puzzle. It's all about how our own brains, which are actually hardwired to take shortcuts, end up creating this huge, predictable glitch across the entire stock market. It's a story that starts with just a tiny habit in our own heads and, believe it or not, blows up into a massive market-wide trend. Let's get right into it. So, everything really kicks off with this one question. You've seen it, right? Someone who is brilliant, genius-level smart, and they make a decision that just leaves you scratching your head, thinking, how? We tend to assume that being smart automatically means you're rational, but as we're about to find out, it turns out that's not even close. And that idea brings us to our first big concept for today, the rationality gap. See, before we can really get a handle on the market, we first have to understand this pretty surprising disconnect
between the raw power of our brains and our ability to actually use that power wisely.
Okay, this slide just lays it all out perfectly. Think about intelligence, the kind of thing an IQ test measures as the horsepower of a car's engine. It's pure, raw power. But rationality, that's about how well you drive the car. And as a researcher named Keith Stanovich has pointed out time and time again, having a big engine is a surprisingly terrible predictor of whether you're a good driver. They are two completely separate things. In fact, Stanovich actually came up with a name for this whole thing, disrationalia. And it's the perfect word, isn't it? It perfectly captures that gap between what you could do and what you actually do. It's like having a supercar engine and driving it straight into a wall. And this isn't some rare thing. It's a super common part of how we all think. So what's causing this gap? What's the real reason for disrationality? Well, the answer is hiding in a really basic principle of how our brains are wired to work. So let's meet the main culprit, the cognitive miser. Our brains basically run on two different operating systems. Let's call one the sprinter and the other the marathoner. The sprinter, or system 1, is our go-to, our default mode. It's incredibly fast, totally automatic, and takes almost zero effort. Think about recognizing a friend's face or knowing the answer to 2 plus 2. The catch, it loves shortcuts, so it's really prone to making mistakes. Then you have the marathoner, or system 2. It's the total opposite. It's slow, careful, and requires serious focus. This is the system you fire up for a tricky math problem or trying to learn a new language. It's got amazing computational power, but man, it burns a ton of energy.
And this quote from Stanovich just nails it. Our brains are, at their core, lazy. They are built to save energy whenever possible. So our natural tendency is to just default to the sprinter, that easy, low-effort thinking, even if we know it might be wrong. We are, by our very nature, cognitive misers.
Okay, so we're lazy thinkers. That makes sense on an individual level. But what happens when you take that single psychological quirk and you multiply it by millions of people, all operating inside one giant system, like the stock market? Well, let's take a look. Now, in a perfect world, a healthy, efficient market has a nice balance of players. On one side, you've got your short-term traders. Think of them like piranhas, swarming and attacking any tiny, immediate mispricing they can find. On the other side, you've got the long-term investors. They're more like patient eagles, circling from above, looking to close that big gap between a company's price today and its real, fundamental value years down the road. When these two are in balance, the market works beautifully. Sounds great in theory, right? But what happens to the market when that balance gets thrown way off? What if one side starts to totally take over? What if almost everybody becomes a piranha and the eagles, well, they start to disappear? And that question brings us to a huge shift that's been happening quietly for decades now. You can see it clear as day in the data, which shows this incredible, persistent shrinking of the market's collective time horizon. I mean, just look at this timeline. It's undeniable. Back in the 1950s, the average time someone held onto a stock was 8 years. People were actually investing in businesses. Fast forward to the 90s, and that drops to just 2 years. By the 2010s, 6 months. And today, it's measured in months, sometimes even weeks. The market's patience has pretty much just vanished. The really key thing to get here is that this wasn't some sudden crash or a single event. It was a slow, steady migration. Year after year, more and more people shifted their mindset from that of a long-term investor to a short-term speculator. And in doing so, they fundamentally changed the character of the entire market. And this all leads us to our final and most important section. This is where we connect all the dots. We're about to see exactly how our lazy, miserly brains are the direct cause of this massive market trend and how that creates a gigantic, overlooked opportunity. So here it is, the central mystery we've been building up to. On one hand, we have this psychological rule we're all cognitive misers. On the other, we have a market phenomenon, this incredible shrinking horizon. So what's the bridge? What connects these two things? All right, let's start with what we know is true. As we've already covered, our brains are wired to take the path of least resistance. Our default setting is to think the easy, fast, automatic way. This is just our natural state of being. Okay, now let's apply that directly to the market. Real, true, long-term investing, that is classic marathoner work.
It is 100% System 2 thinking. It demands deep research, a ton of patience, and the kind of intense focus needed to tune out all the daily noise and just focus on fundamental value. To put it simply, it is really hard work for our brains. But short-term speculation, that is pure sprinter thinking. It's all System 1, it's reactive, it's emotional, it's driven by headlines and gut feelings. It feels fast, it feels exciting, and best of all, it feels effortless. It gives our brains that quick hit of feedback and the low-effort path that it loves so much. So the conclusion here is pretty much unavoidable. When faced with two choices, the cognitive miser inside every single one of us pushes the vast majority of people in the market toward the easier, short-term path. So what happens? The swimming pool for speculators gets incredibly crowded and competitive, while the lane for the patient, long-term investor becomes quiet and almost empty. The result is that massive long-term opportunities are just left sitting there, wide open, simply because almost no one is willing to do the hard mental work it takes to find them.
And that leaves us with one last thing to think about. An entire global market has been shaped by our collective habit of taking the easy way out. It's a really powerful reminder that our default settings aren't always our best settings. And it begs the question, if this one little cognitive shortcut can create such a huge inefficiency in the market, where else in our lives, in our jobs, our relationships, how we learn, is our inner cognitive miser costing us a chance at real long-term value?
All right, welcome to The Explainer. Today, we're going to dig into something really fascinating, a link between how our brains work, cognitive psychology, and how people invest their money. And it all comes down to this one really powerful concept, slow-moving ideas.
So, let's just dive right in with a puzzle. I am sure you've seen this happen, right? You've got these incredibly brilliant people. We're talking geniuses, maybe. And they just make choices that seem completely bonkers, totally irrational. How does that even happen? How can someone with a sky-high IQ make a decision that, when you look back, is just, plain dumb?
Okay, so here's the game plan. We're going to start with this whole paradox of smart people making dumb decisions. Then we'll get into what's called the rationality gap and why our brains are, kind of lazy. And then we'll tie it all together, see how this plays out in the world of finance, and talk about the value of slow ideas and how to find the market's blind spot. All right, first up, to really get to the bottom of our puzzle, we have to start with a super important distinction, and it's this. Being intelligent is not the same thing as being rational. They're two totally different concepts. So there's this researcher, Professor Keith Stanovich, who's a huge name in this field, and he argues that our standard intelligence tests, like IQ tests or the SATs, they're actually pretty bad at measuring how rationally we think. Intelligence, he says, is like raw brain power, horsepower, knowing a bunch of facts. But rationality? That's totally different. It's about using what you know to think clearly and make the best possible decision. And Stanovich's research really drives this point home. He found the connection between IQ and rational thinking is weak at best. In fact, he says some rational skills are, and I'm quoting here, totally dissociated from intelligence. Just think about that. It means you can have all the brain power on the planet and still be someone who consistently makes terrible, irrational choices. So, this gap, this disconnect between being super smart and actually behaving rationally, it turns out it has a name. Which brings us right to our next section. Okay, so before we go any further, let's just get our terms straight. When we talk about rationality or rationalism, what do we mean? At its core, it just means basing your actions on logic and evidence, not on emotional whims or, those flawed mental shortcuts we all take. And this is where Stanovich comes in with a great name for this problem. He calls it disrationality. I mean, it's the perfect word for it, right? It's the inability to think and behave rationally despite having all the intelligence you need. So there it is. That's the official diagnosis for the puzzle we started with. So what causes this disrationality? Well, the research points to a couple of things. One is what they call a content problem, which basically means you just don't have the right knowledge. But the bigger one, the one we're really going to focus on, is the processing problem. And this is where we start to see something really fundamental about how all of our brains are wired. All right, so let's dig into why our brains process things this way. And look, this isn't about some personal failing. It turns out we are all hardwired to take the easy way out. The easiest way to think about it is that our minds have two different operating systems, or maybe two gears.
You've got the slow, effortful gear. This one is a powerhouse. It's got immense computational ability. It's super accurate, but man, it takes a ton of concentration. Then you've got the fast, effortless gear. This is your autopilot. It makes snap decisions with almost no effort, but its power is pretty limited. And, well, it's often illogical and makes a lot of mistakes.
And here's the absolute key. Stanovich has this fantastic term for us. He calls us cognitive misers. And it's perfect, right? It means our brains are fundamentally wired to be lazy, to conserve energy whenever possible. So our default setting, our go-to tendency, is to use that fast, easy, effortless system, even if we kind of know it might be wrong.
And again, I gotta stress, this isn't a moral judgment. It's just a basic fact of our cognitive wiring. We're designed from the ground up to save mental energy. We always want to take the path of least resistance. And because of that, our gut instinct solutions can often be, well, pretty illogical.
Okay, now this is where things get really, really interesting. Let's take this whole concept of our lazy, cognitive miser brains and apply it to a world where there are literally billions, even trillions of dollars at stake, the financial markets. So that brings up a huge question, right? If the entire market is basically just a giant collection of people who are all hardwired to be cognitive misers, everybody thinking fast, taking shortcuts, does that create a massive opportunity for anyone willing to, well, think slow? To get an answer, we've got to turn to the work of a guy named Jack Trainer. Now, he might not be a household name like Warren Buffett, but in the world of finance, he was an absolute giant, a true pioneer in how we think about risk and value. Yeah, Trainer wasn't just some other analyst on Wall Street. His whole career was packed with groundbreaking work. We're talking about collaborating with Nobel Prize winners and literally shaping the foundations of modern finance. He was the absolute definition of a deep, slow, effortful thinker. And this brings us to Trainer's big insight. He basically saw that all investment ideas fall into one of two buckets. You've got your fast-traveling ideas. These are the obvious ones, the simple ones, they spread like wildfire. But then you've got the slow-traveling ideas. These are the tricky ones. They're complex, they require special expertise to even understand, and they demand that real hard mental effort that we've been talking about.
Okay, so now let's connect the dots. Let's link Trainer's insight right back to our lazy brains, because this is where we find the market's blind spot. This is where psychology and profit finally meet.
I mean, just think about it for a second. The stock market is nothing more than a giant collection of human minds, and we've just established that those minds are, by and large, wired to be cognitive misers. So what are they looking for? They're actively hunting for those simple, easy, fast-traveling ideas that don't require a lot of heavy lifting. And this leads us to Trainer's killer conclusion. He basically says, look, the market is not going to be inefficient when it comes to these fast ideas. It just can't be. Why? Because by their very nature, the huge crowd of cognitive misers will spot them, get them, and the price will reflect that information almost instantly. There's just no edge to be found there. It's gone in a flash.
So where is the inefficiency? The real inefficiency, the market's big blind spot, it's hiding in those complex, messy, slow-traveling ideas. And why is that? It's because to really understand them, you have to engage that slow, high-concentration, effortful thinking, the very thing our inner cognitive miser is screaming at us to avoid. So the vast majority of investors, they just ignore them.
And really, that's the big takeaway from all this. The very same mental laziness that causes dysrationalia in our everyday lives is the exact same thing that creates these amazing pockets of opportunity in the market. The real value isn't hidden in some secret formula. It's hiding in plain sight. It's in the topics that just feel too hard, too complex, or like way too much work for most people to even bother with.
So I want to leave you with a final question to think about in your own life. And this could be in your career, your learning, your investments, whatever. What's that one difficult, complex, slow-moving idea that you've been avoiding? You know the one that just feels like too much work. Because based on everything we've just talked about, that might just be the most valuable thing you could possibly tackle. You know, your brain basically has two different gears. There's a fast one and a slow one. One is your gut instinct, it's effortless. The other, that's your deliberate, deep thinking, and it's demanding. Today, we're going to dig into these two systems, and I think you'll be surprised to find out why your fast brain, the one that always feels so certain, can be so wrong.
Okay, let's just jump right in and put this to the test. I'm going to give you a quick quiz. It was actually designed by a Yale professor, Shane Frederick, and he gave it to students at some of the smartest schools in the world, like Harvard and MIT. So let's see how you stack up. All right, here's the first one. Now, a bat and a ball cost $1.10 total. The bat costs exactly $1 more than the ball. So how much is the ball? I'm willing to bet an answer just popped right into your head. Just hold on to that for a second. Okay, now for puzzle number 2. If it takes 5 machines 5 minutes to make 5 widgets, how long would it take 100 machines to make 100 widgets? See what's happening again? Your brain probably served up a quick, what feels like a very obvious answer. What's your gut telling you? And for the final one, this is a classic. In a lake, you've got a patch of lily pads that doubles in size every single day. If it takes 48 days for the patch to cover the whole lake, how long would it take for it to cover just half of the lake? Just like the others, an answer probably feels simple and correct right away. Got your 3 answers locked in? Okay, good. So, how would you do? The reason I'm asking is because this little test reveals something really deep about how our minds are wired. It turns out that the answers that feel the most obvious, well, they're very often wrong. Just take a look at the difference here. Our intuition screams 10 cents, 100 minutes, and 24 days. But the correct answers are actually 5 cents, 5 minutes, and 47 days. Kind of wild, right? Let's quickly walk through why. For the first one, if the ball is 5 cents, the bat is $1 more, which is $1.05. Add them up, you get $1.10. Bingo. For the second one, if 5 machines make 5 widgets in 5 minutes, that means each machine takes 5 minutes to make 1 widget. So, 100 machines making 100 widgets still going to take 5 minutes. And for the lily pads, if they double every day and cover the lake on day 48, they had to have covered half the lake the day before, on day 47. And hey, if you got these wrong, you should not feel bad at all. You are in very, very good company. In fact, Professor Frederick found that more than half of the students at these top-tier universities failed this test. So this tells us something really important. This test isn't really about measuring raw intelligence. Nope. It's about our brain's natural desire to take shortcuts. We are hardwired to jump to the first answer that seems reasonable, just so we can avoid the heavy lifting of real hard thinking. Now, this whole tendency to leap to conclusions, it's not random. It's explained by this really powerful psychological framework that was made famous by the Nobel Prize winner Daniel Kahneman. And it all boils down to 2 very different ways our brain goes about its business. He calls them System 1 and System 2. Think of System 1 as your intuition. It's lightning fast, it's automatic, it's effortless. And then there's System 2. That's your reason. It's slow, it's deliberate, and boy, does it take a lot of work. Now, System 1 is basically the hero of our everyday lives, right? It's what helps you read the mood on someone's face, drive a car on an empty road, or understand a simple sentence. It's also the part of you that gave you those immediate, intuitive, and wrong answers to those puzzles. It just runs on autopilot. System 2, on the other hand, is the part of your brain that you have to consciously decide to switch on. It's the heavy machinery. It's what you use for complex math, for logical puzzles, and for checking the impulsive work of System 1. You had to actively engage System 2 to ignore those tempting, easy answers and find the correct ones. So this leads to a huge question, doesn't it? If System 2 is our built-in fact-checker, why doesn't it just step in more often and save us from System 1's mistakes? Well, the answer, in a single word, is laziness. I mean, listen to how Daniel Kahneman himself puts it. He says, cognitive effort is mental work. And as with all work, many of us have the tendency to get lazy when the task gets harder. It's so true. Thinking hard is genuine work, and our brains, just like our bodies, are programmed to conserve energy. Kahneman even has a name for this. He calls System 2 our lazy controller. Think about it. To use System 2, you need self-control. And just like forcing yourself to go to the gym, doing it constantly is draining. It's frankly unpleasant. So eventually, our brain's battery runs low, and we just let System 1 take the wheel. And this leads us to what he calls intellectual sloth. It's that state where we're just satisfied with the answers on the surface because it's easier. We avoid the hard work. The opposite of that is being engaged. That's when you're more alert, you're more skeptical of your own gut feelings, and you're actually willing to put in the effort to think things through. Okay, so this mental tug-of-war, it's not just for brain teasers. It plays out in the real world in some really high-stakes ways. And there's maybe no better example than financial investing.
where this battle between fast and slow thinking is happening every single day. In the world of investing, you see this split perfectly. System 1 thinking grabs onto the simple, fast ideas, the metrics that are obvious and easy to understand. System 2 thinking, though, that's what's needed for the really laborious, reflective work of analyzing those slow-moving, long-term ideas. These here are classic System 1 metrics, things like PE ratios, dividend yields, stocks hitting a 52-week low. They're so easy to find and calculate, and they feel like you've uncovered some secret insight. But here's the problem. Because they're so simple and obvious, everybody else is looking at them too. Any edge you might find disappears almost instantly. The late, great investor Jack Trainer put this perfectly. He argued that any real opportunity, any real inefficiency in the market, isn't going to come from those fast, obvious ideas everyone sees. It's going to come from the second kind of idea, the kind that travels slowly. And that's really the key. A successful, long-term investment strategy isn't built on those simple, surface-level numbers. It's built on the deep, difficult, System 2 work of analyzing complex, long-term business developments. It's so much harder, but that's where the real insights are hiding. So the next time your gut just offers you a quick, easy answer, maybe you're in a meeting, maybe you're in an argument, maybe you're looking at your finances, I want you to remember this. Just pause for a second and ask yourself, is this the easy answer or is it the right one? Is my intuition helping me right now, or is it just being lazy? Have you ever just stopped and wondered why really, really smart people sometimes make just awful decisions? Well, today, we're going to dive into a concept that explains exactly why that happens. And honestly, it might just change the way you think about thinking itself. It's all about something called the mind work app. I mean, it's a question we've all asked, right? You see these brilliant people, maybe even yourself sometimes, make choices that when you look back seem so obviously wrong. How is that possible? Well, the answer isn't about IQ. It lies deep within the very architecture of our minds. All right, let's get into a classic scenario to see what this looks like in the real world. An investor glances at a stock, sees a couple of numbers that look pretty good, and boom, a judgment is made, just like that. It's a classic mental shortcut. And as our source material points out, it's a trap so many of us fall into, one that relies on what psychologists have dubbed System 1 thinking. So let's really break down this specific trap. We're going to call it the investor's fallacy. And it's the perfect place to start because it so clearly shows the much bigger, more universal idea we're digging into today. Okay, so what's so fascinating here is just how specific and tempting this trap is. The investor in our example isn't just being reckless, They're looking at what seem like solid numbers, book value and dividend yield. They see these are at historical lows, the dividend is going up, and that allure is powerful because the decision feels simple, it feels quick, and it feels intuitively right. And that feeling, that really quick, intuitive, oh yeah, this feels right conclusion, that is the signature move of System 1 thinking. It's our brain's automatic, fast-acting gut reaction system. And look, it's incredibly useful for most of life, but in really complex situations, it can be our biggest weakness. So to really get why that gut feeling can lead us into trouble, we need to zoom in on the two competing systems that are always running inside our heads. It's a really powerful framework that helps explain a ton about human behavior. So on one side, you've got System 1, the fast thinker. This is your gut instinct. It's automatic, it's effortless, it's always on. And on the other side, you've got System 2, the slow thinker. Now, this is our inner analyst. It's deliberate, it requires real concentration and effort, and it's just plain slow. It's the part of you that solves a complicated math problem, not the part that makes you instinctively dodge a ball thrown at your head. And the difference between these two is so huge that psychologist Keith Stanovich even suggests we should think of them as basically being separate minds living together in our brain. Each one has its own strengths, its own weaknesses, and its own way of doing things. So this brings us to the all-important question, right? If our automatic System 1 can get us into so much trouble in complex situations, how do we actually reliably fire up that more powerful analytical System 2? How do we get the slow thinker to wake up and take charge? The goal is to be what the source material calls engaged. And what that means is your System 2 is activated. It's strong, it's focused, and, this is key, it doesn't get tired and give up so easily. An engaged mind is one where that slow thinker is fully in the driver's seat. Okay, let's take this theory and drop it into a really high-stakes real-world environment. As it turns out, Wall Street is the perfect playground for watching this battle between our two minds play out. Now, you'd probably think the world of high finance is all System 2, right? All careful analysis and deep critical thought. But according to our source, the opposite is often true. That fast-paced, high-pressure environment actually pushes people to default to System 1, just rapid-fire decisions based on intuition and gut feeling. But that's not the only game in town. See, amidst all the chaos of those split-second decisions, there's another path. It's a path that deliberately tunes out the noise and instead champions the slow thinker. And the best example of this? Warren Buffett. His entire investment philosophy isn't built on speed at all. It's built on depth. It's all about patience, deliberation, and setting aside serious, concentrated time just to think. It is the perfect real-world example of an engaged System 2. Okay, so this brings us to the absolute heart of the matter. If we know that System 2 is better for big decisions, and we have icons like Buffett showing us exactly how to do it, why is it still so incredibly hard to get it right? The answer is our final big idea, the mindware gap. This is the real puzzle, isn't it? It's not enough to just tell yourself to think harder or be more deliberate. We can try to activate System 2. We can sit down and concentrate as hard as we can and still make a really foolish decision. So why? The reason is the mindware gap. And just like this slide says, it's the lack of adequate content for a deliberate mind to even work with. You can have your analytical engine running at full blast, but if it doesn't have the right parts or tools, it can't actually build anything worthwhile.
And this completely reframes the entire problem. The issue isn't a lack of willpower, it's a lack of equipment. Think of it this way. Having an engaged System 2 is like having a world-class workshop. But if that workshop has no tools in it, you just can't build anything of value. It's that simple.
And those tools, they actually have a name, mindware. It's everything you know that helps you solve a problem. It's your collection of mental models, your knowledge of procedures, your understanding of rules and strategies. It is the entire library of information that your System 2 analyst has to draw upon.
Let's make this really concrete and go back to our investor. Their mental toolbox can't just have two simple tools in it like book value and dividend yield. No way. A well-stocked toolbox needs sophisticated mindware, like a deep understanding of a company's competitive advantages, its moat. Then you need the ability to actually judge the quality of its management and how good they are at allocating capital. You also need knowledge of the big economic drivers that actually determine its value in the long run. And so importantly, you need to know about the very psychological traps we've been talking about, so you can build defenses against them. And this, right here, is the ultimate takeaway. You can be the most patient, deliberate, engaged thinker in the world. But if your mental toolbox is empty, if you haven't filled it with the right mindware, your powerful System 2 has nothing to work with. It's just going to spin its wheels and you'll fall right back on the easy and often very wrong answers of System 1.
So, we'll leave you with a final thought. And it doesn't just apply to investing. It applies to every single complex decision you face. The next time you have to make a big call, ask yourself this: am I just trying to think harder? Or have I actively built the mental toolkit I actually need to succeed? What's missing from your toolbox?
You hear it all the time, the world's greatest investor. But what does that even mean? How do we actually know who's the real deal and who just got lucky for a little while? Well, it really comes down to just two things. You have to consistently beat the market, and you have to do it for a very, very long time. All right, let's dive in.
So here's how we're going to break this down. First, we're going to look at the absolutely chaotic game that most people are playing in the stock market. Then, we'll talk about the mental tools you need to play a totally different game. We'll see how Warren Buffett mastered it, look at the jaw-dropping results, and then we'll wrap up with a really important question for you. Okay, so to really understand a master player, you first have to understand the game they're playing. And let me tell you, the modern stock market, it's a game of just frantic, nonstop activity. So what is this number you're looking at? This is the annualized turnover rate in the stock market today. What that means is the average share of stock changes hands in less than 4 months. Think about that. It's a constant, dizzying churn of buying and selling. This is that fever pitch we're talking about.
And just look at how crazy that change has been. Back in the 1960s, the turnover rate was under 10%. The average person held a stock for over 10 years. Today, we're talking about a 30 times increase in trading activity. This isn't just a little shift, it's a complete transformation of the market's entire personality.
Now, you'd think, right? All this buying and selling, it should lead to better prices, where a stock's price actually reflects its true value. But that's only if the people playing are being rational. What happens when most of them aren't really investing? They're just speculating.
Well, what happens is the exact opposite. When speculators take over, all that frantic trading actually blows the gap between a company's price and its real value wide open. It just pumps a ton of noise and emotion into the system, and that's what leads to those wild, stomach-churning swings you see on the news. If you're trying to be a genuine long-term investor, this whole environment, it's just a mess.
So, if the game outside is total chaos, the only way you can possibly win is by controlling your internal game. And that brings us to the most powerful tool you have, your mindware. It's the thinking toolkit that lets you build a real foundation for success.
And this is the key concept right here, mindware. The best way to think about it is like software for your brain. It's not about having some genius-level IQ. It's about learning specific mental models that help you think more clearly and rationally, especially when everyone else is freaking out. You know, psychologists have shown that we basically have two modes of thinking. System 1 is our default. It's our gut reaction, fast, automatic, emotional. It's great for knowing that 2 + 2 is 4 or hitting the brakes in traffic. But here's the trap. We try to use that same System 1 for investing, which is where we have to consciously switch on System 2, the slow, analytical, and deliberate part of our brain.
So what does the System 2 work actually look like? Well, it's work. It's the hard stuff. It means reading dense annual reports, building financial models, really digging in to understand the business. The key thing here is, none of this takes a rocket scientist. It just takes effort. It requires the willingness to do the slow, hard thinking that most people just want to skip.
And the person who is the undisputed grandmaster of applying the slow, deliberate System 2 thinking to the market? Well, of course, it's Warren Buffett. He just flat out chooses to play a different game than everybody else.
This quote, it just says it all, doesn't it? In a world that is completely obsessed with speed, Buffett's greatest weapon has always been time. He uses patience as an active, strategic advantage. And this lays out the two mindsets perfectly. You've got the speculator, who's running on pure System 1. They need action, constant motion, high speed. Then you've got Buffett, the true investor. He doesn't just tolerate patience, he lives for it. He intentionally slows the entire game down. But it's not just about being patient. It's about being able to disconnect your brain from the emotional roller coaster of the market. Buffett's real superpower is his ability to stay rational when everyone else is either consumed by greed or paralyzed by fear. And as he says right here, that's exactly when you find the real opportunities. Now, all of this sounds like a great philosophy, doesn't it? Be rational, be patient. But does it actually work? Well, the scoreboard doesn't lie. So let's look at the hard data from a career that spans almost 60 years. To really appreciate these results, you have to appreciate the sheer duration. His career is like two huge acts. First, his early investment partnership, and then his epic, multi-decade run at Berkshire Hathaway. This incredible length of time is what separates true skill from just dumb luck. So let's look at Act 1. If you put $10,000 in the Dow Jones back in 1956, by 1969 you'd have about 15 grand. Hey, not bad. But if you'd given that same 10 grand to young Warren Buffett, you would have had over $150,000. I mean, that's just staggering. He didn't just beat the market, he lapped it multiple times. And then came Act 2. Now, this table might look like a wall of numbers, but just follow along with me. The first column is Berkshire's performance. The second is the S&P 500, the market. But the really important one is that third column, the difference. Just let your eyes drift down that column. Year after year, decade after decade, the pattern is just undeniable. So if you boil all those numbers down from that huge table, this is what you get. Over nearly half a century, the market gave a very respectable 9.4% a year, but Berkshire Hathaway delivered 19.7%. Now, that difference might not seem huge, but believe me, thanks to the power of compounding, over the long haul, that gap creates a truly astronomical difference in wealth. Okay, so we've seen the chaotic game, we've seen the mindset you need to win, and we've seen the incredible proof that it works. This brings us to the last and, honestly, the most important question.
one that turns the spotlight away from Buffett and right onto you. Buffett uses this powerful poker analogy, and it just hits home so hard. He says in any game, there's someone with an edge and there's someone who's the sucker, the patsy. In that high-speed emotional game that most people are playing, if you look around the table and you can't spot the patsy, well, I've got some bad news for you. And this is the bottom line. The default setting in this game is to lose. If you rely on emotion, on your gut, on that fast System 1 thinking, you are basically guaranteed to become the source of profits for the more patient, rational players. Rationality, your mindware, is your only defense. And so we end with the ultimate choice that every investor has to make. Are you going to play the frantic, high-speed game of speculation where the odds are stacked against you, or are you going to choose the slow, patient, and rational game of true investing? Because the game you choose to play will absolutely determine the results you get. The choice is yours. You hear the name Warren Buffett, and you immediately think of investing, right? Of just mind-boggling wealth. We all know the legend, the Oracle of Omaha. But behind all those staggering numbers, there's a much more personal story, one that really reveals what truly drives him. So let's peel back the layers. You know, to really get a handle on an icon like Buffett, someone who's been at the absolute top of his game for decades, you kind of have to look at his story from two totally different angles. And that's exactly what we're going to do here. First, we'll dive into the jaw-dropping performance. I mean, the numbers that really built the myth. And then we'll pull back the curtain and take a look at the person, the ambition that got it all started in the first place. So let's start with the performance. Because honestly, when you just look at the raw data, the conclusion is, well, it's unavoidable. His record of sustained, superior performance is just absolutely incredible. Okay, so take a look at this. This gives you a snapshot of Berkshire Hathaway's annual performance compared to the S&P 500. Now, don't worry about reading every single line, just kind of squint and look at the overall pattern. This chart represents decades of just remarkable consistency. All right, let's zoom in on a specific year to see what this actually looks like in practice. Let's take 2002. The S&P 500 was down over 22%, a brutal year for most investors. But Berkshire Hathaway? Get this. They were up 10%. That's an outperformance of 32.1 percentage points. He wasn't just weathering the storm, he was basically sailing right through it. And here we see the exact same thing play out, but during an even bigger crisis. In 2008, with the global financial meltdown, the market crashed almost 38%. Berkshire lost value, sure, but only by about 9.6%. That's an outperformance of 27.4%. When pretty much everyone else was panicking, Buffett's strategy showed just how incredibly resilient it was. So what does this all mean over the long haul? This is where things get really crazy. This is the magic of compounding in action. Between 1965 and 2012, the market returned a very respectable 9.4% a year. But Berkshire Hathaway? 19.7%. That's more than double compounded year after year for nearly half a century. And all of that compounding leads to this absolutely staggering number that really defines the whole legend, an overall gain of 586,817%. It's a number so huge it's almost hard to wrap your head around, right? This is the peak of his public legend as an investor. Okay, we've seen the numbers. They're insane. Undeniable. But what if the real story, the most revealing part of who Warren Buffett is, can't actually be found in a spreadsheet at all? And that brings us to the other side of the coin. We've seen the what, that incredible performance, but now let's dig into the why. You know, what actually drives the man behind all these historic returns? And to find a real clue, you've got to go way, way back, long before he was the Oracle of Omaha. Back when Eisenhower was president and Buffett was just a kid with this incredibly powerful ambition. See, as a young man, he used to tell pretty much anyone who would listen with total conviction that he had this one simple, audacious goal. Wow, I mean, just imagine a teenager saying that with a straight face. It gives you this incredible window into his focus, his drive, even way back then. Now, to be totally fair, the source material is clear that he was joking about the jumping off the building part anyway. But about the goal itself? Oh, he was dead serious. So Let's really think about that for a second. We all know he blew past that youthful goal a long, long time ago. But what's so fascinating is what that initial goal wasn't. It wasn't to be the richest guy on the planet. It wasn't even to be a billionaire.
No, his intense, all-consuming focus was just on that one target, a specific, tangible goal that, to him, was the very definition of success. It kind of suggests a mindset that's less about just piling up endless money and more about winning a very specific game he set for himself.
And that leaves us with this one last, really compelling thought. When you've completely crushed your wildest youthful dreams, by a factor of tens of thousands, and you've played the game better than anyone literally in history, what on earth keeps you coming back to the table?
All right, let's get right into it. For more than 60 years, there's been one guy who has consistently, and I mean consistently, beaten the stock market. Now, most experts will tell you that's impossible, but that guy is Warren Buffett. So the big question is, how on earth does he do it? Well, today, we're going to unlock the 3 core advantages that really make up what we call the Buffett advantage.
You know, I think this quote is the perfect place to start, because it really gets to the heart of his psychology. For Buffett, it's not about the fancy cars or the mansions. The guy famously lives pretty modestly. It's about the game. It's the intellectual puzzle and just the sheer satisfaction of watching these rational decisions compound into, well, unbelievable wealth. This mindset, this is our first real clue. To really appreciate his genius, you have to picture the world he's been investing in. We're talking about decades of pure chaos, hyperinflation, gut-wrenching market crashes, wars, all sorts of political drama, stuff that sent most investors running for the hills. But through all of that, Buffett didn't just hang on, he absolutely thrived. And the reason why is all about how he saw this chaos.
And this right here, this is the core of it. Where most people see a crisis and feel nothing but fear, Buffett sees a sale. He sees an opportunity. That unwavering optimism of his isn't just a quirky personality trait, it's a strategic weapon. It's what lets him live by his most famous rule, be greedy when others are fearful. This temperament, this is the foundation for everything else.
Okay, so here's our game plan for breaking this all down. We're going to start by setting up the central puzzle of his success. Then, we'll dive deep into his 3 core advantages, that rational mind of his unique way of looking at things, and the incredible company he built. And then, we'll wrap it all up with the big takeaway for all of us.
So, let's kick things off with this central puzzle. For decades, right, the smartest people in finance have pushed a theory that says you just can't consistently beat the market. It's all a game of luck, they say. And yet, there's Warren Buffett. His entire career is basically a giant challenge to that whole idea. So, really, how does he do it?
And this is the theory we're talking about, the efficient market theory. The gist of it is that all the news, all the research, all the gossip, it's all instantly baked into a stock's price. If that's true, then picking stocks is no better than throwing darts at a dartboard. You can't possibly find a consistent edge.
Which brings us to the elephant in the room, right? Buffett's decades of outperformance, his entire career, it just doesn't fit. His success kind of screams that maybe, just maybe, the market isn't perfectly efficient. Or, and this is the important part, that most investors are just playing the game completely wrong.
So here's the secret. It's not luck, and it's definitely not magic. It's a system, a really powerful approach built on 3 interconnected advantages. It's a framework that covers his mindset, his method, and his machine. Let's dig into that first one.
So this brings us to his first, and you could argue his most important advantage. It's all behavioral. And according to Buffett himself, this has very little to do with how smart you are and everything to do with your temperament.
You know, his longtime business partner, the incredible Charlie Munger, doesn't talk about Buffett's cleverness or his cunning. Nope. He points to something much more fundamental, a brain that just operates on pure, unfiltered rationality. It just cuts through all the emotional noise that trips up almost everyone else.
His biographer, Roger Lowenstein, says the exact same thing. And just look at the words he uses: patience, discipline, rationality. These aren't about intellect, are they? They're traits of your temperament. It's about your character, about how you act when the pressure's on, not just about what you know.
But really, who better to explain it than the man himself? Buffett uses this absolutely brilliant analogy about a car engine to explain the difference between just being smart and being effectively smart.
And this analogy just nails it, doesn't it? Your IQ is just potential. It's the horsepower of the engine. But your rationality,
That's what actually gets the power to the wheels. He truly believes that most smart people fail because they let their emotions, their ego, and their bad habits get in the way. They're basically throttling their own engine. So, okay, a rational mind is the foundation. And that's what allows him to have his second major advantage, which is all about perspective. It's his analytical edge.
This is where you can really see the massive difference in worldview. The average investor, they're glued to the ticker, the daily ups and downs, the endless economic forecasts. Buffett, he ignores all of it. Completely. He sees himself as a part owner in an actual business, and all he cares about is its long-term ability to make money. The only question he ever asks the market is, hey, is anyone out there panicking and offering me a great deal?
I mean, listen to how simple he thinks this should be. Forget all the complicated financial models and confusing theories. He says it all boils down to just two skills. First, can you figure out what a business is actually worth based on its real earnings? And second, can you develop the right mental attitude toward the market's crazy mood swings? To really get how he thinks about market prices, you gotta meet his imaginary business partner, Mr. Market. Some days, Mr. Market is just euphoric, offering to buy your shares at some insane price. Other days, he's totally depressed and offers to sell you his shares for pennies on the dollar. Now, you wouldn't take life advice from a manic-depressive, right? So why on earth would you take financial advice from him?
Now, stop and think about this for a second. Buffett has literally said he wouldn't care one bit if the stock market just shut down for a year or two right after he buys a stock. Why? Because his confidence isn't in that little flickering price on a screen, it's in the real-world business, its brands, its people, its profits. For him, the market is just a place you go to find a bargain. It is never an instructor telling you what to think.
Okay, so a rational mind and a business owner's perspective are incredibly powerful, but you need a structure, a machine, to apply them at a massive scale for decades. And that brings us to his third advantage, the organizational masterpiece that is Berkshire Hathaway. Buffett absolutely loves this quote from Winston Churchill, and honestly, it's the perfect description of Berkshire Hathaway. He built the company to be a perfect reflection of his own investment philosophy. And now, in turn, the company's structure just reinforces and amplifies that philosophy every single day. This right here is the beautiful, elegant engine at the heart of Berkshire. It is a powerful, self-perpetuating cycle. You've got dozens of businesses, insurance, railroads, candy, you name it, generating just mountains of cash. All that cash flows up to headquarters in Omaha, where Buffett, totally shielded from Wall Street noise, rationally decides where to put it next. This structure lets him move huge sums of money, patiently, turning profits from one industry into ownership of another. It's the ultimate compounding machine. Okay, so we've gone through the man, the method, and the machine. So what's the big takeaway here? What can we actually learn from all this? Let's just put it all together. The Buffett advantage isn't just one single thing. It's a whole framework. You have the behavioral advantage, which is all about mastering your own emotions. You have the analytical advantage, which is about shifting your focus from blinking stock prices to real business value. And you have the organizational advantage, which is about creating a system to constantly reinvest your profits for growth. The cool part is, each one of these has an action you can take. And that really brings us to our final thought. If we accept that Buffett's true superpower isn't some off-the-charts IQ, but his incredible, unwavering rationality and discipline, well, then it forces us to look in the mirror. The biggest thing holding us back isn't a lack of information or intelligence. It's usually us. So the question to leave you with is, what habits, what emotions, or what biases are getting in the way of your own output?
Welcome to The Explainer. Today, we're going to break down how to think like one of the absolute legends of investing, Warren Buffett. We're going to distill his core philosophy into a process that you can actually start using.
Okay, so let's just dive right in by tackling a really common myth. You've heard this a million times when people talk about Buffett's success, right? This idea that you need to have money to make money, that his billions came first, and then the success followed.
But here's the thing. The reality is the complete opposite. Buffett developed his unique way of looking at businesses long before he had millions, let alone billions. So the key takeaway here is that his method isn't a result of his wealth. His wealth is a direct result of his method, and that's something anyone can learn. To really get this, really internalize it, we're going to walk through a powerful thought experiment. This is designed to completely flip your perspective, from thinking like someone who just trades stocks to thinking like a true business owner.
So imagine this scenario. You get to pick one and only one business to invest in.
just one. And once you pick it, that's it. You're locked in for a full decade. Oh, and to raise the stakes a little, your entire financial future, your whole retirement is riding on this single choice. All of a sudden, everything changes, doesn't it? The daily stock price going up and down, the constant chatter on the news, the quarterly earnings hype, all of that noise just fades into the background. You're forced to think deeply, really deeply, about the actual business. Is it a good business? Will it be around in 10 years? You start thinking like an owner.
Now, this new mindset requires a whole new toolkit, so let's build out the exact framework that Buffett uses. We're going to go through his 4-part tenet screen. Think of it as your ultimate checklist for evaluating that one critical business.
So first things first, you have to look at the business itself. And the questions are pretty straightforward. Can you explain in simple terms how this company makes money? Because if you can't, you probably shouldn't be investing in it. Does it have a solid track record? Has it been through good times and bad? And maybe most importantly, what does the future look like for this company? Now, what's so interesting about this slide is that it really defines what favorable long-term prospects means. What you're looking for is what Buffett calls a franchise, a business that sells something people need or want that doesn't really have a close substitute, which means it can basically set its own price. The absolute worst business to own is a commodity business where your product is just like everyone else's and the only way to compete is on price. That is a brutal, brutal game to play.
Next up, you have to look at the people running the show. You know, a great business can be driven right into the ground by bad management. So you have to ask, are they rational? Do they invest your money wisely, or do they just throw it around? Are they honest with you, the owners, about the good and the bad? And crucially, do they think for themselves?
And that last point brings us to a really key concept, the institutional imperative. This is this powerful, invisible force in the corporate world that basically pushes managers to just copy what their competitors are doing, even if it makes absolutely no sense. You want to find managers who are strong enough to resist that herd mentality.
This quote, man, it just perfectly captures that dangerous thinking that the very best managers are able to avoid. This kind of everyone else is doing it logic leads to terrible decisions, dumb acquisitions, and a lot of destroyed value. A great manager is charting their own course.
All right, let's get into the numbers. Once you're feeling good about the business and its management, you have to check the financials. And these 4 tenets give you a much clearer picture of a company's health than the stuff you usually see on the news.
So, a lot of investors get obsessed with earnings per share, or EPS. But Buffett says, hey, that number can be really misleading. Think about it like a bakery. Just because they make more total bread this year, that's higher earnings, doesn't mean they're actually better at baking, especially if they spent a ton of money on new ovens. Return on equity, or ROE, is a truer measure. It asks, for every dollar of oven you own, how much profit are you cranking out? It's a measure of efficiency.
Okay, to really understand a business's cash-generating power, you've got to calculate what Buffett calls owner earnings. Think of it as the company's real take-home pay. It's simple. You start with the profit they report, add back a few accounting things that aren't actual cash expenses, and then, this is the most important part, you subtract the money they had to spend just to maintain the business, to keep the lights on. What's left over is the real discretionary cash that belongs to the owners. That's you.
I love this one. This is a fantastic, super quick test of how good management is. Just look back over the last decade or so. For every single dollar the company kept in the business, instead of paying out to shareholders, did it create at least a dollar of new market value? If the answer is no, then management is actually destroying your wealth. And only now, after all of that hard work, after analyzing the business, the management, the financials, only now do we finally look at the price tag. The final step is to figure out what the business is truly worth, and then see if you can buy it at a big discount to that value, what Buffett famously calls a margin of safety.
So, you now have the toolkit to analyze one company like a true owner. So what about building an entire portfolio? Well, the great thing is the rules don't change, they just scale.
Buffett argues there are really 2 kinds of investors. There's the know-nothing investor, and that's not an insult. It's just someone who doesn't have the time or interest to analyze businesses. For them, buying an index fund and being broadly diversified is absolutely the best strategy. But if you do the work we've just talked about, you become a know-something investor. And for you, it makes way more sense to concentrate your money in your very best ideas.
And this quote just gets to the heart of it, doesn't it? If you've done the work and found a handful of truly fantastic businesses that you understand inside and out, why on earth would you water down your returns by putting money into your 20th best idea? It's all about putting your capital where your conviction is highest. So let's bring this all home. let's wrap this up with the single most important philosophical shift you need to make, the one idea that underpins everything we've just talked about.
This right here, this is the whole game. You have to stop thinking of yourself as someone who buys and sells little pieces of paper called stocks. Instead, start thinking of yourself as a part owner of a real, living, breathing business. And you should hold on to your little piece of that business with the same care and long-term view as if you own the entire company yourself.
And that's the question we want to leave you with. Every single time you think about making an investment, ask yourself this: am I buying a piece of a wonderful business that I want to own for years and years? Or am I just renting a stock, hoping its price goes up for a little while? The answer to that one question will make all the difference in the world.
All right, today we're going to dive into one of the most successful investment philosophies ever created, the Warren Buffett Way. But what we're going to discover is that its greatest lesson isn't just about trying to copy a billionaire, it's about finding a method that truly works for you.
You know, this quote from George Johnson, it really hits on something fundamental about us, right? Our minds are basically pattern-seeking machines. We are literally wired to find order in everything, because spotting those patterns makes a chaotic world feel just a little more predictable, a little safer.
And here's the thing, that exact instinct, that deep-seated need for order, is precisely what creates the central dilemma for every single one of us who tries to invest.
Which naturally brings us to our first big idea, the pattern trap. Because while our brains are amazing at finding patterns, they often trick us into looking for them in all the wrong places, especially when our money is on the line.
I mean, think about it. This craving for order isn't some random quirk. It's a powerful survival instinct. For centuries, it helped us predict the seasons, find food, and just generally make sense of things. It gives us a feeling of control in a world that can feel, well, pretty out of control.
So here's the crucial point. That powerful, incredibly useful instinct can completely backfire in the financial markets. It pushes so many well-meaning investors to go hunting for predictable sequences where really none exist, and that leads them straight into a trap.
Okay, so let's dig into that a little more in our next section, looking in the wrong place. Where exactly does this pattern-seeking instinct lead us astray?
Yeah, this is where it all goes wrong. So many investors get caught up trying to decipher the little squiggles on a stock chart, looking for some secret code in short-term price moves. They end up acting like fortune tellers, trying to guess the market's next big swing or what the economy is going to do next. These feel like the right patterns to chase, but honestly, they're illusions.
And here's the hard truth. The market and the economy are they're just too complex. They're driven by millions of unpredictable human decisions every single day. The exact patterns of the past just don't repeat in a way that you can reliably predict. It's a search that's pretty much doomed from the start.
Okay, this slide right here, this distinction is everything. True investment, over on the left, is all about knowledge of a business, the stuff you can actually analyze and understand. But speculation on the right, that's just a bet on the unpredictable psychology of the crowd. One is about reducing your risk, the other is all about chasing it.
So, if looking for patterns in the market is the wrong way to go, what's the right way? Well, that leads us right to the solution, the business-first approach. And this right here is the secret sauce. Warren Buffett's genius wasn't that he found a better crystal ball to predict the market. No, it was that he realized he should just throw the crystal ball away entirely. Instead, he completely shifts his focus and looks for recognizable, understandable patterns at a much more manageable level, the individual company itself.
These are the patterns that actually matter. First, the business patterns. What does this company do, and how does it protect itself from competitors? Second, you've got the management patterns. Are the people in charge talented? Are they honest? And are they really working for the shareholders? And third, the financial patterns. Does the company have a long, consistent history of making money and a healthy balance sheet? See, these are things you can actually study and get your head around.
This slide just lays it out perfectly, doesn't it? You've got two paths. The market-focused approach is a total roller coaster of psychology and short-term speculation. But the business-focused approach? That's about patiently building on a solid foundation of fundamentals. One is a gamble, the other is a genuine investment. I mean, Buffett himself said it best. The weights he's talking about are the fundamentals, the real, tangible, analyzable facts about a business. The votes are just the daily whims of the market, driven by fear and greed. Which one of those sounds like a better thing to base your financial future on?
And this is the big payoff. Sure, in the short term, stock prices can be a chaotic mess, but over the long run, a great company's success, its business pattern, will absolutely, inevitably be reflected in its stock price. A great business eventually becomes a great stock. You just have to be patient.
Okay, so let's see what this looks like in the real world. On the left, that's Berkshire's portfolio way back in 1977. Now notice the top holdings: the Washington Post, Geico. Now look over to the right, 10 years later in 1987. The same companies are still at the top, but look at how their market values have just exploded. This isn't about frantic trading. It's about deep, long-term conviction in the business itself.
All right, let's fast forward another decade, comparing 1987 to 1996. His core holdings, still there. But notice what's happened. The portfolio has gotten even more concentrated in his biggest winners. He's not just holding on, he's doubling down. And, of course, new giants like the Coca-Cola Company have appeared. This is the visual proof of business success translating directly into incredible market value over time.
So how do we actually put this mindset into practice? Well, it all boils down to a really simple but powerful framework: price versus value. You know, despite all the supposed complexity of investing, Buffett's entire method really boils down to just two core things you need to think about. It's all about stripping away the noise and focusing only on what truly matters.
And here's the whole process. Step 1, find the price. That's the easy part, right? It's what the market is telling you his share costs today. Step 2, though, that's your homework. It's figuring out what the underlying business is actually worth based on its ability to earn money in the future. Your profit, it's found in the gap between those two things.
And, you know, the real beauty of this approach is the psychological freedom it gives you. When you focus on the business, you are liberated from the daily anxiety of watching the market tick up and down. You stop wasting all that energy on things you can't control, and instead you can focus your time productively on understanding what you actually own.
And that sense of freedom, it brings us to our last and honestly probably the most important section: finding your own path. This, right here, is the ultimate goal. Buffett's method isn't just a formula. It's a whole philosophy that aligns perfectly with who he is. So the key isn't just to blindly copy him, but to find an investment strategy that fits peacefully with your own personality and the kind of life you want to live. Because when your strategy fits your personality, you actually find joy in the process. I mean, how great is this? Buffett says he gets to tap dance to work. That's what happens when you build a system that makes sense to you, that you believe in, and that lets you sleep well at night, totally free from the anxieties of speculation.
So we'll leave you with this one question. After everything we've talked about, just take a moment and think about your own approach. Are you focusing on the knowable patterns of a business, or are you getting lost trying to guess the unknowable patterns of market psychology? Because at the end of the day, the answer to that question makes all the difference in the world.